decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Kearney in New York.
And I'm Danny Berger in London. Here's what you need to know. The dollar extends its winning streak while yields fall back from decade highs as confidence in the U.S. economy stalls. Markets are on edge with the U.S. on track for an October 1st shutdown, despite some incremental progress on spending bills from lawmakers. And the Federal Trade Commission files a landmark lawsuit against Amazon, accusing it of monopolizing online marketplace services. Now, the dollar continues to weaken. We're in this moment where the euro is at its lowest, at its weakest level since March, since during the SVB crisis, since the collapse of Credit Suisse. Euro, that's trading at under 106 versus the U.S. dollar. So we continue to see the dominance of the dollar, but virtually everywhere else, and I know, Manus, you'll get into the equity part of this, it is a pause of the past week, a pause, a rethink of this adjustment to a higher for longer regime. Crude, that continues its move higher. It's up a 1.33%. We've seen that impact coming from OPEC Plus. It's really bucking that overall demand concern. On that note, Eurasia says that OPEC Plus will need to hold on to those cuts and keep them coming into 2024 if they want to put that floor underneath oil prices. And here you go, U.S. 10-year yields, those are lower by, let's call it 4 basis points. Again, this is a pause, Manus. We're now back under the 4.5% marker.
And is that roll down in the yields, Danny, that gives a little bit of a pause for thought in the equity market and sort of stymies the implosion that you had? S&P and NASDAQ down 1.5% yesterday. They put in a little bit of a more level ground this morning. So you've got the S&P 500 up 0.4% and the NASDAQ up a similar amount. What you've got to consider here is that the tech sector reflected in the NASDAQ is down 11%. It's in a correction territory. Is that a reason, as ICAP said, which is on these drops, is where they want to come in and scoop up opportunities in mega tech? The flow out, we saw it in the Bank of America flow show in Europe 26, 27 weeks in a row. Barclays say the European stock outflows are overdone, but what you have here is this pause for thought as the yields roll down. We just had a conversation with Optimus, with Octavio there, and he made the point, actually, you should get ready for 6% or 7% rates. It is a very real possibility, and in that context, you can expect a further drop of 10 to 15% in equities. Bottom of your screen, you've got the all-world index, and we've got the longest losing streak going back to 2011. Yes, it's below its 200-day moving average. It's back to flat at the moment. Keep an eye on Amazon. Let's see how it trades in the day. You've got this landmark lawsuit, antitrust lawsuit, a monopolist that stifles the competition. We'll talk about that through the next 30 minutes. Amazon was down 4% after the close yesterday evening. We'll check out how it trades for the morning. Danny.
Yeah, Manus, I got to say, you know, listening to Octavio talk about a 10% drawdown possible, I got to think how awkward the timing is. We've just come out of this period where strategists, sell-side strategists on stocks have been so caught off by the gains. Virtually everyone just upgraded their outlook. But now we're in this period where, hey, potentially they can't last if we're having this rethink on duration.
Well, the whole point about duration is, and again, we brought this up, you've got this term premium back in the bond market, back in the green, and for him, that is not enough to scoop up bonds on duration. He wants to be at the short end of the curve. And by the way, you're going to earn 5.5%, Danny, on your equities. Sorry, you're now going to earn 5.5% in money market funds, which are just sucking in the money, $5.5 trillion this month, relative to the dividend yield in equity. So there's a battle royal between risk-free money and pure volatility play in equities. Danny, good morning from New York.
Good morning from London, Manus. On that note, let's shift to Europe. And, well, I guess not to London, to everywhere in Europe, but London, and focus on the ECB because they've just published credit data about an hour or so ago from the ECB showing the biggest slump in that credit data and demand since the euro crisis. Despite that, we heard from ECB Governing Council member Robert Holtzman speaking to the team yesterday, saying he can't rule out another rate hike. Take a listen.
And as a result, we cannot say for sure now we have reached the peak and no more increase. The reason is that the inflationary pressure is still on, and just these recent days we have seen how much energy prices have surprised us.
Joining us now is Ludovic Bund, Allianz chief economist. Ludo, even if there is more inflation to come down the pipeline, does the ECB risk an accident at this point if they continue to hike with the deteriorating data we've seen?
For sure, and especially because, if the ECB now gets its intel from the higher energy prices, we're getting it wrong. It's not up to the ECB to hike to lower the price at the pump, right? We have other issues and certainly other policies in our toolbox to deal with that. I think a further hike would be really pushing it over the fence. The big question now is how long can we stay at these high levels of interest rates? Because already we see the deteriorating credit data, and we already see that the housing market is also under a bit of duress, right? So I think the big question now is whether they're going to pivot at all in 24. And I think this is, a lot of that is in the hands of the Fed. You just mentioned some people are now repositioning themselves in a much more bearish environment, so much higher for much longer. I think that's going to drive also the ECB. They don't want to be the only one to pause, because that would completely spook markets, that the ECB would have thrown the towel a bit too early. So that's the risk here. What the Fed does will be a much bigger driver than the energy prices in the ECB objective function and monetary policy function. We have the ECB staying put for now, but we still have one hike for the Fed. So that's going to be something that will create a bit more of a transatlantic spread, if I will.
Ludwig, good morning. Yeah, I mean, we saw the consequence of the Swiss doing that sort of unexpected pause. Look at the Swiss franc. I mean, talk about taking a pasting. The longest run of losses in 50 years, and the euro is under pressure. But let's go back to Holtzman. Okay.
I'm surprised the Bank of England didn't have the same reaction, because they paused far too early. The UK is one of the few economies that actually has a wage price spiral in the making right now. So you're right. Currencies are going to be the jury, and they're going to be the yardstick against which we're going to be worried, especially because the dollar is still very strong.
Okay, let's push you a little bit further then. Let's bang these out then. Okay, on sterling, you're surprised by their action, but sterling has taken the heat. So how much lower does sterling go? Lots of people are calling down to 118. Where do you think the pressure in sterling is? First of all, let's take it there.
I think they can go down as much as 10 to 15% more if the Bank of England doesn't hike again before the end of the year.
And Ludo, you talk in your notes about the everything slump, about all asset prices falling in 2022. Have we grappled with the new normal of a lower return world?
Well, I think one thing is sure is that, the end of, real equal nominals world is behind. I mean, we see now that anybody is deciding on where they put their savings based on real returns. And of course, there's been a big move from bank deposits to the bond market, but the bond market is super volatile because everybody is tracking whatever the central banks are doing. And you see the central bank's data dependence is a nightmare for market participants, because we never really know if they pause for real or if it's a dovish pause, a hawkish hike, whatnot. So you see that this is creating a lot more volatility on the bond market, which is one of these securities that people actually were rushing into. And 2022 was a one every 30-year type of event, nowhere to hide. So 23 looks much better, but it doesn't look as good as one would have expected. And you mentioned, in your introduction remarks, the risky assets. Equity markets have been super, super resilient. Credit spreads have also been super, super narrow for their own good. So of course there is a risk that there is a repricing on that front. And so we're looking, especially at the weaker links, the peripherals, the high yield, there is still, a need for, quality for the investment. So the world for investors is not easy. We know the world for net lenders is not easy, but the world for net savers is not easy either.
Ludwig, I had the point at the start of the show, which is I can now get an ETF of a batch of T-bills or short end rates that give me 5.5% in dollars. If I am a more mature investor, let's say, why not take 5.5% until I get all of these issues off the agenda in the back quarter. Surely I'm driven more to the short end of the curve at 5.5% than I am to high volatility equity. I mean, is that how I should look at risk going to the end of this year and the beginning of next year? It sounds to me like you're talking about a very risk-off 2024 environment.
Of course. I mean, 2024 is the ultra-long year. The polarization on the U.S. elections, the wait-and-see mode on investment and consumption for corporates and consumer is going to create a natural risk-off mode. You're right. Everybody is pushed to the shorter end of the curve, but this is also where the bulk of the volatility stays. So it's great to have an ETF, but you need to stay put and to hold to maturity. At least, don't move too much.
Yeah, I tried that a few times in 1994. It didn't go so well. It was one of the largest margin calls that I ever had. Take me back to 1994. Thank you, but no.
Yeah. There is a clear parallel with 1994 on the hiking cycle, by the way, because we don't know if they're going to give us. Yeah.
Yeah, I mean, we're a step away of Manus reinforcing that he's going to take forever to retire with those sorts of moves. Hey,
say
Ludo,
no,
okay,
Maddie. Say no.
Yeah, agreed, Ludo. Okay, look, so it's these front end cash-like instruments that are getting all this attention, but weren't these the money market funds that melted down in the pandemic and caused the Fed to step in? If all of a sudden we're talking about more money flooding into it, should we not be concerned right now?
Yeah, look, I mean, we had a bit of a scary March, right? So I think we are not out of the woods yet. There is, of course, these liquidity pressures, but market liquidity, because the central banks are withdrawing fast, and so there is a question on whether there is a rebound in U.S., especially provided liquidity in 24. I believe yes, and there is the funding liquidity. Just talked about the risk of a credit crunch in Europe. So yes, I mean, money market funds is a huge vortex, and it's great for the short-term returns somehow because it's stable in an environment that is not stable, but that creates a lot of side effects or negative externalities on the other products, and especially for banks it's a big question, because there are banks and there are other financial providers that should really look at the leverage and that should really look at the liquidity position with eyes of a hawks. I've been saying that since March. The liquidity crisis is not over. You need to watch.
Do you think that we face another SVB-like moment briefly before we move on to China? We've got to squeeze China in before the end. Well, I'm not saying that we're going to have another bank implosion, but are you deeply concerned about a major financial tail risk on the flight of deposits?
Yes, I am.
Okay. I love this line. An undisputed hegemon, H-E-G-E-M.
Hegemony?
Thank you. Hegemon in finance is France and Japan have lost. I know. You see, it's the Irish in me. It's these long words.
The Irish, yeah.
Europe and Japan have lost some of their weight in the composition of the global financial markets. China's share grew slightly. When I look at everything that's been written about China, written about housing, watching images of massive tower blocks being blown up, when I look at the incremental policy responses, I'm not inspired. Are you?
I'm not. China is very cheap. Chinese equity are very cheap, but if you believe in a Cold War II, you don't go much further in terms of positioning. You're right to mention the real estate crisis. You have to think Spain 2009. You have to think Japan mid-90s. It's going to take some time for China to be attractive again because they have a very depressed saver. People have lost all of their pension, in Evergrande crisis and the likes, right? So I think it's going to take time, but I wouldn't, underappreciate the fact that China is very innovative when it comes to policy determination, and they're ready to cut a couple more times the RRR. They're ready to put more fiscal subsidies without recreating a bubble. So stay tuned. It's not going to be as bad as the market sentiment is pricing in right now, but personally, I would be very cautious with Chinese holdings. I think it's still, there's going to be some flaring up in the US-China rivalry, and it's going to be on the capital account. It's not going to be only on the trade account.
Ludo, stay tuned, but how long do I have to wait at this point? Bloomberg Intelligence had a great headline out saying, not a bazooka, but many pistols. How long do I have to wait until the many pistols result in sustained growth from China?
I think my expectation is that they're going to do a big move on consumption like they did with the EV reduced VAT back in 2016. The problem is that he needs first to align the ducks, right? And the problem here is China doesn't want to create another bubble because that would be really detrimental to any form of growth. So they need to reposition a lot of the public investment and the policy mix, including the cheap lending, to these tech environments. So climate tech, maybe tech at large large, and certainly also the manufacturing. I think you're going to have to wait at least another 6 months because there is some division on where to stand. And they're going to also watch what's happening in the US election. So it could be as much as a year. But I think they're going to make some moves by the end of the year. And so we're going to have a bit more forward visibility, I would say, by the beginning of 2024.
I was going to say 6 months a year. I was actually expecting you to say longer. That'll go by in no time. What time is meaningless at this moment? Hey, Ludovic, we're on time
in
here.
lending mode. Oh, sorry. A lot to say on China.
See? Oh, Ludovic. All right, come back on. You deserve another go. Ludovic Sabran of Allianz, thank you so much for joining us today. We'll hopefully see you again soon. Now, coming up, oil extends gains, hitting U.S. consumer confidence amid higher costs and excessive rate hikes. We're going to have more on that for you next. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Brief. You're looking live in the principal room. Coming up later today, an interview with Bob Michael, J.P. Morgan head of global fixed income, 7:30 a.m. in New York. That's 12:30 p.m. in London. This is Bloomberg.
So oil is marching higher this morning, resuming its rally. We're trying to grapple with how tight this market is for the back quarter. We're up 30% in the third quarter, up 36% since the June lows. There is unanimity, some would say, in the OPEC Plus family. What does it mean for prices going into the back quarter? Let's get to Will Kennedy. He is our managing editor for Energy. Will, I mean, look, to a certain extent, we've already got the message from OPEC Plus about the additional unilateral cuts. Is that what's squeezing the market higher, Will, or is the market front-running a bottoming out in China? Good morning.
Morning, Manus. Great to see you. I think it's still the OPEC cuts that are really taking hold of this market. It is constraining supply. There is less crude getting to the market than people have expected, and I think the global energy system, the global oil system, is stretched a little bit thin right now. But what we're seeing, I think, is a battle, as you allude to, between that tighter supply and how the global economy and the Chinese economy pans out in the rest of this year and into next year. And I think people are trying to find the price where oil demand reflects the economy at a time of constrained supply.
If we do get even less in demand, a recession, what have you, is OPEC Plus, is Saudi and Russia in a position where they can continue to cut to put a floor under prices?
I'm not sure that Saudi will want to cut production much further than here if it can avoid it. Its production at about 9 billion barrels a day is very low by historical standards and leaves it with a considerable amount of spare capacity. So I'm not sure that that's a terribly attractive proposition. Of course, they have the option to extend their current cuts further into next year. And next year, a lot will depend on what other parts of the world do, how far shale slows, whether that can continue to grow, whether there's more oil from Venezuela, whether Iran continues its renaissance. I think a lot of people are now turning towards balances for next year, and that, as always, interplay between supply and demand. And some people are saying that, in fact, the market may not look as tight next year. So that, again, is feeding into the price today, because the market looks very tight right now, but some people are questioning whether that tightness remains into 2024.
Well, of course, we may get more supply from the likes of Iran and the Fragile Five. And Halima Croft reminds us all about Vladimir Putin and the potential re-weaponization of Russian crude flows. Will, thank you very much. Will Kennedy there with the very latest on the oil market. There's what Halima had to say about the market. Moscow may reduce some of the complacency that had crept into the market, but more on that oil market a little bit later on. Coming up on the show, we're going to take a look at some of the market moving events for your trading day ahead. I thought we'd just check in on the currencies with you. The dollar, the musculature of the dollar is pretty flexy. It's up for 6 days in a row. 2023 highs. You're looking at the yuan. The dollar rising, yuan lower. We did have a stronger fixing and a bit of verbal intervention on that. The euro at the bottom of your screen is down 1/8 of 1%. As you can see, a credit data slump is really, really gripping Europe. The Fear and Greed Index hits the most bearish in 6 weeks. Euro dollar trades at 105.58 on Bloomberg from New York. Good morning.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Business Week Radio Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead. We're going to be getting U.S. durable good orders. They're likely to continue to signal tepid business investment outside of semis. That data will hit at 8:30 a.m. Eastern. Now, at the same time, we're also going to be having Micron reporting earnings. That's going to happen after the U.S. market close. Their investors are looking for any signs of recovery. There's been a lot of demand and excitement around chips. Can they keep it going? And then the second Republican presidential debate will be at 9 p.m. Eastern. Former president and current frontrunner Donald Trump plans to again skip the event. But of course, Manus, he will be heading to Detroit. He's going to be speaking there. President Biden was just there too. So that's kind of the main event for him.
It is indeed. We saw Biden on the picket lines yesterday, so it's head-to-head on that front. We've got the story on Amazon, haven't we? The U.S. Federal Trade Commission suing Amazon. It's a long-anticipated antitrust case accusing the e-commerce giant of monopolizing online marketplace services. In the complaint, it was filed in the federal court. The FTC and 17 states accuse Amazon of stifling competition and overcharging sellers.
These are a set of tactics, but ultimately Amazon has pursued them to deprive actual and potential competitors of the ability to gain the scale and momentum needed to effectively compete online. And having achieved and protected its monopoly power, our complaint details how Amazon is now exploiting that monopoly power in ways that harm customers.
Joining us now is Tom McKenzie. Tom, good to see you. Look, what is this case about? The accusation is sellers are paying $1 of every $2 to Amazon, a monopolist that stifles competition. What's the end game?
Well, look, this is the fourth straight suit from this FTC chair, Lina Khan. And look, she was pretty unapologetic in her critique of Amazon, as you heard there, saying, look, this is a monopolistic company and that sellers, but also buyers, you and I, are paying more as a result. So she's accusing Amazon, for example, of compelling sellers on the marketplace, forcing them to use their logistics and shipping parts of their business, also punishing them if they put their prices down on competing websites. Interesting as well in this suit, saying that Amazon actually interfered with the investigation by, for example, using Signal to hide some of the information that the FTC was trying to get their hands on. Amazon, importantly, saying they're going to challenge this, saying that it is wrong, this case, on the facts and the law.
Tom, we're going to have to leave it there, unfortunately. Thank you for the latest on Amazon. Taking a bath yesterday, that is Bloomberg's Tom McKenzie. Manus, we didn't have time to talk with Tom about it, but $90 billion valuation, that's what the Journal is reporting on OpenAI. That is a nice chunk of change.
It is, and that's going to be a private sale, we understand. I just wonder who's going to pick up a portion of that. Danny, good to see you this morning. We didn't get to celebrate you being made British. I'm going to hold that over for tomorrow.
Next time.
That's it for Bloomberg.
I'm even dressed patriotically.
Surveillance is up next.
strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
What's happened in the last 2 months is we are seeing a breakdown again in a lot of the stock market.
There's some recognition by the Fed that if you tighten financial conditions much more, you're going to do real damage to the economy.
The Fed might hold here for a while, but it's very difficult to see why they'd want to go a lot higher from here.
Fed's retaining its optionality. It's not saying we're definitively moving higher, and it's certainly not saying 7%.
It's just hard to see what the positive catalyst is for markets today.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
3-month lows in the equity market, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market is positive this morning and trying to bounce up by 1/3 of 1%. That has not been the story of the last 24 hours. Yields up, stocks down. In the FX market, that's where the attention should be right now. TK, euro, dollar, 105, dollar, yen, pushing 150.
Walked in and looked at the terminal off the cell phone, John, and you go wow when you see a number move. I did a hat trick of wows. It's wow, wow, wow. It is Wow Wednesday. Across assets, we're going to be on this all morning long. Where do I begin? I begin with a real yield and the effect on the FX market out to 2.22%, John. I never thought I would see this quickly.
Lisa, things are getting restrictive and it's starting to bite.
It's starting to bite, which is a question of, are people getting a little over their skis here? There was an essay yesterday by Neil Kashkari, a Minneapolis Fed president, and he talked about two outcomes, either a soft landing or inflation continuing to accelerate hotter than they expect and them having to raise rates further. Where was the base case of a consumer that was running out of money and the potential for a recession? It seems to be off the table in some of the expectations, even as we see signs of true weakness.
Credit to Neil, who I think nailed it at the start of the year. Nailed it in terms of what the objective of this Federal Reserve is and what they'd need to do, TK, get rates up and then sit there for a while. And I think we're at that point now in the last month where we're starting to fully internalize this high for longer message. Yeah. TK, do you think we've fully discounted that now?
Oh, no. This is a process ongoing, and again, you can see it across FX and into the bond market. But, John, I'm going to shift from the liquidity, the fungibility of our world over to tangible assets. Dare I say real estate, and with our guest Chris Verone to start off, that's right where I'm going.
Looking forward to it. Chris around the table with us. Let's start with the price action. Equity futures on the S&P 500. As I said, trying to bounce by about 1/3 of 1% on the S&P after another tough day of losses for the equity market bulls. In the bond market, yields through 450 and back down again, down 3 basis points this morning to 449. And that's that dollar strength for you, Lisa. The euro against the dollar, 105.61.
It's just amazing. Dollar strength has been one constant no matter what happens. in the rest of markets. What I'm watching today, 12 noon, Bank of America Chief Executive Officer Brian Moynihan speaking at the Economic Club of New York. I think it takes on a renewed importance simply because we've heard from a series of bank CEOs, and they all lean into this stronger for longer kind of story, right? We were hearing that from David Solomon. We were hearing that also from Jamie Dimon. Do we hear the same from Moynihan? Aftermarket, Micron is reporting earnings. This, again, I think the earnings are really going to be what could potentially be the most interesting data points, simply because you are starting to see weakness. We saw that in Costco yesterday. Do we see that in the semiconductor space as well? And at 9 p.m., the second debate of the Republican presidential candidates, it's airing on Fox. It's happening at the Ronald Reagan Presidential Library in Simi Valley, California. Who is not going to be there is the former President Donald Trump, who I don't know if he'll be joining the picket line, but he will be in Detroit with a follow-up act to President Biden yesterday. I wonder how much he's going to discuss electric vehicles and lean into some of the industrial policy. Very curious to see how that plays out.
Is he invited to the picket line?
I don't think so, no.
Okay.
It has been pretty, a little bit more frosty between the UAW and the former president.
Elaine Carmark was with us yesterday, the presidential historian, and she was riveting on her language on this. And off camera, she was really heated about should a president pick a side. And my point is, I don't think anybody out there is picking capitalism, job formation, investment in cash, the automakers trying to get to the future. It's a pretty lonely group.
He didn't have a choice, did he, TK? Based on the fact that he came out and said, I'm the most pro-union president in the history of this country. Where else is he going to be other than the picket line?
You know, I'll leave it to Greg Giroux, our expert on this, but the answer is there's X number of states, let's say 10 states that matter. Michigan's clearly one of them.
Big time.
And all this is about is the electoral votes and the closeness of that race the last two elections.
AMH coming up a little bit later this morning. Look out for that conversation down in Washington. As we said, around a table with us here in New York, I'm pleased to say Chris Verone, partner and head of technical and macro strategy over at Strategas, a Baird company. Chris, good morning to you.
It's great to be here. Thanks, John.
We've tried to frame this the following way over the last few weeks, whether this move in the bond market is a reflection of resilience, an extension of the cycle, or a recipe for the end of it. Based on the moves in consumer discretionary, is it the latter and not the former?
I think it's the latter, and I think one of the big shifts over the last, let's say, 4 or 5 weeks as bond yields have made this last leg higher is that it's no longer being accompanied with cyclical leadership. You know, if you think about most of the year, it was bond yields up, but cyclicals over defensives. That changed in about mid-July when we began to really see the weakness in discretionary. We began to see some softness in industrials. It first really began in Europe. If you look at the European luxury stocks or European discretionary, that has now spread here. So I think you have to ask the question, is this last move up in yields the signal that we're end of cycle? And I suspect it probably is.
So is that a signal to buy, given this move we've seen in yields? Buy the long end?
You know, it's funny. We've thought about this a lot. You know, most in this business have spent their whole career waiting for bond yields to go up. And now it's finally happened, and all people are clamoring to do is to buy bonds. I think it's too early. Just a pure technical read of the charts gets me something like 510, 520 on 10s. I don't know if we get there or not, but we've had one mantra all year. The trend in yield is up until the market suggests otherwise, and the market has not suggested otherwise here yet.
Katie Kaminsky at Alpha Simplex, wonderful on trend-based technical analysis, and I took her head off yesterday. I totally agree with you. We can go blah, blah, blah on the show, but the technicals of the 10-year yield now are higher yield, and we can bore, you know, we'll do it off camera, bore ourselves with that. I want to go to the real yield, 2.22%. I modeled that months and months ago, and I'm shocked at how suddenly we got here. Tell me about the suddenly of the yield move we're seeing.
You know, I think what's interesting about this business is one of the real constants is the surprises tend to be in the direction of the trend. And the trend in yields is up, so I don't think it should be a particularly big surprise that they've gone up. And when I look at the real yield, I think it's a reminder that investors are going to demand a positive real yield. Historically, the last 75 years, U.S. 10-year yields have traded 200 basis points above headline CPI. So even if you're in the very optimistic inflation camp, let's say 2.75 or 3%, you can certainly justify nominal 10-year yields of around 5. That is not even remotely historically unusual.
Before we went live, you and I talked about the REIT sector. To me, there's all this talk, you know, it's a market talk and that. Forget about it. The real yield is about tangible assets like real estate. As an example, is it going to be an implosion of the REIT industry as we've seen from the 70s on?
Well, I think the other lesson of trend following, Tom, is in periods of stress, the weak act the weakest, right? So what made new lows yesterday? The S&P Real Estate Index. What made new relative lows yesterday? The REITs as well. So I don't think we should be surprised by the price action if we let the trend dictate how we position. And when I look across all the sectors here, look at the difference between something like REITs or discretionary or even tech, which internally, while they may be vaunted, internally they're very, very weak. And then compare it to something like energy. 95% of the energy sector is still above the 200-day moving average. Yet it gets no respect relative to the attention all year that was paid to semis or discretionary. It's a very, very wide divergence between how good energy is and, frankly, how weak the rest of the market is.
So would you say that something is breaking and we just don't notice? That basically the overall average market-weighted S&P index has papered over some of the breakages that we've seen under the hood?
Yeah, typically you'd look at, say, the 200-day moving average on the S&P and say, listen, it's upward sloping, we're correcting in an uptrend, and therefore we should look to buy weakness. I think we have to nuance that a little bit this time because the underlying trends, when you go stock by stock, are so poor. And that's what's been so unusual about, we're almost 12 months off the low here. And we never got more than 65-70% of the S&P above the 200-day moving average. That's very unusual for the first year of a new bull market, which tends to be the broadest, the rising tide, the fun part of the cycle. That hasn't happened here. So my suspicion is the market all year has told us that it's not convinced we've seen the worst part of the business cycle. And that's how I want a position behave.
At this point, you said that we could get up to 510, 520 on the 10-year yield before something starts to reverse. What's your sense of what's behind this? I mean, as a trend follower, is this something more than simply people just pressing a sell button if everyone says that they're buying and there's no evidence in yields?
Well, I think the supply story has certainly been well talked about here. I find it interesting that the shape of the curve has kind of begun to bear steepen here, and bear steepen is very rare in developed economies, actually quite common in developing economies where inflation issues have been more frequent. I think that's a possibility. I also think, Lisa, as you and I have talked about, there's some structural changes here as well. The Chinese are sellers, the Japanese are sellers, the Saudis are sellers. So you have three relatively large buyers or traditional buyers of U.S. Treasuries who are not kind of on the playing field anymore. Those seem to be pretty massive shifts in how we should think about the structural call.
Do you have a decent understanding of where the buyers will come from?
No.
With that in mind? That's the problem, isn't it?
I don't. I mean, I think at some level there's an attractive yield where you want to be a buyer of bonds, and I keep going back to this idea of, okay, at a minimum it's got to be 200 basis points above CPI. That's just been the historical relationship. So if it's 350, maybe it's 550. It's 3, maybe it's 5. But this is going to be a very unsatisfying thing, what I'm about to say next. Yields will go up until they don't, right? That's what happens every cycle. They go up until they fall.
Let me make a banner here.
Well, Chris, this is important. It's that morning. What does that morning look like? Can you just give us an idea? How people understand how to identify that moment. They go up until they don't. What does that mean?
One of the first things I would look for some capitulative volume in TLT. So TLT is the long bond ETF. You've been doing 40, 50 million shares a day there. I think at the 2020 kind of COVID inflection point, you did 80 or 90 million shares a day. That really reflected panic or fear. I want to see something like that. The flows continue to just pour into TLT. So don't we need to see some change there, right? My experience in this business has been a move reverses when the flows get extremely lopsided on the other side, and we just haven't seen that there yet.
Yesterday with Eric Davis of BMO Montreal and Toronto, I was talking about the pointiness where this gets solved. Ben Laidler out with a great note off your idea of bear steepening. Laidler saying it's an unsustainable bear steepening. And in foreign exchange, it's expressed with, say, dollar loonie, where you get weak Canada. And Martin Feldstein was great on this. Feldstein at Harvard was great on this. It gets pointy, and then it fixes itself fast. Did you anticipate that some of these excessive moments here in September will, quote unquote, fix themselves fast?
Well, I do, and I think you make a great point about the bear steepener. They're bear steepeners until they're not. Yeah. And the two bear steepeners we've seen historically are second half 1969 into the 1970 recession, and then second half 73 into the 74 recession. The first half of those steepeners were bear steepeners. And then what happened in the second half is what always happens. Bond yield ultimately fell. So I think we'll get there at some point. What's unique about those recessions is bond yields didn't fall until you were well into the recession about halfway through. And that's such a departure from what we're all used to the last 40 years, where bond yields would fall in anticipation of a slowdown. That was not the case in the 60s and 70s, and it's kind of the framework that I want to take here.
Yeah. Is it time for a nerd banner?
Yeah.
I should have a nerd banner on TV. We can do this on radio as well. The pointiness of stochastic moves. This is anathema.
That works so well on radio.
It does.
It works everywhere.
For me and Chris Ferrone, this is the heart of the matter. You can't catch a falling knife. You can't play a stochastic move. You got to find the trend and stay with it until it's not there. Did I do okay there?
I think pretty good.
Okay, thank you.
That was perfect, TK. Chris, thank
Canadian
you, sir.
dollars,
Thank you.
a perfect example.
Chris Ferrone, a strategist. TK, to your point, we caught up with Ian Lingen of BMO a number of weeks ago, and we said, was the bond market, the 10-year, a screaming buy? And he replied, he thinks it's a screaming buy. This is Ian Lingen's current stance on things. We remain reluctant to stand in front of any further weakness in treasuries, Tom, given the breach of 450 on 10s. That's where even the bulls are at in the bond market now.
I would say in radio and television, stay with us through the morning. This is extraordinary, some of these summed moves we're seeing.
Looking forward to it. Hey, Chris, fantastic to catch up, as always. Coming up, Ed Mills of Raymond James with the threat of a government shutdown looming. Your equity market trying to bounce here, up by 0.3% on the S&P 500. Coming off 3-month lows at the close yesterday. In the bond market, yields retreat, down 3. Your 10-year, 4.49. From New York, good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
We'll be bringing up 4 of the appropriation bills we've been trying to do since July. Finally, we got the members together to be able to make that happen. If we're able to finish those 4 along with the ones we already, that would make it 73% of all the discretionary funds that we're supposed to appropriate for this time. We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Our Speaker, Kevin McCarthy, as we inch closer and closer towards the potential, the reality of a government shutdown. Live from New York City this morning. Good morning to you all. Trying to bounce after a decent day of losses on the S&P 500. This morning, positive by 0.28%. You both caught up with Mike Wilson at Morgan Stanley. I imagine Mike Wilson's feeling better about 3,900 year end on the S&P. Bramo, did you get that impression?
I got the impression that he felt a lot more conviction taking a look at consumer stocks and saying, look, this is exactly what we thought would happen, and it's showing real weakness at a time where people are feeling the bite. He said it's only a matter of time. We're clearly at end of cycle.
So end of cycle, late cycle stuff. Did he say anything about playing the recovery?
It was too soon to get there for him, but he did talk about how then you can go more whole hog into some of these areas that are most beaten up. And yes, he was like, we're late cycle, getting close to that end, but it could take another year. And that's the difficulty. He said you just can't game that out.
The major message from Mike Wilson, and I think so many people watching and listening disagree, is you got to be in the market. He's not in love with being in cash. He wants to participate even within his caution, somewhat like what we get.
So energy, industrials, late cycle things for him?
The usual Wilson victims.
Okay.
I mean, I get that, but the panic right now in the modern financial media is go to cash. And, right now, this Wednesday morning, is a massive go to cash.
That's your
morning.
Tagline.
It is.
Triple leveraged.
Well,
all cash.
But it's not. I get really upset. I was at the Savoy, John, in London, and somebody comes up and goes, "You must be killing it." I go, "The carry on the leverage is killing me." I mean, you don't get the gross
Only
yield.
you would get real
I don't
upset.
think people understand.
In the
3
Savoy.
times 5 is not 15% rounded up. You got to mark that puppy down.
Okay. Should we finish on foreign exchange just briefly, TK? This move in the
Ed
dollar.
Mills is looking at me like I'm nuts.
Dollar strength. Ed Mills and Raymond James coming up shortly on the potential for a government shutdown and a whole lot more. Just want to touch base with the euro, 105.59. That currency pair negative 0.1%. To touch base with the yen, 4 days of yen weakness. And Tom, on dollar yen, we're pushing 150, 149.21. This dollar a whole lot stronger.
We'll do a lot more data checks on that as well. And again, yen 149.20 is there. That's all that has to be said. And it'll be interesting to see how Japan reacts to what we see. As I said earlier, I'm mostly focused on the tangible market. Part of that tangible market is our politics of this nation. Thrilled to have on set this morning Ed Mills. He's Washington policy analyst at Raymond James. Did a lot of work with Carolyn Maloney, among others, and out of Boston College, where you learn politics quickly. Ed Mills, have you seen this before? To me, a president on a picket line, it's original, but is this an original talk about shutdown?
It's not an original talk on shutdown. At Raymond James, we have enough data to go back to 1995 and say, like, what happens in each of these shutdowns? And what we found was actually somewhat counterintuitive, that on average, the market is up about 3.2% during government shutdowns. So that tells me that the shutdown in and of itself should not be a driver for this market. We have a lot of other kind of headwinds that we have to focus on. Kind of the debt service burden for this country, longer term fiscal trends, but government shutdown, I don't have a huge concern about market implications for
You
that.
and I know the photo when you were at Boston College of Tip O'Neill sitting with Howard Baker, and somehow they got things done. That's not happening right now. How do you get to compromise in a fractured Washington?
Very different world. I have been focused more on the Senate than on the House, and I think almost all of the headlines have been about the House of Representatives, when in reality, the Senate, either sometime in the next day or two, maybe past October 1st, is going to pass a continuing resolution, and it's going to have well north of 75 votes. Once that's done, the pressure is going to build on the House to at least have a vote on that. If they have a vote on what passes the Senate, I think there's probably more than 300 votes on that bill. Why that's important is that if you can get 300 votes, you don't have to go through the Rules Committee. Kevin McCarthy does not have to have a fight on the floor where he has to have Democrats supporting even having a conversation of a bill. Just put it on the suspension calendar and get that done.
So just to put a bow on that, are you basically saying that there's a good chance that we're going to avoid a shutdown more than the market's certainly pricing?
So could we have a shutdown for a day or two? It's certainly possible because we're looking at the timing of how the Senate is working on this. But if there is a shutdown, I don't think it's long lasting because the pressure is going to build so much on the House to have a vote on what the Senate passes. So look at what the Senate does, and if it's 75, 80 votes on that continuing resolution, I think that's a really positive sign. And another positive sign could be if the House is not able to do their own CR. That adds to the complication if they can do that later today.
Moving away from the crystal ball of Washington politics, there's a question around the actualities of the moment. We were talking about the dollar being stronger. And this comes at a time after years where a lot of nations were looking to depreciate their currency. Is the stronger dollar actually a benefit right now to the Biden administration?
Lisa, I could argue yes. And when I have been on trips to Europe and European investors, they think that the Federal Reserve and Treasury are in cahoots here, that all of the push for kind of rebuilding the industrial base of the United States through the Inflation Reduction Act, CHIPS and Science Act, bipartisan infrastructure bill. If you have a strong dollar, it is cheaper to manufacture things here in the United States. And to the extent that that's supporting that fiscal policy in the background, I do think that's an underappreciated aspect of what the Fed has been doing.
Do you think that that's valid in any way, shape, or form, or just conspiracy theory from people who kind of have sour grapes about the fact that they feel like they're on the left foot?
Well, I think there's two things, Lisa. One, this is the first time in generations where we have challenged the industrial base of Europe, right, rebuilding it here in the United States. Two, the Treasury Secretary used to be the Fed chair. And so I do think there might be a few kind of conversations and a little bit of work together between the two.
Tell me about the debt and the deficit. Maya McGinnis was on yesterday and was just brilliant about the new of the debt and the deficit. You are a grizzled pro at this. Are you concerned about our debt and our deficit?
I have a growing concern. I mean, one of the things that we look at, if you check the national debt and the debt service burden, the debt service burden is going to eclipse what we spend on discretionary spending, all of defense and non-defense discretionary spending pretty quickly here. So for years, when I first came to Capitol Hill, being concerned about the debt and the deficit were front and center. Last 5-10 years, that really went away. That's returning, and that's going to have a huge impact on our politics, and ultimately on kind of what we're able to spend. When I look at the 2024 election, probably one of the biggest decisions that's going to be made based upon who wins is the tax cuts that expire in 2025. That's another $4 trillion if you want to extend those out. And so if you are kind of having a conversation about the debt and the deficit, what are you going to do with those tax cuts? What is the implication for the economy, especially on the individual side? Because those are the parts that expire.
It's such a good point, but you know how this works. You get into power and all of a sudden you don't care about the deficit like you used to. Do you think that's going to change?
No. I've always said that the kind of members of Congress really care about the debt and the deficit when they're in the minority.
Yeah.
And one of the big concerns is that the way in which you think you should solve it is different. So Republicans like to kind of grow kind of revenues through kind of tax cuts, and Democrats try to feel they want to grow revenues through tax increases.
Unless, of course, the market forces that discipline onto Congress and Washington in a way, Tom, that it hasn't for a long time. That would be the change.
One final, just quick, I'm so sorry for this. It should be a longer question. Do either of these parties feel like they're in the minority? They're both acting like they're in the majority.
I think that when you are in the White House, that's kind of what sets it. So yes, Republicans have a majority in the House, but in reality, with the Senate a Democratic majority, Joe Biden as president, they kind of can push on the president and make him have kind of tough conversations.
Ed, thank you. Smart as always. Ed Mills and Raymond James up here in New York on the latest down in Washington, D.C. Coming up shortly on this big move in the FX market, Steve Englander, head of G10 FX research at Standard Chartered. We'll be catching up with him in just a moment. Lisa, the scene, the President of the United States in the last 24 hours on the picket line.
I wonder what the Fed thinks. Keep asking for it. Come
Ask
on,
for that 40%.
ask for those wage increases when they've already accepted 36%. I mean, really, this is going to really offer a conundrum to the Fed.
It's pretty remarkable to see, isn't it? Live from New York City this morning. Good morning to you all. Equity futures up here by about 1/3 of 1%. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla. But Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From New York, here's the price action. Equities look like this on the S&P, positive by a third of 1%, trying to bounce up a third of 1% also on the NASDAQ. Yesterday at the close, the NASDAQ 100, the lowest since June 9th. On the S&P 500, taking back the summer, the lowest since June 7th. That's the equity picture at the moment. The damage in the bond market, yields unbelievable. New closing high, 455. We're pulling back a little bit, down by about 3-4 basis points on a 10-year. New intraday high, Tom, 456.22 on a 10-year. It's quite a move, TK.
And it's correlated here. Oil didn't participate the last couple of days for other reasons, cushioning that. I got Brent crude 95.17, which gives you that high yield tinge. You see it in the foreign exchange market. Pick a pair, John. Lisa and I didn't think you were going to come back from London. You were looking for real estate in Kensington.
Well, funded in dollars and looking at cable breaking down. Why not?
I mean, 119. I mean, you're a landowner, but you can take the whole yield discussion, folks, and you can go nominal yield analysis, as John just did, or inflation-adjusted analysis, and it's wow. It is a wow Wednesday.
Well, let's get to the wow of the FX market. The euro at 105. This would be week 11. 11 weeks, 11 consecutive weeks, Lisa, of euro weakness and dollar strength. And we're close to it right now at 105.59.
Russ Kosterich of BlackRock yesterday said that the one conviction trade, the best hedge against stock weakness right now, is the dollar. And I thought that was interesting. Bonds aren't working as the offset, as the hedge in the same kind of way, but people are using the dollar in that sphere because strength is outperforming in that region.
The dollar index, Lisa, here at about 106, heavily weighted, of course, to the single currency. Tom, I know you've been following the yen over the last week or so.
Yeah.
To see that get closer and closer to 150, and you've been right to be on top of it, Tom. Big question. Where's the line in the sand for the BOJ? To start making more noise and start doing something?
I think it's a mystery with Englander coming up. We can ask him. But the bottom line is, I don't think there is a line in the sand. They've got to look at it within a set of moving parts, including Australia yen is a Pacific metaphor.
Dollar yen right now, 149.17. Under surveillance this morning, President Biden taking to the picket lines, endorsing the UAW pay demands. Biden telling automakers striking against the big three to, quote, stick with it. You deserve what you earned, and you earned a lot more than what you're getting paid right now. Lisa, remarkable scenes. And to your point, just compare and contrast what's coming out of the Federal Reserve to what you're hearing from the president.
That, I think, is the biggest tension, especially if other people are taking cues from this, saying now is our time to get more of the corporate profits than we got in the past couple of decades. Key question to me is how much are we going to hear an echo of this by the former President Trump, right? Either side is trying to play to the anger that you're feeling in the worker. And it's, regardless of anything else, that is the focus right now.
Look, this is like Kroger's. There's no corporate profits. You can talk about executive pay and all that. They're running an EBITDA line at GM of 10%, maybe 12%. They're bringing it down to the net income level of 6 cents on the dollar. John, that's like selling bananas in the produce section.
Let's build on that because I'm totally with you. There's something very bizarre about taking shots at Wall Street on the picket line with UAW, because I can't think of many people on Wall Street that have made money investing in GM stock over the last decade, with the exception of a 12-month period coming out of the pandemic. That stock, Bramo, has been dead money for the best part of 10 years.
it doesn't cohere with this feeling of roaring strength. What it coheres with is a feeling of being bottomed out in the industrial sector. And the real question is, where is the debate going to hinge? Is it going to be, I'm standing with you, or is it going to be, what should our industrial policy be and what brought us to this place? And I think that's what's underpinning anger politics, which you're hearing right now.
I had the privilege of catching up with Alarian, Spence, Brown on their new book on permachrist, and thanks for the feedback on that. There's an amazing stat in that book, Tom. Have a think about this. 1990, China's share of global manufacturing, 3.5%. 2021, China's share of global manufacturing, 30.5%. Totally hollowing out domestic manufacturing bases in developed countries and sending it away. And this is the backlash. We saw the backlash in the politics of 2016. You're seeing the backlash on your screens in Detroit.
And even if it goes to other nations on the Pacific Rim, there's intermediate supply development where a lot of it's still being done in China. And to be fair here, John, there's a domestic and international China discussion. And people feel actually China, away from the real estate debacle, may be doing better than good. Maybe not 7% GDP, but okay, John, General Motors, the last 10 years, annualized return off the Bloomberg Professional Service, 2.02%.
Yeah, that's not getting it done. No. Wall Street weren't the winners of GM in the last 10 years. The winner's been the leadership, and we've talked about executive pay, and we'll continue to talk about executive pay at places like GM. A couple more stories to get through. U.S. government shutdown nearing its Saturday deadline despite incremental progress. The Senate introducing their own bill that would extend funding to November 17th, but no clear path for the bill to overcome a deadlock in the House, which is set to vote on its own measures. In about 60 minutes from now, we'll catch up with AMH down in Washington, so look out for that conversation. And I wanted to finish with this one, Lisa. Evergrande troubles deepening. The chairman being placed under police control. This according to people familiar with the matter. The billionaire said to have taken away by Chinese police earlier this month, and it's being monitored at a designated location, adding to questions, Lisa, about the company's fate and, of course, the chairman's fate for that matter as well.
Especially since he was one of the most highly ranking Communist Party members and actually was incredibly politically influential, one of the richest Asian influencers out there. He's worth now about less than $2 billion. At one point in 2017, $42 billion was his net worth. He has fallen off. I wonder what this means. He's being detained, sort of, but he's not going to necessarily be arrested or charged. I don't understand. 6-month time frame seems to be the official limit, but what is going on?
With the foreign minister, the defense minister, I'm not going to comment on that. What I am going to say is, how's it going to be expressed? The easy answer is simple. Weak renminbi, weak yuan. Is it unimaginable as 2.22% 10-year U.S. real yield? John, is it unimaginable to see weak yuan back to where it was in October of 2005?
That's the latest this morning, TK. That story, I can tell you, getting a ton of buzz. One of the most read stories on the Bloomberg terminal so far today.
This is a privilege. We love the guests we have, and particularly when they're so good at foreign exchange cross rates, like G10 FX strategist, global head of G10 FX research at Standard Chartered, Stephen Englander, joins us for Global Wall Street this morning. Let me start there, John. Stephen, rather, John and Lisa have a lot to talk about. Is it unimaginable that we will see a devaluation of yuan renminbi out back to where it was long ago, fixed at a 750 level?
I've come to learn that our imaginations are pretty limited. It's certainly not the most likely scenario out there. I mean, the key problem that China has is domestic. It's not its trade balance. With the world growing so slowly, the odds that it can export its way out, especially given concerns in the U.S., concerns in Europe, concerns in elsewhere about the China trade surplus. They're going to have to solve their problems domestically. The exchange rate can help a bit, but it's not going to help a lot.
What do institutions do when you have not a Plaza Accord dollar strength, but what we've got right now? What would you expect the Fed to do, Treasury to do, and other central banks?
Well, look, I think the U.S. is focused domestically unless there's something that really breaks internationally, and so far that hasn't happened. I think there's a mythology about the Plaza Accord. I mean, the reason you get into a plaza is because you have common interests. As long as the interests are not common, it's the only rule is every man for himself. So each country is pursuing its own policy to its own advantage, and what we're seeing in markets is how that plays out.
Steve, what do you make of Ed Mills' comment that there is some sort of tacit, I don't want to say working together, but acknowledgement that a strong dollar by the Fed, by the Treasury, is a positive for the industrial policy of the U.S.?
Look, there could be something to it. I think that it's probably helping a bit on the inflation side, combined with the deflation that we're actually seeing in China and in Chinese imports. I don't, given all the geopolitics driving trade flows, I don't think that exports and imports are as sensitive to exchange rates as they used to be. So it could be that we're kind of getting some of the benefits. We can get a cheap hotel room in Paris, maybe not Paris, but elsewhere. But I don't think it's kind of the biggest deal out there. In fact, I'd say probably if you're at the Fed, you're kind of saying maybe we get some modest benefit from this, but we have to spend a lot of time making sure that the rest of the world, and particularly parts of the world that have dollar debt, that the strong dollar really doesn't lead to some kind of financial market accident. So, I'm on the fence on that one.
How close are we to that, Steve? Some sort of financial market accident?
Look, it's not imminently visible, but what we're seeing are things like the KRE index losing, the regional bank index kind of going down pretty much, 2 days out of 3. So there is some concern there. There's pockets of concern elsewhere that certainly isn't helping. The world isn't growing nearly as fast as we expected, and less so than the strong dollar. The high U.S. rates are not helping that growth picture, but there's nothing that's around the corner.
We've been talking, Steve, about a stochastic move where things weaken, like Loonie weakens out to 138, 140, 142. And if you look at a chart, the fact is it always reverses abruptly to stronger Loonie at some point. Is that what's going to happen this time? We're going to have whatever the events are, and then quickly they will turn around?
There is something to that. I mean, obviously rate differentials have to help, but I think if you're in Canada, going down to Florida, you can't afford to buy a beer because, Canadian dollar is so weak, or if you're in Japan and you can't travel because your currency is so weak, it becomes a political issue. And there's nobody arguing that in Japan that we're doing great because we're so competitive, or in Canada that we're doing great because dollar CAD's 130, 135 and a half. So I think something usually happens. What kills people in the market is getting the timing wrong. If you can get the timing right, you do very well. But the risk is being premature on those moves. But we think it's kind of toppish. I mean, we don't see the Fed raising rates. We don't see them cutting rates anytime soon. So I think there's a lot getting built in that's momentum right now.
How much is this a dollar story, and how much is this an everything else being weak story?
Everything else being weak, 70%. The dollar strength story, 70%. I know it's a Yogi Berra kind of calculation.
He's on 2 days.
It was a Bramo classic, Steve. That was a tough one to answer. Steve, I was curious from your standpoint, just to wrap things up, this combined weakness in the euro and strength in crude, to borrow some of Lisa's wording, just how toxic that is for the ECB at the moment. What do they do with that as the backdrop?
Some of the chickens are coming home to roost, some structural chickens. I mean, their energy policy hasn't really been successful. Their innovation policy hasn't been successful. China's on the fast track on electric vehicles. The sources of growth there, I mean, I think Europe is a funding currency. Actually, Swiss is a funding currency, becoming much more attractive over time.
Steve, thanks for the update.
Going to get paid for what they do.
I think you're done now. Steve Englander, a Standard Chartered. Steve, sorry. Going to catch up as always. Let's just finish on that point, Lisa. It's so important. Where this leaves the ECB, the European growth model, to see the euro breaking down to 105, to see crude in the 90s. What do you do with that?
There is no clear answer. And you can hear that from some of their discussions where they want to get inflation down. Stagflation is not going to be their base case that they're going to be happy with. At the same time, they're between a rock and a hard place. There's no good answer. If I knew the answer to that, I'd be in a very different position.
Oh, big time. You'd be in Lagarde's seat.
Exactly.
Maybe, although I'm not sure what Lagarde would say this morning either. What does President Lagarde, Tom? You've spoken to her recently in the last month. Where does she see things
This
now?
is really important. This came up yesterday, John. You nailed it. Her speech that she gave in Jackson Hole is not implementable given these markets. You go right back to massive short-term data dependency, which she and Philip Lane are pushing against. You can't have a 60,000-foot plan when you got stochastic moves out there.
Lisa, I'm sure you saw some of the credit data coming out of the ECB, coming out of the Eurozone. It's not great, is it?
It's devastating.
Pretty
it's
bad.
Worse than what we've seen even during the Euro crisis. So what do they do with that? I mean, is this lag effect? Is this being worked through and we just still have higher prices simply because crude and natural gas are going up?
I feel bad for Steve now for cutting him off. I thought he was done.
So, you know,
Didn't
it's
sort of
okay.
sound like
Steve,
he was
you were great.
done. Steve was great.
You're
Steve's
70%
always great.
done, 70% not done.
Yeah, you know, I think I did him a favour anyway, sort of getting him out of answering that. Equities on the S&P, positive here by 0.3%. Live from New York City. Good morning.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Without accountability, the independence of the Fed is going to be challenged going forward. So the Fed has huge interest in embracing the few things we propose in order to restore trust in an institution that's absolutely critical and that must have political autonomy.
Always fantastic to catch up with Mohammed Al-Aaron of Bloomberg Opinion, the columnist speaking alongside the former Prime Minister Gordon Brown and Nobel laureate Michael Spence on their new book, Permacrisis, A Plan to Fix a Fractured World. Catch the full conversation on Bloomberg.com and on YouTube as well. Let's turn to the price action. If you are just joining us, equities trying to bounce here by 0.3% after closing at 3-month lows. All that happy talk, that soft landing hope and dream through the summer. We take it all back. The equity market back down to levels we haven't seen, TK, since early June on both the S&P 500 and on the NASDAQ too.
Yeah, there's a lot to look at here today, and you can look at it across currency pairs. As I've said time and time again, John, FX is the deepest system out there. Some things are on. Every day it varies. Like sterling's really not part of the story today. Maybe sterling will, hit a 120, 119 tomorrow. Who knows?
But the euro is, the Japanese yen is, DXY at 106, euro dollar 105, dollar yen Tom very, very close to pushing 150. And you've been asking a question as the right one. At what point, Tom, does the stress get too much for the BOJ? Where's the line in the sand for them?
Well, Steve Englander off the camera, folks, wasn't going to give us a level here. I don't think there is a level to know, but what he said is so important. This is institutional and political as well. 106 DXY. I mean, is Chairman Powell waking up this morning looking at his Bloomberg, watching surveillance going, OMG, we got to act? But can you imagine a 108? I've never framed 110 DXY, and that's my mistake.
To Bramo's point, though, does that do some of the work for this Federal Reserve? Higher real yields, stronger dollar. Isn't this part of the objective? To put the brakes on the economy And Tom, ultimately, to help bring down price pressure, does the dollar contribute to that effort?
The dollar contributes to everything, but I look at it as an identification of the system, and particularly around yields. This is a joy, and particularly for our American audience, listen carefully. It is rare that you can say a person, a CEO, turned around an airplane. If you're out at JFK or anywhere across America, there is Iberia. It is of Spain. And Luis Gallego, I hope I'm pronouncing that correctly, probably butchering it, but he did it. He did what we wish they would do in America, turn around an airline. In conversation with our Guy Johnson, IAG CEO, British Airways is his fault. Guy, please help us here at your aviation festival with a gentleman of Iberia.
We're here in Lisbon, Tom. Luis Gallego is the CEO of IAG. IAG, the holding group for, as you say, Iberia, British Airways, Aer Lingus, the list goes on and on. It's one of the big three holding groups in Europe that owns the vast majority of Europe's airlines. You guys were just talking about what's happening with the dollar. The other thing that's kind of floating around this industry at the moment is what is happening with fuel. Fuel prices absolutely rocketing higher. You've got Brent obviously surging, but the crack spread on top of that to make jet fuel also super wide at the moment, which means jet fuel is very expensive. Luis, great to see you. Thanks for stopping by to see us. Does higher oil, does higher jet fuel mean higher fares?
Fuel for us is 25% around of total cost, but in IAG we have a hedging policy. So for this year we have above 70% of the fuel cover, and next year is around 40% now. Yep. So at the end, the fares are related to the supply and the demand and the competition that we have in our different markets.
Okay, competition is really important. The American carriers don't hedge. Yes. So you're hedged. Your American carriers, the competitors on the North Atlantic, are not hedged. Do you have an advantage right now because of the higher fuel price on the North Atlantic versus those American competitors?
In North Atlantic, we have a joint business with American Airlines, with Finnair, British Airways, and Iberia. And at the end, we have a profit pool of revenues that we share between the different airlines. So we have metal neutrality. The customer, they can fly in the airline that they choose. So at the end, all the benefits we share.
But nevertheless, versus the other groups outside of your group, do you think you have, if they're not hedged, are you making more money right now on the North Atlantic?
I think in general in the States they don't hedge. In Europe we hedge, so at the end we are balanced.
Okay, it balances itself out. How is demand on that you're seeing at the moment? I'm hearing the banks aren't spending big at the moment. I'm hearing the big tech is not spending big. What's happening with demand? What's in particular happening with business demand?
So demand is very, very strong, particularly leisure demand. Premium leisure traffic is amazing. The corporate traffic is the one that is lagging behind. We are still, for example, in levels in BA in the second quarter of around 60% in volume, 70% in revenues of what we had in 2019. In the case of Iberia, is better. It was around 80% in volume, 90% in revenue. The main reason is they operate in different markets, but also I think in Spain, the people after COVID, they came back to the office before what is happening in UK.
You and I have just been on a panel with Luis Rodriguez. He's the guy that runs TAP. There's going to be a cabinet meeting tomorrow that's going to determine kind of what happens next in the privatization of the Portuguese flag carrier. Have you had a little conversation with him? You've expressed interest in maybe bringing TAP into the IAG group. Do you think why is that the right call? Why are you the right potential owner for TAP?
First of all, we want to see what are going to be the conditions of the privatization. But we are a group that was created in order to consolidate the sector. And we have excellent brands, excellent airlines below us. So TAP, I think, is an operation that could be interesting for us. And I think the model that we have is the right one for a company of the size of TAP. They can have the advantage to belong to a group like us, but to have the freedom to preserve the brand, to preserve the customer, to be accountable of the P&L. So I think what we have shown in the past is that all the airlines joining the group, they have developed much more than when they were alone.
Do you think you can own Iberia, Air Europa, and TAP?
Yes, we are sure, because I think Iberia and Air Europa, we are in the middle of the process with the competition authorities. This is an operation of consolidation in the hub of Madrid. But TAP, when you look at the markets TAP is operating, mainly is Brazil, that we don't have a lot of presence there, and also the former colonies of Portugal. So I think the networks are very complementary, and that's the reason we can operate, for example, with a dual hub strategy in the same way we have Dublin and London in the north.
Can I just talk to you about what the future of this industry looks like? Is flying going to become too expensive because of the journey that aviation has to go on to get itself to carbon neutrality? We talk about SAF, sustainable aviation fuel. It is going to be, jet fuel's expensive. Sustainable aviation fuel is going to be epically expensive. Do you think people are going to be able to afford to fly when we make this journey, when your aircraft are powered by sustainable aviation fuel? Is it going to be too expensive for all but the very elite?
I think it's going to be more expensive. The question mark is if it's going to have an impact in the demand. We think that we can decarbonize aviation, but maintaining fares that can be affordable for the consumers. And we have a lot of people that they say we are ready to pay a little more in order to fly in a sustainable way. So I think that's the challenge, but we don't have any other alternative. We need to decarbonize aviation.
The British government is already starting to back off some of its sustainability targets. Do you think you could see aviation maybe being set looser targets? Do you see that coming? Do you think it's a mistake that the British government is backing off its targets?
I think we need to maintain the ambition, because otherwise we are not going to achieve the commitments of to have net zero emissions by 2050. The main issue is that we don't have SAF enough to comply with the mandates that they are putting in place. So it doesn't matter if we put a mandate if you cannot buy SAF or eSAF. So what we need is production of SAF. It doesn't make sense that International Airlines Group, we are buying SAF from US to put in our aircraft in Europe. It doesn't make sense, and we need to fix that.
Louis, always great to see you. Thank you very much, Steve, for stopping by to see us.
Thank you very much.
CEO of IAG. There you go, John. Flying's going to get more expensive.
Guy Johnson, not the kind of news we want on a Wednesday morning, but that's the news we get. Guy Johnson out of Europe this morning. The latest on UBS, the stock is lower. Credit Suisse might have some legal issues that ultimately UBS might have to own. That conversation is coming up. UBS is lower by 4%. Live from New York City, this is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
What's happened in the last 2 months is we are seeing a breakdown again in a lot of the stock market.
There's some recognition by the Fed that if you tighten financial conditions much more, you're going to do real damage to the economy.
The Fed might hold here for a while, but it's very difficult to see why they'd want to go a lot higher from here.
Fed's retaining its optionality. It's not saying we're definitively moving higher, and it's certainly not saying 7%.
It's just hard to see what the positive catalyst is for markets today.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Pouring freezing cold water over this summer's Happy Talk. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is trying to bounce up by 1/3 of 1% on the S&P. Yesterday at the close, the lowest since June on the S&P, on the NASDAQ. This morning, Tom, in the FX market, the euro 105, dollar yen pushing 150.
Those are the major pairs, but you can look at all the granularity of the foreign exchange market and see the trauma that's out there. It's not a soft landing, it's an abruptness here. And the adverb I'm using, John, is suddenly. There's all sorts of suddenly. Kawa, you weren't here. Luke Kawa of UBS.
What did Luke say?
Luke nailed it. He went all Newtonian on us on Monday. He's talking first derivative, second derivative. And the second derivative, the accelerative force, is in place on this Wednesday.
At some point, Lisa, this Treasury market sell-off becomes self-limiting because of the pain it inflicts elsewhere. Are we nearly there yet?
Well, Chris Verone said we might have to get to 520 on the 10-year before we get to that point. So we still have another 70 basis points to go. In other words, we might not be that close simply because the bulls have been burned so badly they're not stepping in. And we see that again and again. What I find interesting is where the bias in markets is right now. And I think you rightly started with, are we seeing a dash of cold water on the Goldilocks theory? Yesterday, the market moved on a Conference Board consumer confidence survey that came out disappointing. This just shows maybe people are getting a little bit nervous about their positioning around a soft landing and their confidence and strength.
The 2 data points yesterday that jumped down, consumer confidence lower, house prices higher. Doesn't that speak to the moment we're in, Lisa?
People are getting nervous by how expensive things are getting, and yet they keep buying. And this is the problem that people are really grappling with. Some of these anecdotal feeling surveys don't reflect what people are actually doing, which is not buying treasuries, but buying homes and buying everything else, buying plane tickets, etc.
Chris Verone, a little bit earlier this morning, said things can change when things break, and ultimately something may well break. Something did break earlier this year. The banking system in the United States of America, and Switzerland had some difficulties as well. I want to talk about this story. News in the last 60 minutes. Check out the stock of UBS. UBS is down by a little more than 4%. Here's the story from our team here at Bloomberg, Tom. I'll share it with you verbatim. The US Department of Justice has stepped up its probe into Credit Suisse and UBS over suspected compliance failures that allowed Russian clients to evade sanctions. This according to people familiar with the situation?
Well, it's the usual chit-chat on sanctions, and you say, well, it doesn't matter, but it matters here for a bank, as Armati said to Bloomberg in Asia a few days ago, under massive restructuring. All the domestic political headaches of Switzerland, dealing with the Swiss people and the government and the cantons and that. But the overlay now is this market that we're describing. As Chris Verone said, REITs hammered. Our banks next.
Consumer discretionary really struggling as well over the last few weeks.
And that's a GDP question.
Big time. Your equity market looks like this on the S&P. Small bounce, up by 0.3% on the S&P 500. We'll get into the equity market and bring you some more on that UBS Credit Suisse story a little bit later in the next hour or so. In the bond market, yields are lower by 2 or 3 basis points. The 10-year back to 450.72. Talked about the FX market already. Has breathed some life into the energy conversation. Lisa, 91.76 on WTI, up by 1.5%.
A terrible mix, as you've been pointing out, for the ECB, but also it raises some questions for the U.S., for this really impedes consumer confidence. I'm watching this. 12 noon, we get Bank of America CEO Brian Moynihan speaking at the Economic Club of New York. This comes after we heard Jamie Dimon talking up, gaming out what the world would look like at 7% rates. There seems to be a bias to rates going higher in all conversations, not crashing down to pre-pandemic lows. After market, we get Micron earnings, which I think will be interesting, especially given Costco coming out with disappointing earnings yesterday. Micron, key for a lot of the tech trade, which has completely supported the entire equity market this year. And at 9 p.m., the thing that nobody is talking about and no one seems to care about is the second debate of the Republican presidential candidates. It'll be aired on Fox News, happening in California. It is interesting, and you mentioned this, John. No one's talking about this, and you're right. Zero buzz. Asa Hutchinson got kicked out. No one cared. 7 people are showing up, not the former president, because he's going to be down in Detroit trying to speak to the anger among some of the picketers with respect to the auto manufacturers. I'm sure that he's going to try to counter what Biden did yesterday. That's where all the focus and cameras are going to be, not in Simi Valley in California.
Absolutely. Tom, how does that group of individuals on that stage later on get any traction whatsoever?
You got off the plane, you called me in from Middletown, and you said, Tom, what's going on? And I said, you said there's no buzz in this debate. And to me, that's the heart of the matter. I don't sense a buzz out there. I think people have moved on from the drama of the former president not showing up.
Yeah.
It's that simple.
Big time. AMH coming up a little bit later this hour. About 20 minutes from now, we'll catch up with her about the latest situation in Washington and, for that matter, in Michigan as well. With us around the table, Avery Sheffield, co-founder and CIO at Vantage Rock at Rockefeller Asset Management. Avery, good morning to you.
Good morning.
Is it time to buy this stock market yet?
I would be cautious. I certainly would be. I think that, to the points that you've been addressing, look, we are in a period of real uncertainty. We have the 10-year yield continuing to move up. We have pressure in the oil market. We have, as Lisa, as you were saying, people still going out and really buying houses, buying cars, but actually pulling back on some areas in consumer discretionary spending, which suggests they're tightening their wallets because the things that really matter to them, housing, food, energy, transportation, they need money for that. And that creates a dynamic where the Fed is likely, I think, to potentially stay higher for longer until something breaks. Because if something doesn't break, there is a risk that inflation could reaccelerate.
This is a great polarity here. You've got a huge advantage of dealing with Ruchir Sharma every morning at Rockefeller Capital. He's just fabulous on the greater global view. And on the other side, you came out of Wharton and your first job was the glory job of Wall Street, writing the black books at Sanford Bernstein. You do security analysis granular. How do you combine Ruchir Sharma's worldview with the discipline you learned at Sanford Bernstein? How in God's name do you do that?
Right. Well, it's a lot of fun every day, and working with people like.
You're having fun in this market.
Yes,
okay, there's your banner, Sheffield having fun while the rest of us are going down in flames. How much fun is it?
Well, it's very dynamic and always interesting, right? So you always have to put on your macro hat every morning. Your Ruchir Sharma hat, and then have the discipline of security analysis, to your point. But deciding, what the inputs are into those models for anything that has any cyclicality, which is a lot of the market. We're not just a healthcare fund or a utilities fund. It's very important to understand what you think about interest rates, what you think about oil, and as inputs to decide how to value a company.
What's the Haven trade right now?
The Haven trade. So I think that inexpensive defensives are probably the safest place to be.
Which is what?
So, I mean, we do like insurance. Insurance companies that have conservatively managed their balance sheets have the benefit of
financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Picket lines when I was a senator since 1973, but I tell you what, first time I've ever done it. Pressure. Okay? Oh, look. Watch me as well slip onto the third three. Fact of the matter is that you guys, UAW, you saved the automobile industry back in 2008, 54. Made a lot of sacrifices. Gave up a lot. And the companies were in trouble. But now they're doing incredibly well. And guess what? You should be doing incredibly well, too.
What a scene, what a moment in the last 24 hours. The President of the United States, Joe Biden, on the UAW picket line in Wayne, Michigan. Live from New York City this morning. Good morning. Your equity market just about positive by 0.4% on the S&P 500. The headlines in the last week, all in the bond market. Yields at cycle highs over the last few days. Your 10-year 450.31. Yields coming in about 3 basis points. I can tell you, Bob Michael at JP Morgan Asset Management with us around the table in New York in 13 minutes' time. Just want to check in on UBS. We'll have more on this story for you a little bit later on this morning. That stock in Swiss trading is lower, hit hard, down by around about 4% off the back of our story here at Bloomberg that reads as follows. The US Department of Justice has stepped up its probe into Credit Suisse Group and UBS as well over suspected compliance failures that allowed Russian clients to evade sanctions. This according to people familiar with the situation. Our story, Lisa, this morning goes on to read that what began as a series of subpoenas sent to a range of banks early this year has developed into a full-scale investigation focusing on Credit Suisse.
What I find interesting, two things. First, you mentioned this morning, that UBS voluntarily gave up the government backstop against any potential liabilities from Credit Suisse, which raises a question of what kind of liabilities they're going to have. But the second thing is UBS wants to expand in the U.S. The U.S. is one of the opportunity markets for this bank. What does this do to that if they're going to be painted with the Credit Suisse brush and a negative one at that? It's sort of a growth prospect in addition to potential liabilities.
It's another headache. It's just another overlay here on their global struggle. And, you know, as Armati told Bloomberg, in Asia, they got a battle with Asian wealth management. How many headaches do they have? 5, 6. Add another to it. It's that simple.
And many, which is why the price was what the price was.
And
right?
we're advantaged at 5 a.m. here worldwide out of New York. 5 a.m. The Irish import with us. Manus Cranny's encyclopedic on this.
That is true.
You know,
he's cranny nearby.
Unlike me faking it, he actually knows what he's talking about.
I think that applies.
I can't understand his accent, but that's a separate issue.
TK, that's rude.
It's not rude.
That is rude.
It's Irish. You know, Manus
that is.
He can't understand me as well.
That is rude.
That advantage.
I can understand him. He sounds fantastic.
I feel Manus Cranny's pain right now because I've lived with this for years. Tom will say I can only understand every other word coming out of John's mouth, which is also
no, it's
rude.
about every 3 out of 4, maybe 4
every 3 out of 4.
Yeah,
is that where things have improved?
Yeah, things have improved.
Good.
You're
Good.
You're very
Thanks, TK. Thank you very much.
In Washington, Anne-Marie Horton, our Bloomberg picket line correspondent, joins us right now. Anne-Marie, those are historic images. There's no question about it. Sum it up. What did the Beltway think of the president's appearance on the picket line?
Well, it was unprecedented. As you say, we haven't seen images like this. He was carrying a megaphone, talking to auto workers, telling them that they should keep at it, keep asking for it. Even when a reporter said, should they be asking for a 40% pay rise? The president says this is what they deserve, and they took sacrifices and kept these companies running during the depths of the financial crisis. But to that point, the president is also walking a fine line on that picket line, because remember, A big issue the UAW has with this administration is the billions of dollars of federal money that is being sent out to help electrify the grid. And we talked to Jared Bernstein yesterday, and I asked him, isn't this the crux of the issue? Isn't this very difficult for the president, given the fact that they are very annoyed, it is very obvious, about this money that's going to EVs? And he said it's not a foregone conclusion yet that those EVs will not be produced and made by non-union workers. But the fact of the matter is you're going to need less individuals to make an EV, and a lot of the money we've seen going towards these EV plants are in the South, and this is just not the culture for union workers.
Anne-Marie, balance of power question. Does President Trump need a megaphone?
Well, President Trump, I think, is going to have a very different look. He'll be doing more so of his typical rallies. I doubt Sean Fain, well, I know Sean Fain will not be standing next to him, whether or not Sean Fain maybe goes up and actually protests the former president being there. Remember, Sean Fain has come out and said it is individuals like former President Donald Trump that we are actually standing for, that billionaire class. So he will have, I think, a classic mic and podium. He will not have a megaphone.
Breaking news. There's a GOP debate a little bit later. Anne-Marie, nobody's talking about it. Lisa mentioned that about 15 minutes ago. Yeah. How are those guys, that group of individuals, going to get any traction whatsoever?
Well, they're going to have to try to figure out a way that they can break out. Trump will be doing his own counter-programming in Detroit, in Michigan, in a huge swing state that he was able to flip in 2016, but he obviously lost in 2020. This is a moment where a lot of focus will be on DeSantis, who I think he had about the middle of the road in terms of timing he was able to grasp on the last Republican debate, and a lot of people are going to come after him. Donors have been still waiting on the sidelines to see whether or not he can break out. Tim Scott is going to try to break out. Recently, you have seen some of these Republican candidates start to attack the frontrunner, former President Donald Trump. For Tim Scott, it has been about abortion and saying that the former president looks to turn his back on the pro-life movement. Then you have Nikki Haley, the UN ambassador, former governor, another South Carolina individual. She has attacked Trump at that first debate. She'll likely do it again because they're going to be asked about the shutdown, about fiscal health and fiscal priorities of what her administration would look like, and she attacked the Trump administration for adding $8 trillion to the debt. They're going to try these moments to break out, but it's going to be very difficult given what we see in the news right now with the looming shutdown in Washington and then with the former president taking center stage in Michigan.
Based on some of the polls I've seen, Anne-Marie, I'm sure you've seen the same ones, Nikki Haley does quite well on the head-to-head at the national level against President Biden. What is she achieving at the national level that she's not achieving when it comes to the primaries?
The issue for the primary with all of these candidates, and I think one thing is important, actually, Paul Ryan, the former Speaker of the House, was at a fireside chat yesterday at a university and actually said you have to look at state-by-state polls. And some state-by-state polls, you can see these individuals doing very well, less so than you see them doing, less so than you see those numbers reflected on the national polls. But the issue they all have is that the former president holds 30% of this party and this base, and we've yet to see anyone coalesce around that number 2 that could potentially take the remainder of that 70%, 60% of the party to get them through. And that's the issue they have right now. Even if they do show that they would poll very well in a general election, they still have a Trump problem in the primary.
Is the debate between Governor Newsom and Governor DeSantis going to get that much more attention than the Republican primary debate? What was the genesis of this? I mean, how is this going to go over? How do we understand what this is?
Which one? The governor to governor debate? I believe that was Newsom's idea. He sat down for a very long, extended interview with Sean Hannity over the summer. And I believe he said he'd be willing to debate Governor DeSantis, take him head-to-head about what's a better state, California or Florida. And then Sean Hannity, to his credit, was able to get it done, and that will be happening at the end of November. I think it'll be a fascinating debate because potentially these two individuals, whether or not it's this cycle or future cycle, could be head-to-head for the presidential.
I wonder, Anne-Marie, how impressed the administration is with the potential for this debate.
Sure that they're going to weigh in on this just yet, but they do talk about how, Gavin Newsom is going to be there this evening in Simi Valley at the Reagan Library. He's going to be the spin doctor for the Democrats. So they do use him as an individual that can be a strong surrogate for this administration. He is asked constantly, And Jonathan, I know you saw that Sean Hannity interview.
Yeah.
He was asked constantly by Sean Hannity, and he said, I am not running. I back President Biden.
AMH, thank you. Anne-Marie, on the latest down in Washington, D.C., I did watch that exchange between Sean Hannity and Governor Newsom, and I can tell you Hannity is a tough interviewer, TK, as you know well. Governor Newsom did a really, really good job in that conversation. Seriously, if you haven't seen it, engage with it. Have a little look at it. He did a fantastic job with Sean Hannity.
Particularly for our international audience, a lot of the credibility here is not celebrity garbage in that. It's actual skill sets. And Mr. Hannity has been like that across the aisle as well.
Governor Newsom was sharper than I expected in that conversation. Far sharper than I expected. Coming up on this bond market, this guy, Bob Michael of JP Morgan Asset Management, weighing in on some major historic moves in the Treasury market with yields at cycle highs, a 10-year at 450. Live from New York City. Equities up. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode.
Getting back to June lows in the equity market, trying to bounce off those lows right now on stocks, on the S&P, on the NASDAQ. We're higher by about 0.4% on the S&P, up by 0.42% on the NASDAQ 100. Thanks for that contribution, Tom. In the bond market, 2-year, 10-year, 30-year, TK, these moves right here. Yields a little bit lower today, but much, much higher over the last few months. Let's call this 450 on a 10-year, 450, 10 right now on 10s. On a 30-year, Tom, your 30-year in the 460s. It was only a few months ago where being in the 440s was worthy of a headline. We're now in the 460s.
Those are the single yields, a nominal yield. Again, I look at the inflation-adjusted yield, the shock of a 2.22%, and how quickly we got there. But John, what's interesting is that vanilla spread, the difference in yield between the 2-year and the 10-year. And the phrase the pros use is disinverting. And most experts will say it's not the depth of the inversion. Think of Priya Misra and all she did a year and a half ago. It's when you turn and disinvert, and that's what's going on right now.
And it's been led by the back end. Best evening.
Yeah.
Yields higher, Lisa. Cycle highs yesterday, your 10-year, 456.22. The close yesterday, 453.56.
Where are the buyers? And that's my question. There have been so many people who are talking about how much they like yields at this level, including our next guest. And I'm wondering at what point you start to see the action, the sort of vigilantes on the other side saying, yes, yield finally, and coming to the market and actually doing some bulk buying.
Well, we're seeing the action in the FX market, that's for sure. Yields up, dollar stronger. Here's two currency pairs for you. The euro against the dollar against the yen. The euro breaking down to 105. Dollar yen breaking out towards 150. That's a stronger dollar story, weaker yen, weaker euro. TK, I keep going back to your question of the moment. At what point does the BOJ start making not just some noise, but start doing something about a much weaker Japanese yen?
Yeah, inside baseball, I don't want to go all Rudy Dornbush on you, but the answer is every sequential intervention you do, the theory is less efficacious. So they've already done one ballet. The next ballet is presumed to be not as effective and takes more ammo to get the same effect.
Do they back away from negative interest rates towards year end? That's where the conversation kind of was a few weeks ago. Sure. The yield curve control, what they're willing to tolerate, all of that good stuff, bad stuff, whatever that might be. Under surveillance this morning, here's your first story. A US government shutdown nearing its Saturday deadline. Despite incremental progress, the Senate introducing their own bill that would extend funding to November 17th, but no clear path for the bill to overcome a deadlock in the House, which is set to vote on its own measures. Lisa, you're in charge of this one.
Oh, great.
Explain this.
It's a mess, and basically the Senate is trying to force some business to get done without the shenanigans of what's going on and without putting a House Republican Speaker Kevin McCarthy on the hot seat and potentially being voted with a lack of confidence vote. What I find interesting is markets profoundly do not care. The answer to this is to keep buying the dollar. The dollar is a place to go, even though it looks like Washington's a mess, as always, yet again. And that, to me, is the story, that basically people are shrugging this off despite some of the jawboning that this time will matter.
Okay, here's another question. Does that story have some similarities with this story? The U.S. Federal Trade Commission taking Amazon to court in a new antitrust case. The e-commerce giant accused of monopolizing marketplace services and illegally forcing sellers to use its services in exchange for better listings. This is the fourth suit the FTC has filed against Amazon just this year. Lisa, the company responding saying the agency is, quote, wrong on the facts, wrong on the law.
And Lena Khan, who heads the FTC, has not been very successful, let's be honest, in some of her plays to get some antitrust actions against some of the tech giants, which has been her cause, frankly, since law school, right? This has been something that she's been really hot on. What I thought was interesting is Amazon's shares were down 4% yesterday. These are the cash cows of the market, and they continue to be the resilient market players simply because they do have so much of the market and they can exert this kind of power.
Surveillance, dumb question. If assuming Trump-Biden, if Trump wins and Lena Khan has shown the door, what happens? I'm asking.
I imagine there'd be questions about whether this would continue or not.
I remember the day where the Justice Department walked away from Microsoft, and then it was like, well, that took long.
How many times have we heard this? What ultimately addressed the Microsoft issue?
I can't do a thing with my boat.
The market did.
I can't remember.
Yeah,
the market did.
But in fairness, I mean, she's not totally doesn't have a point. I mean, if you take a look at this idea,
that she doesn't have a point.
Well, I mean, if you take a look at what's going on, Amazon penalizes merchants that have different prices that are lower on other sites. There are whole sorts of things. What do you do with a company that is the market?
Here's the fact. I have my cell phone. Someone in the house in the West Wing is saying, we're out of this. Watch. Boom. Boom.
And those prices are getting more expensive.
Well, that's the change.
That's the change.
A few years ago, could you make the argument it was hurting the consumer? I'll speak for myself.
Not a chance.
Not from my perspective. I was doing pretty all right, doing okay, going through Amazon. I'm with you. Over the last few years, it feels like maybe you're not getting your better prices from that particular platform.
And merchants are going out of business because they're not making a profit. And that's the other flip side of the story.
Let's finish on this story. Hollywood writers getting back to work this morning after reaching a deal with major studios. Union workers getting a 5% boost in minimum pay, more viewer data from streaming services, and more protections against the use of artificial intelligence. WGA members will vote on the new contract by October 9th. Actors from SAG-AFTRA remain on strike. So making some progress here, Bramo, but not completely.
And not completely, and I thought it was interesting what was on the line. Artificial intelligence, and they're going to get some royalties, even if artificial intelligence fills in the gaps of some of their plot lines.
Is that where all these plot lines are going to come from now? Just AI?
Well, no, they're going to generate something, and then AI will be like, this is what you were going to say.
Right,
Really, and ChatGPT is going to be like, do you really think that's a good idea? Maybe just, tweak this ending. This character seems disingenuous.
The future, Tom.
In 2011, I joined a guy named Mohammed El Arian on the stage at the Fixed Income Analyst Society as he was wandered into the Hall of Fame of fixed income. Folks, on Wall Street, this is like a ginormous deal. Names like Dan Fuss of Loomis Sales, Ed Altman, who was one of my first, the Z-score and all that. A guy named Fabozzi. It was inflicted upon us at gunpoint to read this. Roger Ferguson, he did okay, and every other name. It's a who's who here of fixed income.
There's a new name.
Joining us with a new name is Bob Michael, CIO, JP Morgan. No, forget about the title. Hall of Fame member, congratulations.
Thank you. It was a special night last night. And by the way, Barbara Novick from BlackRock was an honoree. And your own, Steve Berkley, the godfather of the entire fixed income index business, was also an honoree last night. So it was a very special night.
Can I just speak to how modest Bob is, Tom? That he came in this morning, I knew where Bob was last night for this event, and Bob came in and said, I was at a meal last night, and he starts talking about a calculator. I'm sitting there thinking, TK, not just any meal. Not just any meal.
And you pushed him, and he didn't even say it.
There's so much within the bond turmoil right now. We'll just take a few seconds here. You and I were weaned on the same book. Sidney Homer, who's in the Hall of Fame, and Marty, and the yield book. I mean, tell us about what that book did to you and me, how it straightened out our head about discounted cash flows.
So true story. I heard Marty might be there last night, Marty Leibowitz, who co-authored that book. I have my original copy of the book. I kept it at home. I looked at it for weeks, and I decided not to bring it in and have him autograph it because I was afraid he might open it and see I underlined the wrong things in it. but he was there. It was star after star. So for me, very, very special.
Very cool.
It's a key moment right now in the bond market, and I'm so glad that you're here. Because you've been one of the buyers and saying that it is an incredible value in the 10-year, pushing against the grain right now. How much conviction do you still have, despite some of the moves we've seen?
I have increasing conviction. And I will admit, for bond buyers, we've been swimming upstream here for the last couple of months. And I go back and I look post-Silicon Valley Bank, and we all looked at the market and thought from March to June, we're going to have a pretty significant retracement. Let's sit out of that. I think what's been the surprise is from June to this past week, rates have continued to go up. And the narrative has become, it's more of a soft landing. You look at the fiscal impulse that are coming from all the acts, the Inflation Reduction Act, the Chips and Sciences Act, and a couple of the others, the Infrastructure Act. And they're all rippling through the system, but what we're seeing is the underlying data continues to get worse. We look at the consumer that continues to get stretched, and we think that buying duration in here, we're about to start swimming downstream again.
How do you understand the market moves? How do you understand where the bet so far has gone wrong, given the fact that yields have gone up much further than anyone thought was possible in this cycle after so many people called this at peak yields?
Well, I'm not so sure about that, and I've gone back and looked at the previous cycles, and actually we should have been more surprised if we didn't get this back up in yields, and it's happened every single time. You go back, and about the same magnitude, 50, 60 plus basis points. We went back and we looked at the end of the Fed hiking cycle in 2006, yields fell dramatically. And then they went back above the 5.25% high in June 2007, right before these enhanced cash funds started shuttering. So it takes time. And then, by the way, they went back in June 2008, they went up 100 basis points from their low in March 2008. So until these long and variable lags hit, you're in this never land of something that feels like a soft landing. You're not getting more rate hikes, you're not in recession, and the markets will oscillate back and forth, and you'll have this battle between the Fed's done it, they've engineered a soft landing, they'll congratulate themselves on that. They did it this time through their summary of economic projections, and people like me say, look at the underlying data, everything's cracking.
And then bad things happen. You can't throw around 06, 07, 08 without really giving us an idea of the kind of things you're concerned about. Do you see things going badly wrong, or just the ultimate run-of-the-mill recession that we're not used to?
Well, you touched on them earlier. It's not true that these rate hikes don't have consequences. We almost took out the UK pension fund system and the US banking system. When you look at the Bank Term Funding Program, it didn't backstop regional banks. It backstopped the entire banking system. We're looking at a couple of things. We're looking at the consumer facing depleted savings. So the excess savings from the COVID fiscal transfers, those are gone. And now they're facing the higher cost of everything. They're facing higher energy prices, which are going to dip into consumption elsewhere. We look at temporary help services jobs. They've turned down. They've never turned down before, except in advance of recession. And we looked at home price affordability, housing affordability. Kelsey Barrow and I were talking about this morning. It's the worst on record. Now, the date only goes back to 1986, so I don't know before that, but the combination of very high home prices and the cost to finance them, we've never seen it. So when you hear about the current generation talking about how hard it is to buy a home and how inexpensive, they're 100% right. We've never seen this before.
Bob, this is great. We're going to continue this conversation. If you are just joining us, welcome to the program. Your equity market on the S&P 500 positive here by 0.3%. In the bond market, we talk a lot about yields. A 10-year at 450.92. Bob, there's some long-dated stuff at the moment. We've touched on this. A 30-year Treasury issued only a few years ago that's trading something like 50 cents on the dollar. Someone's holding that. We know the Federal Reserve is. Of that particular issue that's been referenced a lot based on our reporting here at Bloomberg, I think about 19% of it is held by the Federal Reserve. You said to us something you didn't anticipate was the actions of the Fed after the banking difficulties of spring were the equivalent of what happened with TARP, that it was that kind of moment. Are we not going to see additional stress in the banking system based on some of these moves, these incremental moves, the additional moves we're seeing in treasuries over the last few weeks?
I think you have to anticipate that the entire banking system hasn't been solved yet. There's been a Band-Aid put over it, but right now you're sitting with a whole host of regional and community banks where their securities portfolio is now further underwater. Sure, they can post it to the Fed and get 100 cents on the dollar, but that's been used to meet deposit outflows. We look at the amount of money accessing the Bank Term Funding Program, it's still around the highs at $108 billion. You also look at their loan portfolios. Those are also quite low now.
Let's continue this conversation. The brilliant Bob Michael of JP Morgan Asset Management on the banking system and on US corporate credit. That conversation continues live from New York City this morning. Equities up by 0.3% on the S&P 500. Good morning.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think in the first within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
These increased costs and these cost pressures underscore the importance of the Federal Reserve's efforts to fight inflation, which can complement efforts to address other factors affecting rent prices, including increasing the supply of rental housing.
That was Michelle Bowman, the Federal Reserve Governor, weighing in on Fed policy in the United States. Live from New York City. Welcome to the program. Your equity market on the S&P 500 positive here by 0.3% on the S&P. A little bit of a lift here. Yields coming in a couple of basis points. 450.72. Does 60-40 work? So this was a big question, wasn't it?
Good question. Yeah.
It's a problem.
Yeah.
Treasury's down, stocks down, Treasury's up, stocks up.
It's not working. It's not working yet again. And there is a question of whether we understand the bond market. And right now, a lot of people have been saying, well, it's technical, it's structural, it's this, it's that. Maybe yields can go even higher, trying to explain something that isn't cohering with the traditional logic of the past 10 years.
In 1996, Fixed Income Hall of Fame, a guy named Fisher Black, he did well, tragically died way too early, and a guy named William H. Gross from 1996. And Black Gross at that Hall of Fame, Lisa, we've had the great moderation. Like on a sailboat, and I'm not a sailor, it's like the wind behind you, or, you know, there was a band called Mountain, and they had a great song called Nantucket Sleigh Ride. It's a Nantucket Sleigh Ride where the wind's really helping you out. That's what we've had in the bond market for 20 years.
And now as we get back, who is going to emerge the victor at a time where you're finally getting yields?
Well, something we mentioned, the unrealized losses, Tom, here in the bond market are just ginormous.
Yeah, ginormous is the right word.
In the US
That's
banking system,
seriously.
absolutely ginormous.
You can't add them up on a calculator. Here's Bob Michaels and my calculator. This is my personal HP 12C with CFA sticker here. And Bob, you used to have this, or Bill Gross had a Monroe Trader at his desk and all that. All that's out the window now. Here's what our audience knows and what you're dealing with at JP Morgan every day. The Vanguard Total Bond Fund is down something like 21% from the Great Moderation peak. It's down 7.5% annualized. That's what our audience is feeling. How do they turn that around? Leave bonds?
I'm all for that we're at an inflection point in the economy and the bond market, that the last 15 years were not normal, that we got to a structural low. That was it. And now we're going to revert to something that's more normal, where maybe that first long-term Fed dot at 4.25% will be the neutral Fed funds rate. I just don't think you get there all at once. I think it takes time. It took 27 years for the Fed to get from 20% to zero. Maybe this time we go from 0 to 5.25. Things slow down. They have to come back to 2.5 to 3. Next time they go to 6%, and then we figure out what that range is. We've gone too far already.
You're in an office with a guy named James Dimon, and these are huge questions with a lot of zeros to the left of the decimal point. Is the Great Moderation over? Bring up the banner again. BND, this is the Vanguard Index, and this is what our audience is feeling. They've been hammered 21% from the peak, 7.5% annualized off the Bloomberg. What do you say to Jamie Dimon about this hope and prayer of getting back to the great moderation?
We all hope that we moderate at a reasonable level of interest rates. And I would hope that not tomorrow, but say 5 to 7 years from now, a 5% 10-year Treasury is normal, not 1.5 to 2% where we were. Right. It's just going to take time to get there.
And this is so important, Lisa. 5 to 7 years is not in the vocabulary of financial media and global Wall Street to a great extent.
Although I did hear I should start paying attention to the possibility of 7%.
Yes, I was just going to say that. What did you think about that? Did you go over to Jamie and say, what are you thinking?
You volunteered this moment.
Yeah, exactly. I was going to go there, but you actually made it easier.
It is a reminder to me that I sit here and I think about, could the Fed go to 5.5%? 5 3/4? They may just do one for decoration. Could they go to 5 3/4, 6%? No. By the time you get to that meeting, and I'm glad to know that the guy sitting on the top of the house is thinking, you idiots.
Okay, good.
What if all this liquidity hasn't been wrung out of the system? It reignites, and we do get up to something like 7%. It happened in the 80s. So he's running the whole show, and I'm grateful that he's thinking about those things, and I get to go back to my little world of, is it 5 3/4 or are we stuck here?
So basically the lead is here. You respectfully disagree with Jamie Dimon. You'll let him worry about 7% interest rates, but that's not your range in any way, shape, or form.
Well, I think he's pretty clear. That's a stress test. I don't think that's his base case scenario.
As we game out how to understand long and variable lags, you did talk about that. And I think that that is one of the questions that we keep hearing about with the likes of Jim Bullard, the former St. Louis Fed president, saying that we've already seen them and that they might be shorter and they might have worked their way through the system much more quickly. How do you push back against that, especially at a time where you do have highly financialized markets that do respond to a Federal Reserve, forecast what it's going to look like, and have already been adapting to this reality for a year, more than a year?
I would have waited until 2 years passed from the period of Fed hikes to see whether those long and variable lags hit, because the Fed's own studies show it's 18 to 24 months. And here we are about 12 to 18 months into it. So we should just be starting to see that. I disagree. I don't think they fully hit. I think we've only seen the front edge. You talk to anyone in corporate America, the big companies have already termed out their debt. They have to go back and refinance that. You talk to anyone who's looking at a home, they can't get a mortgage at 3%. They're in that close to 8% category, and those people who own homes, if they need to move, they're going to have to step up their mortgage. The cost of financing autos has gone up, and we've seen through the Chase credit card data that revolving credit usage has gone vertical, and that's at a much higher cost of funding than before. So that is telling you the consumer's already stretched here. They're trying to maintain their level of spending, and it's going to cost them more when they put it on credit.
We've been seeing this, and we've been hearing the acknowledgement of this for people who still are not buying treasuries right now because they're saying that prices are still going up. Yes, the housing market is broken, but house prices are surprising to the upside. At what point do you say that inflation can stay here, that benchmark rates can stay here, even with a downdraft that's being felt and recognized by the market?
Well, I think the end of this week will be interesting because on Thursday we get benchmark revisions to GDP. We expect those to be lower. So that will raise into question how strong the economy is. Then we get personal consumption expenditures on Friday. We think that while the year over year may come down below 4%, you could have another 0.2. Now you'll start to print a string of 0.2s, which is bringing inflation pretty close to the Fed's 2% target. As long as those growth and inflationary pressures, the trajectory is down, at some point the Fed's policies will look outdated.
Question from a Bloomberg subscriber. Bob, let's finish with that. Unless the Fed steps back into the market via QE, who's going to take down the duration supply next year? What's the answer to that at the moment?
We get inquiry every day from retail platforms and from institutions wanting to know is this the time to go into bonds? And there's been a lot of flow at the start of the year, but I think it's only been at the tip of the iceberg. I think there are a lot of pension funds and insurance companies that are looking at one of the best opportunities to de-risk in 20 years. They put some money to work. They've got a lot more to do. There will be plenty of buyers out there.
Out of interest, what's holding them back? If I told them that they could have these yields a couple of years ago, they'd been like, really? Like, can I take that now? What's holding them back now? Here it is, 460.
I think everyone's concerned about catching a falling knife. And I think at the start of the year, when they put money in, yields rallied very rapidly and they pulled back to see if you would get a pullback. They pulled back a bit, and over the summer they put some in, and as yields had continued to go up, they've just paused.
Ian Lingan publishing moments ago, Bank of Montreal, it goes to the same illusion. Christopher Owen had this earlier, the stochastic idea of catching a falling knife. What is the signal out there? Is it Fed rhetoric or Jerome Powell policy, where all of a sudden you go from the fear of catching the knife to something else?
I think you've got to see something which evidences a material slowdown in the economy. I think everyone's comfortable with the disinflation narrative, but concerned that there's a lot of data in the labor market that looks strong. When we start to see the labor market come under pressure, that will turn the tide for sure.
Bob, I've known you a long time. Always enjoy catching up with you. Congratulations.
Thank you very much.
Inducted into the Fixed Income Hall of Fame. Bob Michael at JP Morgan Asset Management. Very cool. Live from New York City, Nadia Lovell of UBS up next.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but X-Pen is X-Pen. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under
Tightening would be a worse mistake than over-tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
The market is going to look past some of the shenanigans in Washington and focus more on what the Fed is doing.
Inflation has been trending pretty rapidly lower, much faster than the Fed expected.
Yields have moved higher, even in the face of this sluggish economic growth.
That is the risk for the fourth quarter, is can the consumer continue to surprise on the upside?
Consumers are spending, but they're filing for bankruptcy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We're together again in New York on radio, on television, and markets on the move. We'll do more this hour on the data check. Really extraordinary to see all the linkages. And John, one correlation today, unlike Monday and Tuesday, is oil lifts, 95 Brent.
And we talked about that toxic brew, Tom, to see Brent at 95 and the euro at 105. So that means euro weakness and energy strength. The oil importers, TK, the pain that they must be going through right now with this mix of a strong dollar and higher energy prices.
We've covered this all morning, and we can do we'll do the data here. We'll do a little more data for you this morning before we get to Nadia Lovell on the equity markets with UBS Global Wealth. But John, I look at where we are and I go to a tangible study, like talking to Bob Michael moments ago of JP Morgan about tangible things. Oil, you mentioned, dead on. Real estate is a tangible asset. It's not some fungible thing like Apple shares, OMG, bear market.
Well, let's get to the OMG of 450 on a 10-year, on a 30-year of 465. And Tom, let's ask the question, where are the buyers? Gargi Chowdhury of BlackRock said yield of dreams at the start of the year. This is the stuff people dreamt about years ago.
Yes.
They've got it in front of them. Why aren't they buying it? Bob Michael, JP Morgan Asset Management, 5 minutes ago, they do not want to catch the falling knife.
Lisa, I look at this, and this is your window, and I look at the Bloomberg Total Return Index, the ex-Lehman Brothers indices, and it's unimaginable that the price can break down below that trough of, I'm going to say, a year ago, and yet it's getting there. We're getting close to OMG, new low prices.
Yeah, we're poised for a third straight year of losses on the broad bond indexes. And it was funny yesterday when you talked to Kathy Jones and you said about falling a catching knife. Are you falling a catching knife? And she said, we don't like to fall catching knives here. We leave that to the equity folks.
It's in the
she was
zeitgeist
joking.
this morning. Verone,
right,
Lingen, Jones, all of them.
There is a question then, what's going to trigger a reversal? You know, what's going to trigger the people with conviction that yields will go down, maybe not back to where they were pre-pandemic, but that this still is the yield of dreams and not a precursor for a very new era with substantially higher, dare I say, Jamie Dimon type rates.
Are spreads giving way?
A little bit, particularly a little bit, but not catastrophically. This is the sort of shocker for a lot of people. It's why have you not seen bigger dissonance, bigger sort of dismay expressed in the credit market? You are seeing in high yield, though.
What's important here, folks, is the three of us all look at different tea leaves to indicate the stresses out there on a Wednesday morning. John, what's your number one tea leaf?
Well, I'm with Lisa. High yield spreads are still south of 400 basis points. Looking at the index that I follow, they're still historically very tight. Very, very resilient. Lisa was exploring what changes this. It's the data. It's certainly not house prices going up. It's not unemployment still south of 4%. It's not jobless claims around 200K. When that data starts to change, that's when you get on the call, on the phone, 1-800-BOB-MICHAEL, and you're like, yeah, let's go. Let's go. And you just don't see that yet in a big way.
I go to tangibles and particularly to real estate. Chris Verone saying how poorly REITs did yesterday and other indicators he uses. You know, you read in New York City, you read every Bloomberg and Crane's article that's out there about each real estate transaction. It's ugly.
It's ugly. At the same time, it's not that ugly, right? I mean, that's the thing, is that people are looking for it to be the catalyst to Armageddon, and it's not. I mean, we're used to the perma-crisis that you were talking about with the likes of Mohamed El-Erian earlier this week, and we're looking at a market that doesn't have that kind of catalyst. So that's the reason why people don't know what's going to stop the sell-off. in bonds that is causing yields to go to the highest since 2007.
A longer data check this morning in this 8 o'clock hour. John, I'm going to start with a bank rate 30-year mortgage breaching 7.75% up to 7.78. How close is that to 800?
Amazing. Just around the corner, Tom, off the back of these moves in the bond market. 30-year, 465, 10-year, 450, 2-year, still north of 5%. Off the back of all of that, dollar strength, the euro breaking down to 105.40, dollar yen breaking out to 149.20, 149.25 session highs. TK getting closer and closer to 150. That is a weaker yen, a weaker euro, and a much stronger dollar.
Even Mexican peso giving way here. It's been so strong for so many weeks. 17.59 Mexican pesos per dollar. On your equity markets, on your new 201k with a VIX at 18.26. Nadia Lovell, Senior U.S. Equity Strategist, UBS. Nadia, thank you so much for joining. Give me the siren call of whatever the new level of cash is going to be, 5.25, 5.55. Someday it's going to be a level like 6% cash. Do I need to be in cash?
No, I don't think that you need to be in cash. I think that there are opportunities in the market, equities as well as the bond market. We think that there is some upside to this market. I mean, this welcome pullback, I think is very healthy, and I think that it's time to really start to leg into the equity markets. And in the fixed income market, even though yields have backed up a bit, we do think that yields will trend lower in the coming months. We do think that the economy will start to slow and the Fed is done hiking, and that should give some relief to bond yields. And so we will be looking to add to bonds as well.
Starting to leg into stocks. Which stocks, Nadia? Are you looking at consumer discretionary and saying, let's go?
No, we actually, in terms of, we're neutral consumer discretionary. We maintain a preference for industrial consumer staples and the energy sector. We know that energy has done quite well over the last few months since we upgraded it 3 months ago, but it has lagged the commodity, and we continue to believe that oil prices are sustainable in this $90 to $100 range. We're looking for 95 into 2024, and so we do think that there's a little bit more to go in the long energy trade. I mean, we particularly like the E&P companies and the oil services companies within energy.
When you talk about yields eventually going down, there's a question of what's going to trigger that at a time where people are seeing strength that was unexpected in the economy. And they're saying that it will cause inflation to stay higher for longer, the Fed to stay on hold for longer. What gives you confidence that both equities can keep doing well and we are going to get yields going lower, typically some sort of symbol of weakness being expressed to the market?
Yeah, we are looking for more subprime economic growth, but we're not calling for a recession. And so we think that you are going to be in this sweet spot where the GDP growth is probably around 1%. The Fed is done hiking. We know that historically when the Fed is done hiking, bond yields start to fall. I mean, we think that inflation is going to continue to remain on this downward trend. I mean, for a core PCE on Friday, we're looking for about 14 basis points. And when you annualize like the last 3 months in core PCE, you're at 2.3%. Right. And so we think that inflation is going to cause the Fed to stop hiking and look to ease rates in 2024. And so that should be supportive to the equity markets as well as the bond markets.
Nadia, I'm going to editorialize and suggest that maybe the bond market on price is in a bond bear market, price down and staying down and looking for new lows. In the equity space, I'm confused. Are we in a bull market off the October lows, or are we reaffirming the bear market reality in stocks?
No, I don't think that you're going to re-enter a bear market in equities. I mean, reality is the earnings recession, in our view, is behind us, and so we think the upcoming earnings season, of course, will be important. But we also think that you should be starting to see an inflection point in earnings after 3 quarters of negative earnings growth. I mean, when we look into 2024, we see high single-digit earnings growth, really supported by still a growing economy, right. And still a consumer. Yes, the consumer is pulling back, but the consumer is still there. So, I mean, when we look into 24, we're looking for 4,700 on the S&P 500. So no, not an indication of a retest of the bear market.
What do you do with tech and other high flyers? I'm thinking luxury, which has been beleaguered, I guess. But what do you do with those leading sectors from before?
You were seeing a pullback in tech. We are neutral tech, but we think that this pullback could provide some opportunities. What's really going to be important for tech, again, is the earnings season. This is really where the rubber is going to hit the road. No longer is just the utter of the term AI is going to move a stock. You really need to start to see revenues come through on that, or concrete plans around AI. And we do think that you are going to start to see some growth in some of those areas of tech that had been weak, or signs of bottom and stabilization, whether that be PC, smartphone, or cloud computing. And so for globally, we continue to like the areas of tech that are profitable, number one, and two, areas of tech where there are high percentage of recurring revenues and have some secular exposure to secular trends like AI and cybersecurity. We do think that there's a role for tech in the portfolio.
Nadia, we talk about these macro trends, and then we get these micro stories like what the FTC did yesterday with Amazon. How much and how do you sort of view those headlines and translate them into overall theses? How much do you care about those type of developments?
It's important to keep an eye on these things because obviously, these sort of cases could eventually lead to a breakup of a company, which in some view, even some of the breakup of these larger companies can unlock value. So it is something bear watching over the longer term. But I think in the nearer term, what's going to matter more is really the earnings growth, what the Fed is doing and what the economy is doing, not so much on terms of a regulatory standpoint, because these regulations take a long time to play out, and most of the time they end up being nothing.
It's Groundhog Day once again for Amazon. Nadia, thank you. Nadia Lovell of UBS Global Wealth Management. Lisa, we touched on that, didn't we? How many times have we talked about this story regarding this company?
So, do you think that it was something else driving stocks lower, driving Amazon stock 4% lower yesterday in the day, right? I mean, because you raise a point, and I actually expected there to be very little price action because we've seen this again and again and again, and nothing has come of this. There's something else going on.
If I had no access to any news whatsoever and just eyeballed this market, I'd be like bond market. Treasuries,
Exactly. So I think that people are looking at some of these peripheral ideas of FTC suits and maybe using that as an excuse to sell because of bond yields where they are.
The wall of worry.
Yeah.
The wall of worry, just another brick in it.
Exactly.
Tom and just crashing right into it at the moment and not climbing it.
The wall of worry's out there, and it's going to be news flow, and data dependency becomes ever more crucial. I see also Dan Niles just out on Twitter. Great respect for him. He's been shorting. He just covered his short supposedly out on Twitter. There's going to be a lot of courage displayed with some people right, some people wrong.
The courage to buy this bond market as well, offering up 450 on a 10-year, which is amazing to see. Amazing. If you're just tuning in, welcome to the program. Your equity market positive here by 0.3%. Yields are a little bit lower by 3 basis points. The 10-year 450.51. Steve Rasciuto of Mizuho is going to join us in about 18 minutes or so.
Perfect.
What will change it? What will drive ultimately demand for the Treasury market? At least you'd have to imagine weak data, bad economic data, which is what some people are anticipating later this year. The problem is, and I've said this a million times this year, it's the economists who cried recession.
Exactly.
We've sat here so many times and talked about it, and now they're still saying, yeah, but this is it. This is it really. 4Q, tension, headwinds for the U.S. consumer.
TD Securities just put this out, their rate strategist, saying the beatings will continue until morale deteriorates. And that kind of is what this feels like, right? That essentially you're going to keep getting it wrong until finally people start suffering a little bit more, because essentially that's been the story of the calling recession that just hasn't happened.
Starting to see it in consumer discretionary stocks. It's been painful for that part of the equity market. Chris Verona Strategas was with us a little bit earlier this morning. We had that conversation with him. How do you frame this moment? Do you see this bond market move as a reflection of the extension of the cycle, reflection of the resilience in this economy, or a recipe to end it, a recipe to drive in some pain into this economy? And he said, based on the move in discretionary, Tom, it's the latter and not the former.
I think that's one of the theories that's out there. Having Steve Rasciuto come up with his work with Dominic Constant at Mizuho is going to be able to frame where we are. But again, I'm going to go to the data, and first thing is to get to the weekend. I mean, to be honest,
that feels like somewhere away still.
And again, what am I watching most, folks? I'm watching real estate. I think that's a huge story here.
This is where we are right now. The dollar, the strongest it has been throughout the whole of 2023, and crude at highs for the year as well. 95 on Brent. That conversation with Amrita Sen, energy aspects, on why she's looking for triple digits.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
We think it probably normalized towards $100. The question we've had a lot today is why 100? Well, when you look at spare capacity of OPEC, over the next few years, the only ones that are going to be able to fill that gap in supply is OPEC. And historically, when spare capacity has fallen to sort of between 5 and 10% of total capacity in the world, that's a risk premium, which I haven't used that term for a very long time in oil, maybe last year briefly, that will drive $20 above the 80 to 100.
Looking for triple-digit crude, Christian Malik there, the global head of energy strategy at JP Morgan Securities. We've heard a lot about that number over the last week. And Rita Sen of Energy Aspects calling for $100 oil by Halloween, the last time she was on Bloomberg Surveillance. In her latest note, she says this: "We do not see prices letting up in the near term. Crude fundamentals have become strong enough that the macro story is no longer sufficient to drive price action. Tom, instead, crude is starting to drive the macro view."
Joining us now in New York, as usual in London, Rita Sen, co-founder, head of research, Energy Aspects. How does Saudi Arabia react to the bond turmoil and critically strong dollar currency turmoil worldwide in OPEC Plus and outside OPEC Plus?
I think, Tom, that's one of the biggest reasons why Prince Abdulaziz has insisted on keeping these cuts. He is extremely worried about what he's seeing in the macro market, right? Bond markets are reflecting this uncertainty. What does it mean for growth? And why preempt that by bringing barrels on, for instance, and you get a big slowdown in growth, only for them to have to cut it back?
What was the mood like in Oklahoma City? That's where you just came from with this conference. David Solomon, interestingly, was there of Goldman Sachs saying, "We support you," which is a real change in the tone of some of the biggest financial institutions in the U.S. Was the tone optimistic that you could start investing again in a way that was more meaningful with the idea of higher oil prices?
No, I think it's a great question. And I think the mood was optimistic because oil prices are at 90. But I do think there was a sense of pessimism as well, because the markets aren't really allowing CEOs and companies to invest. Shareholder pressure and governments as well around the world. I think you're starting to see some European governments backtrack over the last couple of days with some of their big targets. But in general, I'd say, the support from the Western governments for oil and gas companies remains very limited, with the focus still mostly on ESG and renewables.
Well, there's a larger question here than how high prices could go. And the Continental CEO said that oil could hit $150 without government backing. Do you agree? I mean, honestly, when I saw that, I was like, of course. But that's just my natural internal skepticism. What's your take?
I mean, look, those numbers, they're just a number, right? Like you can't kind of like, what's the difference between, I don't know, 130, 150, 200? I wouldn't sit here and call for those numbers. But I think the point I would make is, and we've been calling for high prices for the end of the year consistently, and we were very out of consensus. But my kind of fear in this market is we have destocked so much inventory. Right now, what's going on in the US, Cushing is dry. And even when Cushing has fallen to record low levels, it can't keep barrels because the rest of the US is so low that it's continuing to pull barrels from Cushing. Dubai, I don't know if you saw this morning, Dubai spreads have gone to over $3 backwardation. It's telling you this market is very, very tight. And we are not seeing signs of investment from companies, not because the CEO doesn't want to, it's because we in the world, society, governments, they're not allowing them to. We do continue to see a huge supply gap in the medium term, probably around 26 to 29. We don't have enough projects in the pipeline, and that's where OPEC and Saudi Arabia and UAE have to step up, and that's where the projects are coming through.
This is ultimately the point that you're making, that perhaps some people are getting this back to front. You're saying that the macro isn't driving crude, crude's going to drive the macro. Can you explain that just a little bit more?
The first half of the year, we had every Fed decision mattered more to crude oil than OPEC decision, right? Whereas now, you've seen even when in the bond market, the turmoil we've seen equities come off, but crude's really held up. And that's purely driven by fundamentals. And the worry now is if crude markets are this tight, you start getting oil prices going up, and then does that influence Fed decision again through inflation?
In your experience, how inelastic is demand for certain crude products? How much demand destruction could we see off the back of these prices?
Oh my God, Tom's going to love this because I'm going to say this because I have started to see this not just in China, but even other parts of the world. It's very early days. So Tom, don't ask me to put a number to this elasticity thing I'm going to mention. But I'm sensing that oil is becoming more inelastic. If you look at this, the global economy this year is going to be less than 3% GDP growth, right? But oil demand growth is going to be more than 2 million barrels per day. Now, China, we know, still post-COVID recovery. But there's something around, initially we all thought working from home will lead to lower oil demand. It seems to be going the other way because now people are having to come into work. There's more driving from further away because people have still moved out during the pandemic. We just aren't seeing the same impact from higher prices on demand. Again, early days, maybe people have excess savings. Let's see what happens next year, but I'm keeping an eye out on that.
You want to put a number on that?
I'm telling my group of economists to continue to do that.
The microeconomist Jeff Curry at Goldman Sachs, exiting, made very clear to us that the tangible real yields globally, the end of the free money that we've seen, changes your world, changes oil investment. Are you beginning to see indications that a 10-year 2.22% real yield changes how oil animals think?
Absolutely. And I think we've been talking about this since April, really, Tom. And that is my worry. Nobody wants to hold inventory just for basic kind of, we always used to say we need X number of days of forward cover, 15, 20, whatever that number is. You need that buffer. What if a cargo gets delayed? What if there's a Libya happening? Today, because of the rising rates, it's too expensive. And that's what creates the risk of volatility and upside for prices going forward.
So let's reaffirm the price. John started with that. I mean, you made some real headlines and vision of $100 a barrel at 95.57 Brent crude. We're really buttressed right up against the 96 level. But before, get us out beyond that to the fear of 120 a barrel. How do we get there?
I think those kind of numbers, those kind of numbers, you probably need an event, right? A supply shock. But in the day-to-day trading, if we break these technical levels, of course we can make a run up to $100. Like I said to you last time, calling 100 at 95 is not a big call, right? So I'm not going to do that.
But to get to the new regime.
No, to the new regime, I do think, yes. And one of the things to bear in mind, there's crude and cracks. Diesel cracks, yes, they're coming off, but gasoline and diesel cracks are on top of that. So that's where I do think, in some ways, you have to put a risk premium to prices because you don't have enough inventories. Once you break through this next level, we can then go into that paradigm where we just hang around $100 unless there is a clear sign that demand is slowing down. We haven't seen that yet.
Just to finish, how sustainable do you think the Saudis' current position is?
Oh, it's very sustainable. They're very, very clear that we want to make sure inventories are not building. And I think there's clearly signs of that. And also the macro concerns, right? And that's where it becomes a bit of a chicken and egg because we've started to get worse data from the US. That's going to concern them even more. And that almost makes them more cautious in adding barrels back.
The reason I asked is because there is a monthly review. I'm just wondering whether I should ignore the monthly review between now and the end of the year.
I mean, we have seen Prince Abdulaziz and even Alexander Novak come and extend the cuts to year end. Of course, they always keep an eye out on the market. We've got the November OPEC meeting as well in Vienna. So there are a few things to kind of consider before year end. But, that deal is still, he's extended it for a reason. He is concerned about the global economy. I'm not going to change that overnight.
We'll see if they let us attend that OPEC Plus meeting in Vienna. You don't want to weigh in on that. Don't worry about that. Amrita Sen of Energy Aspects. Amrita, thank you. TK, triple-digit crude is only $4.50 away.
It's an international event, and the International Bank in America, at least the romance of it, is Citigroup. Thank you to Barchat. It's a great Twitter handle. They do a lot of smart stuff. And Barchat's got out this morning. I miss this, folks. We miss a lot here because there's just so much to watch. The House of Jane Fraser, reverse 10-to-1 split is in the vicinity of $3.99 per share. We're not there yet. We got down to $4.01 per share.
We have this conversation every time. Is that bar chat or bar chart?
I thought it was bar chat.
Is it bar chat or bar chat? Do you want to double check?
It's very valuable.
Just in case someone wants to go and access that material out on X, the platform formerly known as Twitter. Amrita, thank you.
Just Amrita wanted me to put a number on it.
I know. Coming up on the Open next hour, Tony DeSpirito of BlackRock, Tony Dwyer of Canaccord Genuity, and the brilliant Amy Wu Silverman of RBC. As we count you down to the opening bell, about 1 hour and 4 minutes away in a couple of seconds. Your equity market higher, positive by 0.3%, trying to bounce back from 3-month lows. From New York, this is Bloomberg.
Names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Surveillance on radio and television. Jonathan Farrow on assignment. Lisa Bramwitz and Tom Keene here with markets. We've been doing durable data checks all morning, Lisa. It's a durable bond market as it tries to find a durable price south.
It tries to find a durable data point to try to give some direction, and we do get durable goods in just seconds. It is important to say, and you've been on top of this, Tom, that the dollar strength is really the one move that has permeated and continued from day to day, and it continues yet again today.
With a durable report on durable durable goods. Michael McKee. Michael McKee, why do durable goods matter?
That's a durable question, Tom. Gets asked a lot. The headline numbers don't matter as much as the capital goods orders non-defense ex-air. So why don't we start there? Up 0.9% after a 0.1 gain the prior month, which is a bit of a surprise. We'll have to see if that is revised at all. But I'll tell you what, the capital goods orders non-defense is good news. Yeah, it was revised down to a -4. So you get over the past 2 months, you've got a swing of 0.5 percentage point. Durable goods orders overall up 0.2% after falling 5.6%. That's a revision down by about 0.4. Ex-transportation up 4. We expected, the headline was expected to fall more because ex-transportation take out the Boeing numbers is what you always have to do. And at this point, it looks like that didn't matter all that much. Shipments up 0.7%. I heard you and Steve talking about third quarter GDP during the break, and that'll feed into that. These are August numbers for third quarter, and shipments obviously stronger than had been anticipated. So it looks at this point like reasonably good news. Now, cherish these numbers because we get tomorrow and Friday, and then we may have to go a very long time without data. So be very excited out there.
Michael McKee, on sabbatical, if we get a shutdown, of course, he's leading our coverage here on shutdown, surveillance shutdown central. We'll have more on that. And look for Balance of Power as well this evening to give you an update on what's going on in Washington. Lisa, just very quickly here. Michael McKee, thank you. Just, Lisa, a little bit of market move. I don't really know what to make of it. Can you?
You saw 2-year yields slightly inflect upward, but this isn't going to make the break or make or break the bank. The idea that the headline number came in better than expected, yet another better than expected data print, keeps people on edge that is the economic surprise, continuing to the upside rather than the Bob Michael view of the world of the deterioration continuing and really deepening.
We'll drift away from the markets. Brent crude 95.36 up $1.40, really buttressed up against 96 an hour ago. And the interesting strong dollar features. We'll sum all that together, and we can do that with Stephen Rasciuto. He's chief U.S. economist at Mizuho Securities. The Rasciuto constant tandem is extraordinary what they've got at Mizuho right now. Let's go to third quarter GDP. I believe it ends in 3 days, if Taylor Swift allows it to. And the answer is you are more optimistic than many. State the optimism.
Yeah, I mean, I think the reality is the consumer began the quarter on a very, very strong note, and we have seen it tail off as the quarter goes on. But you're considering quarterly average data, so raising the early part of the quarter and the end of the previous quarter sets a higher base for the quarter in general. Then you've got information like you got this morning in terms of the durable goods shipments, and then you can look at the investment expenditure components. And even though there has been some weakness in housing, the actual level of construction started in housing is there, and we had a little bit of a reduction in the trade component. So I think when you add it all up, the surprise in the GDP number is actually a much more healthy number than people think, more in lines with the Atlanta Fed numbers than the New York Fed numbers.
So how do you understand this, right? We have the idea of people saying that they feel very uncomfortable, that inflation is impeding their ability to spend money in other places, and yet home prices went up. We hear that people are less confident than they've been in more than 6 months, and yet suddenly we're seeing consumer spending remain robust. How do you pair what people are saying and what people are doing?
There's a disconnect, and there often is a disconnect between what people say and what people do. Yeah, I'm concerned, but I'm more concerned about where it's going to be in the future. But, you know, I really feel like getting this done, and I'm employed. I feel comfortable in my job. You know, UPS workers are making a heck of a lot of money. UAW workers want a 40% wage increase. I'm going to get paid more. I've got a good job. Nobody can fire me. I'm just going to go out and spend money. And, oh, by the way, right now, shadow banks are willing to lend to them. So the net result is they're going out and actually spending the money.
Are they going to get the wage increases? Because we see that the strike activity is continuing and accelerating on some level. We've seen, yes, some sort of maybe resolution with the Writers Guild over in Hollywood. UAW is still ongoing with the support of President Biden. You have now the Las Vegas bartenders and other and housekeepers and food servers coming out authorizing a strike in that region. Is this going to push wages higher regardless of how much the GDP he hangs in there?
Well, the reality is there is a real wage pressure problem. And even though there's a smaller percentage of the economy is unionized now than back last time we had a significant wage-related issue in the economy, the fact that we have 24-hour-a-day, 7 days a week, 365-day-a-year financial press, and they're looking for things to talk about, and this wage story is a big thing, everybody hears it all the time. So that helps drive the momentum behind, yeah, I deserve to get paid more.
The idea of Risciutto and Constam down the same hall or wing of Mizuho, New York City is extraordinary. Dominique Constam has been screaming in a wonderful way that this Fed is, quote, super restrictive. I see it in the Bloomberg Financial Conditions Index, where finally the accommodation of the last 90 days is coming in. Overnight, the BFCI dipped below zero just for a cup of what do I call it, hot brown water? Yeah, hot brown
very
water.
flattering.
It's come back up, but essentially we're becoming more restrictive. How restrictive are we now within the Risciutto Constam restriction?
Well, the question is not how restrictive we are. The question really is how restrictive do we need to be to get the macroeconomic result we're looking for? And this becomes the problem. If you look at the different portions of the curve, the long end of the curve up until very recently had been very well controlled. Yes, mortgage rates were high, but corporate financing costs were good. Spreads are very, very tight. Then you look at the belly of the curve where securitization takes place, where the shadow banking industry funds, and it was, 100 basis points through what we're looking at because everyone expected 100 basis points worth of cuts. Now we've taken out 50. I hate to tell you, we're going to take another 50 basis points out. So the reality is the restriction that we have in terms of the Fed funds rate is not necessarily the restriction that's being transmitted to the rest of the economy. And that's been the problem for the economy and for the Fed.
So critically, how does Chairman Powell adapt to that, to the Risciutto Constam restriction?
Well,
how does he adjust?
The problem for the chairman is the other members of the committee continuously torpedo the ideas that are laid out in terms of the FOMC.
But he's the chairman.
It doesn't matter. His vote is only one, and he's reflecting the committee in general. He's one vote on that committee.
Oh, come on. Greenspan didn't run it that way.
Greenspan was a very, very different chairman. Greenspan's vote counted more than anybody else's. This particular chairman doesn't have that clout. And the net result is you have a situation where the political economists versus the academic economists are winning.
Bronze that. Folks, it's September 27th. That's the most important comment I've heard on Bloomberg surveillance in 2023.
I want to go back to the idea of wage pressures, Steve. You were basically saying that it's the media's fault because we're looking for things to talk about. So we're talking about all the strikes and that it's leading to people asking for higher wages. Companies will not pay them unless they can afford it without going out of business. Are these wage increases sustainable with the business models as they are?
Well, again, I'm not blaming the press. I'm just saying that's part of the dynamic that you have to take on board. That's number one.
I just had to call you out.
Yeah, that's okay. Number two, you have to realize that the benefit for companies is so far, up until very recently, the equity market's been giving them a pass. Okay, in the first 9 months of the year, operating earnings are down. Yet the economy has been above growth potential and inflation's been high. Yet the market is assuming we're going to have 12% rise in earnings next year. Here again is a disconnect. The numbers don't add up. If this year you can't get positive earnings growth at all so far, how are we going to get 12% earnings growth next year? So the reality is, as the equity market comes down, companies are going to be forced to say, I got to increase my margins. I'm going to go out and start shedding some of my workers. And that's when you start to see the consumer come down. And that's where the risk becomes of a 2024 recession. Not until the equity market starts telling CEOs, you have to do something about your margins. And it's just beginning to happen.
This is a really fascinating point because a lot of people are looking to why is the stock market so optimistic? Is this sustainable? And you're saying that is what has to give. The margins, because these workers are going to get those wages, and then the layoffs begin. So if we don't see them until next year, until later in the year, how high do benchmark rates go? How much could this Fed overshoot it, in your view, to get it down to 2%?
Again, the reality is the terminal rate is a moving target. It's up to be honest, granted, it's up to two things. It's up to how quickly the long end of the curve stresses the Fed, because the Fed is willing to play games, or at least some of them are, with the idea of a 2% target. You heard Goolsbee the other day, okay? Those are fine examples of the problem. So when the chairman says, I'm adamant on a 2% target, and Kashkari comes down and says, I'm adamant on a 2% target, there are other members of the committee that come out and say, you know what, when we get to 2%, we'll rethink it. Well, no one's going to believe 2%. So the reality is long-term rates are moving higher. As long-term rates move higher, inflation expectations become unanchored. Then the Fed has to address the situation. If inflation expectations become unanchored, what do? Do we allow it to happen and sustain a higher inflation rate embedded in the system, or do we take action against it? I think they'll eventually take action against it.
You're so fired up. We're going to continue with here. We got to do a data check right now because the markets are moving on radio and television. Good morning across America. Lisa, it's green on the screen. The equity market says everything's fine.
Oh, well, but this is really the issue, is that something has to break it. And to your point, if the Fed is really truly committed to that 2% goal and is concerned about how unmoored inflation expectations are, what more can they do, right?
There's only one thing they can do, and raise interest rates. You saw that last year when inflation expectations began to become unanchored, and Bullard came out, who unfortunately is no longer there. Bullard came out and said, hey, we got to go 75 basis points, and they went 75 basis points in 3 steps. And the net result was inflation expectations became anchored again for an extended period of time, and the equity market managed to do better. This time through, it's questionable with the new composition of the committee whether or not the committee will make those same steps. And the market, I think, is building in an inflation risk premium. People like to call it a term premium. Actually, a term premium is nothing more than an inflation risk premium. And the market's building in an inflation risk premium because they say there's a 2% target, but is it really a 2% target? I'm no longer believing them.
We're going to come back on that. Steve Risciuto of Mizuho with us right now. You need a data check. Futures up 16, the VIX 18.30, showing some of the tension there. But in the bond market, disinversion continues with negative 56 basis points, 2.22% in a little bit, but a stunning 2.18% on the 10-year real yield. I've got the dollar stronger. Dollar out to DXY strength about 40 minutes ago. We'll monitor that through the day. The Standard & Poor's 500, green on the screen, up 0.4%.
I want to pick up there on what Steve Risciuto was talking about, Tom. I mean, this idea that the risk premium, that the term premium is no different than the inflation premium, that basically people are not believing the Federal Reserve really is committed to getting back down to 2%. Stephen, is that a worry for you? Economically, does that actually create a risk for the economy that people are underappreciating?
Well, I think it certainly creates a risk for long-term investors. You know, when we were in the 3.75 to 4.25% trading area, we were basically priced at perfection for a 2% target. You know, 1.75 to 2.25% trend growth, 2% inflation. You're right there, 3.75 to 4.25. If you're going to say 3% is the target now, then I'm talking 4.75 to 5.25. It's a long way from where we are today. And that then becomes the issue. The issue first is for the markets. And then we can talk about what the issues would then be for the macroeconomic environment. Clearly, mortgage investors or household people who want to buy homes aren't going to appreciate the fact that long-term interest rates are going that high. But again, this is the risk the Fed takes by wanting to change the inflation target. And if you change the inflation target, I'm afraid your credibility disappears.
What is, for America, what does a 2% plus real yield mean? A huge body of people have never experienced this. What's it mean day to day?
Well, I mean, I think the question is a 2% real yield enough? I'm not sure it's enough. Go back to what you and I lived through in the Paul Volcker days. All right, where did Paul have to stop?
Big number.
Paul stopped at 26% Fed funds rates.
Yeah.
I'm not saying we're going to get there. It's a different world. But be careful in picking a terminal rate.
We got to get you and Dominic on set together. That would be. Are you guys on speaking terms?
Yes, we are.
Okay, Steve, there's your break exclusive for the day. Risciuto Constant on speaking terms at Mizuho Securities. We'll get them on here together. Coming up, David Rubenstein, the Carlyle Group.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
First of all, I think it's nuts to make a big issue of this debt limit thing. And because that says simply it's a stupid rule we have in America that Congress has to approve twice, paying for something they've already voted to spend on. I mean, a lot of these people who were opposing raising the debt ceiling voted for most of the debt that is embedded there.
He is 77 years old, the former president of the United States, Mr. Clinton of Arkansas at the 92nd Street Y. That with David Rubenstein and Secretary Clinton as well, Hillary Clinton, Bill and Hillary Clinton on Bloomberg Tonight together at 9 p.m. So you'd think you'd show up, Lisa, and it'd be like Pelsy-Welsy, happy, happy. The material of this interview with David Rubenstein is stunning.
Especially at a time where there are real questions about what a changing of the guard in Washington, D.C. on both sides of the aisle would look like.
I can't say enough about this, folks. Whatever your political persuasion, Mr. Rubenstein is at a home run here on the controversies deeply embedded across America. He's co-founder, co-chairman of the Carlyle Group. David Rubenstein joins us this morning. David, I got 8 ways to go here, but I've got to go to the idea that the former president of the United States thinks the Electoral College of Madison, Jefferson, and the rest is out of date. Is he serious?
Well, he favors direct election. Obviously, direct election has some problems, but as he points out, the Electoral College was set up when we had 13 states or colonies, and it was set up in a way that was designed to help the South have more influence in the election of the president because of the slavery issue. But in the end, direct election has been talked about many times over the last 200 plus years, and I think it's unlikely we're going to change because it will require a constitutional amendment, which requires 2/3 of each house and 3/4 of each of the states, and the smaller states are not going to agree to a direct election system, which eliminates their influence in the Electoral College. But I think the most important thing I would take away from the interview is that Bill and Hillary are still very deeply involved in what's going on in the United States. I think no couple since Eleanor and Franklin Roosevelt have together had as much influence for as long a time as the Clintons have had. Bill Clinton was president of the United States for 8 years, Hillary Clinton a senator for more than one term, and then Secretary of State for 4 years. And so the combined experience the two of them have is quite unusual. Eleanor Roosevelt never held elective office. And interestingly, I think they still have a lot of influence in the Democratic Party. When they talk, people do listen, and I think they're widely regarded as having pretty good political insights and pretty good policy chops. I don't think that today, they are likely to be able to influence President Biden that much, though they know him. But President Biden is on a certain trajectory. But there's no doubt that they have influence throughout the Democratic Party, and
and probably with some influence with President Biden.
There's a really intense debate right now, David, among a lot of people talking about the age of the candidates who are running for office and whether it represents the rank and file of the country, why it is that sort of mainstays in politics have continued to be the headliners again and again, year after year, even as some people would argue they may be aging out. What was the view of the Clintons on that?
Well, they're not going to say anything specifically about the age issue in a way that would be upsetting to President Biden. But there's no doubt that both of them are in their mid to late 70s now, and they recognize when you're in your mid to late 70s, I'm 74, you probably have more challenges doing certain things than you can do before. Last night in a different forum, I interviewed Jim Baker, former Secretary of State, who's now 93 and a half years old. And, you can see he's very smart still. But, when you're interviewing somebody in her 90s, it's different than interviewing somebody in their 60s. I think the President of the United States today is, 80, and his likely candidate against him, Donald Trump, is 77. So it's a different situation than people expected. When I was a younger John Kennedy ran, he was 43 years old. That was thought to be too young. What's too old, what's too young, nobody really knows. The voters have to make their decision. There's no doubt that as all of us age, we recognize that it's more difficult to do certain things in your 70s than you could probably do in your 60s.
No.
Well, it's a good point, and everyone's age is different for each person in terms of what they can do. It's just the reason why I bring it up is because it has played so heavily in polls at a time where people are trying to understand what the new path, the new vision is. Yesterday, we saw President Biden on the picket line talking about workers' rights, and a lot of this had to do with the globalization and some of what that did to the industrial complex. Do the Clintons weigh in on kind of how they see globalization at a time where it's really being called into question?
Well, I don't think they think globalization is going away. They think it's been challenged a bit, that China is more complicated a country to deal with than it was before. But I think globalization, they would say, and I would agree, is here to stay. It's just going to go through some ups and downs. Clearly, the Congress of the United States is more divided on globalization than it was when President Clinton was in office. When President Clinton was in office, we brought the Chinese into the WTO, and now there's some people that think that was a mistake. I think it was a good thing to do, but there are many people who think that we've given China too many opportunities to be competitive with us. And I think the Clintons are not against China's being in the WTO for sure, but there's no doubt it's a different environment than it was 25, 30 years ago.
What will the impact of the Clintons be at a convention in 2024, or the development of, I guess, Mr. Biden running again? What do you perceive as being their impact on the party?
Their impact is that they're highly, highly respected. I was at an event in Aspen this weekend where many people who are prominent former leaders of the Democratic Party were there. There were also Republicans there. And Hillary Clinton was a speaker, and she got a terrific reaction from many people there. Barack Obama was there. He also was well received. So I suspect that the next Democratic convention, Bill and Hillary, assuming they speak, will get standing ovations because they're very good speakers and widely regarded and highly regarded in the Democratic Party. Barack Obama and Michelle Obama the same. That's different to say that they can change people's votes that much. They have some influence, but as we all know, Bill Clinton is a very good speaker and very good at explaining things, and I suspect he'll get an incredible ovation when he speaks at the Democratic Convention, as I assume he will.
Yeah. David, he is dead at 86 years old. I know the impact that Brooks Robinson had on me and all of us is he invented third base for modern baseball. You were a lad in Baltimore at the time of that Orioles ascendancy. What did those Orioles teams and what did Brooks Robinson mean to Baltimore then?
Well, for people who grew up in Baltimore, Baltimore was always much smaller than New York or Philadelphia, or not less significant in some ways than Washington. So having the Orioles win the World Series gave us an enormous amount of pride, and Brooks Robinson was seen as the ultimate Oriole. He played for the Orioles his entire career, Hall of Famer, the greatest defensive third baseman in history. He's had some health problems in recent years and sadly passed away yesterday. But I think there's nobody who represents the Baltimore Orioles better or represented them better than Brooks Robinson, though they had many great players over the years. He was equivalent to Johnny Unitas, who was the star of the Baltimore Colts in that era. It's a sad thing to see that happen. You know, when you're younger, you look up to people like Brooks Robinson, and I did. I was very young, and he was just the ultimate baseball player.
David, thank you so much. David Rubenstein and the Clintons. Look for that, of course, here tonight at 9 p.m. on Bloomberg. I can't say enough about some of the comments that I've seen from this interview. Lisa, it's just amazing to see what the path is going to be to 2 conventions next summer, and then somehow out of Labor Day, we stagger through September and October next year. I can't frame what that will look like.
I can't even frame what debate's going to be most important. Is it going to be inflation? Is it going to be workers and unionization and getting wage increases? Is it going to be abortion? Is it going to be the question of, just globalization and international participation? No, but at the same time, if you take a look at all the different issues that have played, it's unclear which is going to be the dominant one.
I mean, I'm going to go back to the culture wars as identified, but really what this is about, and it speaks to a gentleman with a megaphone on a picket line at Michigan Truck that we saw in the last 24 hours. They got to get out the vote. They got to get out the independent vote. They've got to, both Republicans and Democrats, get out a youth vote of a changing America. And it's just, to me, there's a huge uncertainty of the path that we're going to see into next year.
And we'll be tracking it. Today there is a Republican debate that no one's talking about, but we will be talking about it tomorrow, I'm sure. There also will be the former President Trump
Farrell
in Michigan.
Will watch it. John Farrell will watch the debate tonight to report to you. These are Markets on the Move on radio and television through the day. More data checks. This is Bloomberg.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With 2 more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Live from New York City this morning. Good morning, good morning. 3-month lows on the equity market and trying to bounce. Your S&P 500 up 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, surging bond yields shaping up global markets. President Biden joining striking auto workers as Congress struggles to keep the government open. We begin with the big issue, consumer confidence taking hits.
We're starting to see the consumer certainly under some pressure. Weakness in the consumer.
Consumers are going to be facing some headwinds here.
The market doesn't like the strong economy keeping interest rates higher for longer.
Even, 50 basis points higher from here really will start to impact the consumer.
Consumers continue to complain about inflation being elevated.
Higher oil prices.
They're still concerned about the labor market and their personal finances ahead.
The trend in yields is up.
Yields are rising.
You have to ask the question, is this last move up in yields the signal that we're end of cycle?
You always have that kind of last kind of move where people throw in the towel, and I think that's what we're going through.
I think from here the consumer slows.
There's a real spending issue coming up, and I think that that's going to impact earnings.
Bond yields being higher, our Fed that's higher for longer, is going to continuously put pressure on just the broader markets.
The risk for the fourth quarter is, can the consumer continue to surprise on the upside?
Consumers are getting it right and saying, look, there's trouble ahead.
Let's build on that conversation. Joining us now is Canaccord's Tony Dwyer, BlackRock's Tony DeSpirito. I'll be using full names for the next 20 minutes. Don't worry, gents. Tony Dwyer, first to you. Let's talk about that consumer. Do you see this bond market move as a reflection of unexpected resilience of the consumer, or are they ultimately going to be a source of fragility?
I don't think it has very much to do with that at all. I think we're trying to make a great academic study, John, on whether it's inflation or economic growth. We lost our biggest buyers, right? Our three biggest buyers are the Fed, commercial banks, and foreign entities. So the peak day for the S&P 500, I believe, the peak moment was when Janet Yellen announced that the Treasury Department was going to increase their issuance of treasuries to fund the government. That's when bond yields started moving higher. That was the peak day for the market. Now what's happened is you've got this incredible increase in supply because you went through the period of the debt ceiling debacle. So you have this incredible level of supply. The Fed is in quantitative tightening, so they're not buying. You've got China and Japan supporting their own currencies, so they're not really buying. And then the commercial banks are under regulatory scrutiny because of the Silicon Valley Bank issue. So when you lose your three biggest buyers and you increase the supply way more than expected, guess what it yields to, John? Higher yields.
You get some juicy
yields. I don't think it has
yields.
a lot to do at all with economic activity.
A 10-year at 450, a 30-year at 463, a 2-year at north of 5%. Tony DeSpirito, why buy stocks when I can buy that in the bond market?
Yeah, well, look, without a doubt, we're seeing more competition for flows from bonds. But I think, we've kind of been spoiled by, I'll call it the post-global financial crisis period, where equity returns post the GFC until the Fed started raising rates in 2021 was over 17% per year. That's more than double the historical average, and with less volatility. I think we're going to go back to the world before the global financial crisis when we had kind of 8% returns. And so one of the things we do is we look at an equity risk premium. It's effectively comparing stocks versus bonds. And when you look at that ratio is like spot on, exactly in line with historical averages. So I think we've got to get that post-financial crisis period out of our mind and look back and say, you know what? Stocks versus bonds, much more like what we've seen historically. And of course, historically, equities have won, depending on the time horizon you use, 75% of the time versus bonds. So I still think equities for the long run for your portfolio. I do think we're going to need to be more selective because of more volatility and more stock price dispersion going forward.
And Tony DeSpirito, just to pick up on that point, are you basically saying we're going back to what you might call the old normal?
Exactly.
What do you think the relationship will be like with that in mind between equities and bonds? Because at the moment, bonds down, stocks down, and then all of a sudden bonds up, stocks up. Do you think we can break that and break back to that traditional, more intuitive relationship between stocks and bonds?
I do think we're going to go back to those more historic relationships. And I think also volatility. This is really important. Volatility and dispersion will increase going forward. I think that's both in terms of earnings volatility as well as when I look at valuations. There's a wide dispersion in valuations. I look at that and say, look, two things, two conclusions for investors. One is beta is not going to be enough, right? You're going to want more than stock market returns. You're going to want to seek alpha. And the environment is ripe for still skilled stock picking, and I use that word carefully, skilled stock picking. So if you can find a skilled stock picker, I think the alpha available from skilled stock pickers is going to be higher over the next 5-10 years than it's been over the last 10.
Tony Dwyer, do you agree with those two conclusions?
It's going to be a really difficult time, John. You're in the situation where somehow the Wall Street's thinking that you've got a historically levered system. Debt to GDP is at a generational high. And somehow we're going to have the fastest rate hike cycle in history. And it's all going to be okay, and we're going to have the Goldilocks. So our belief is that, believe it or not, when bad news becomes bad news, to the other Tony's point, that's when you want to look at taking advantage of the opportunity where the weakness has already been engaged. The average NYSE stock is now down literally 30.0% from its 52-week high. So, to believe that now the data is getting squishy, so you should become more negative because interest rates are higher, that's been in the restaurant stocks, the retail stocks, the bank stocks. It's been in all of those areas, and it's been kind of made invisible by the Fantastic Seven or whatever, phrase you want to use today. So our view is that you get three parts of this cycle, John. You get good news is bad news because it means a tighter Fed. That was 2022. Then you get bad news is good news because it means the Fed's done and rates can stabilize. But ultimately, the real time to buy, the time to be aggressive is when bad news becomes bad news. And I think we're starting to see the beginning of that with some of the consumer data. And God forbid we have a traditional credit cycle instead of a credit disaster. We've had, to Tony's point, 13 years of an incredible fixed income environment. And levering it up that way, just meaning the higher yields are going to have a bigger impact. It doesn't have to be a crisis. It's just a credit cycle, and that's what ends up in a recession.
You mentioned that economic data. Let's talk about it. Let's cross over to Mike McKee. Morning, Mike.
Morning, John. I wish I could help Tony Dwyer out, but unfortunately I've got good news, which is good news, and that's all I got this morning because durable goods is the only number out, and it does come in stronger than expected, in some ways more strong than even expected, because durable goods orders were expected to drop on Boeing, but they didn't. 0.2% gain, 0.4 ex-transportation. And the capital goods ex-defense, ex-aircraft up 0.9%. That's the proxy for business spending in GDP, so that's really good news. Capital goods shipments tell you kind of what went into the current quarter GDP, and that was up strong as well. We won't get those numbers until the end of October, if we get those numbers. Tomorrow we get GDP figures, but they're the third and final release for the second quarter, and we get jobless claims. Income and spending on Friday is going to be the last big number that we may get, as the Fed is looking at the PCE component of that. What is inflation doing? And are consumers still spending as they were? Michigan sentiment, you were talking about consumer confidence at the top of the hour. Conference Board was down some this past month, so we'll see if Michigan mirrors that. But then we're kind of out of business, because if the government shuts down, there's a lot of stuff that won't happen. I'm only going a week out at this point because we don't know how long it's going to last. But here's what you wouldn't get next week. You wouldn't get most or any of the government numbers. ISM manufacturing and services still out. That'll be important. Vehicle sales will tell us something, but really the numbers that the Fed's going to want to see are not going to be available. The problem only gets worse if the shutdown happens and goes on, but we're going to have to wait on that to see.
Mike, any conclusions on the damage it would inflict on this economy? That's the data we will and won't get. What about the damage it could do to the U.S. economy?
Well, it's not going to do great long-term macro damage. It will do damage in the short run, particularly to those people who aren't paid and have to call their credit card company and say, I'm not getting paid, so I can't pay you. And there will be some lost business. People won't go out to dinner, etc. But usually, the law says everybody who is furloughed gets paid. when this is over. So what you'll see is a slight decline in GDP, maybe 0.2% a week, according to Bloomberg Economics, and then it all pretty much comes back once this is settled and people get paid. But there will be a little damage, not a whole lot. I guess the real question is, what does it do to Wall Street confidence?
True. Mike McKee, thank you, sir. Just lining things up for you, the potential that maybe we won't get some of those data points. Tony Dwyer, let's just build on some of the stuff that Mike was talking about. Let's make a list. Later this year, we could be seeing a government shutdown, student loan repayments. We've got crude back in the 90s, headwinds again for the consumer. You mentioned consumer discretionary. Given the moves we've seen recently, Tony Dwyer, is that a buy for you then?
No, it's not yet a buy until the only thing that will create a real significant, sustainable, fundamental buy that brings me back to the perma bull status, John, is when you get a real drop, not a one-time drop, but a real drop, not just in U.S. Treasuries yields, but also mortgage and corporate yields. The corporate yield for the high-yield debt yield towards my Bloomberg terminal, as of last night's close, is almost 9%. It's 8.86%. So companies don't really care about what the spread is. They care about what rate they're going to be able to get money at. And until the cost of that money comes down in the Treasury, mortgage, and corporate market, we're not going to get fundamentally bullish. And just one last thing, John, to Mike's point about the data, if you look at the revision in the prior months of the core durable goods data, you'd kind of shake your head and wonder why you look at any of this stuff. The way that they're collecting the data and the revisions that are taking place make it very difficult for a data-dependent Fed to be right.
True. And when I talk about consumer discretionary, I think it's worth pointing out the kind of names that are in that group, that bucket on the S&P 500. Massive range of names: cruise lines, Amazon, Tesla, Nike, Ford. Tony DeSpirito, with that in mind, do you like what you see, given the correction we've had so far?
Yeah, so I think one of the things to do is say, look, I'm not in the business of predicting a recession or not. What I'm in the business of doing is picking stocks. And so the way to go about this is say, what sectors or industries have already discounted a recession versus which ones haven't? And so I would call out banks and financials. On one hand, if you look at the way banks and industrials, if you look at the way banks are trading, low double-digit P's, 10 times current earnings, low price to tangible book, they're discounting a recession. And then you look at industrials, I understand the recent strength in the data, but they're trading at multiples closer to 18, 20 times. They're both cyclical businesses. So I'll just go with the ones where the pain's already discounting, and therefore that creates a margin of safety. I think that's the stock picking strategy that you need to pursue in this kind of market.
Tony, stick with us. We'll keep building on this. Tony Dwyer, Tony DeSpirito. Your equity market right now on the S&P 500, still positive, trying to bounce by about 0.4% after an ugly, brutal day of losses again in yesterday's session. Let's get you some movers going into the open. Here's Abby.
Indeed, John, a bit of a relief rally, at least right now in the pre-market. Starting out with one stock that's not helping those shares of Costco. They are down, and this despite beating in the recent quarter, down 1.7%. Investors are concerned that the company did not talk about raising their membership fee. That's seen, according to Morgan Stanley, as a slight disappointment weighing on the stock. ExxonMobil up more than 1% with oil. WTI crude back above $92 per barrel since June. This stock up nearly 20% with the crude oil rally, and clearly the best sector over that time period as well, as we've seen so much weakness for other sectors with yields higher. Coinbase Global, we have a bit of a rally for Bitcoin, John, up for the second time in just, I believe, 7 days, taking many of these stocks with it. It's an interesting barometer, of course, of risk on, risk off. If you recall, in 2021, the VIX was seen as broken, so people looked to Bitcoin today. A bit risk on for that.
Abby, thank you.
Barometer.
Abby, we'll catch up with you around the opening bell. Coming up, President Biden joining the picket line with striking auto workers.
The fact of the matter is that you guys, the UAW, you saved the automobile industry back in 2008 and before. Made a lot of sacrifices. Stick with it, because you deserve the significant raise you need and other benefits.
Team coverage down in Washington. Up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
The fact of the matter is that you guys, the UAW, you saved the automobile industry back in 2008 and before. Made a lot of sacrifices, gave up a lot, and the companies were in trouble. But now they're doing incredibly well. And guess what? You should be doing incredibly well too. Stick with it. You should deserve the significant raise you need and other benefits.
Amazing to see President Biden joining the UAW picket line, endorsing the union's push for higher pay. This is Republican presidential candidate Donald Trump counter-programs tonight's GOP debate, visiting Detroit to speak at a non-union auto parts plant. His campaign saying he will deliver a primetime speech before current and former union members. Previously, Trump has pushed back against Biden's union agenda, saying, quote, Biden had no intention of going to visit the United Auto Workers until I announced I would be heading to Michigan. Tell him to leave the car industry alone. Your team coverage starts right now with Bloomberg's Anne-Marie. Katie Lyons down in Washington, D.C. AMH, quite a scene for the President of the United States.
It was quite a scene, and we should note the White House will say that the president is not only the most pro-labor union president we've seen in American history, but now he is proving it by showing up to that picket line, taking that megaphone, and saying, yes, you deserve the raise increases you're asking for, which, by the way, the union was asking for 40%. Now they've actually lessened that to 36%. But, Jonathan, what the White House will also tell you is that Sean Fain, the UAW president, invited President Biden, and that is why he is there. It is not that he is chasing Trump's tail there, and Trump will be there this evening. And the politics of all this has to go with the 2024 election. Michigan is crucial for the Democrats. Biden picked it up in 2020, but Trump flipped this state red. It was blue since it was red. It hasn't been red since the late 1980s. And Jonathan, he won it by 10,704 votes. These are the voters that both these men are trying to take a hold of for next year.
They're the fine margins that you just talked about, AMH. Katie Lyons, where does this leave Donald Trump today?
Well, it leaves him wanting to, as Anne-Marie said, also address these people, these working class individuals, many of them who are auto workers. Now, as you pointed out, John, he isn't here at the invitation of the union, which is why he is speaking at a non-union shop this evening. Sean Fain, the president of the UAW, has pretty much openly expressed displeasure with Donald Trump. He said just recently he doesn't think Trump cares about the working class people. He thinks he cares about the billionaire class. And he goes on to say he's just trying to pander to people and say what they want to hear, and it's a shame. So there's a clear split between Trump and union leadership, even if he may be speaking to some union members this evening with this message that the EV push that President Biden has underway is hurting people working in the U.S. and shifting jobs overseas. All that said, as much as Trump is trying to address workers this evening, he also is trying to counter-program the second primary debate that is happening out in California this evening. That's where 7 other presidential candidates will be, probably having to address the elephant very much not in the room. What is interesting, though, John, is Asa Hutchinson, the former Arkansas governor who did not qualify for the second debate, is going to be counter-programming Trump's counter-programming. He's also going to be in Detroit this evening holding a press conference, and what his campaign says is he's going to be highlighting Trump's false promises to blue-collar and union workers in Michigan and across America. So there's going to be a lot of split screens this evening, John.
A fascinating 24 hours ahead. Kelly Lyons, thank you. AMH to you as well, down in Washington. Tony DeSpirito, straight to you, sir. GM for the best part of a decade. That stock, dead money. Ford for the best part of a decade. That stock, dead money. Are these names investable, Tony, from your standpoint? Tony DeSpirito?
Yeah, so I'll comment upon the auto companies generally. Look, it's actually, forget the stock prices, look at the earnings power. The earnings power of these businesses has done quite nicely, despite the flat stock prices. And so to me, I actually see some opportunity there, particularly when you run any kind of sum of the parts math. Take any kind of investments, in overseas businesses, U.S. business, their auto finance business, add that up. And these businesses are trading at substantial discounts, right? There's a lot of fear over wages and whatnot, but even when you take that into account, I think there's a lot of opportunity in the auto sector.
And Tony Dwyer, your take?
Well, until rates go down, I don't think you're going to get enough of an increase in demand to surprise to the upside in earnings, as Tony mentioned. The earnings are up, but the earnings power is there, but the stock's flat. So it's going to take something different. And I think for this, as well as all consumer space, I think you're going to need a much lower interest rate environment that increases. Remember, John, that when we go into recession, the market bottoms during the recession, not because the data is great, but because the lower interest rate environment improves the outlook for money. You know it's going to get better when interest rates are significantly and sustainably lower. You really need that to kickstart the consumer space, whether it's autos or other areas.
Tony Dwyer, you know the sequence of events. You throw up bond yields. They start to hit equity markets. The pressure builds on some of those corporations to do something about margins because revenue's not so great. Where's the margin expansion going to come from? Tony Dwyer, at names that may have to confront 40% wage increases in certain parts of their labor.
That's been one of my issues, John, is that S&P operating earnings are seeing a double-digit or near double-digit margin. It never was a double-digit margin prior to 2019. So the point for us is that margins see a little bit of pressure when costs go up, but the real dropper for margins, the real margin pressure, comes with lower demand, and that lower demand takes place with higher interest rates that increase the default rate assumptions and really just the cost of labor, cost of energy, all of those things. When you drop revenue, you can't cut costs fast enough. And I think we're about to embark on that period. So our mandate right now, as you know, has been light and tight. Little extra cash, more defensive posture. Looking with the average stock in the NYSE down 30%, John, I'm not looking to get negative here. The time for that was last year. We're looking to stay out of the way and to attack as prices come down when bad news becomes bad news.
Tony DeSpirito, I've got about 30 seconds left on the clock. Final word, please.
Yeah, so I go back to this concept of where the pain's already discounted versus where it's not. And Tony Dwyer said that most companies are down 30% from their peaks. I think that's really substantial. And so I'll go back to the auto example you gave. Yeah, are earnings under pressure from wages? Yes. Do rising rates mean we won't see higher vehicle sales? Yes. But what's the earnings ratio today? The PE ratio is 5 times current earnings. You don't need any good news to like these stocks. You just collect cash flow and you'll do quite well. And I think that's what to look out for. Buy quality businesses at good prices and you'll be fine in this market.
Tony DeSpirito, thank you, sir, for your take. Tony Dwyer, to you as well. Tony, your equity market on the S&P positive by 0.4%. The opening bell about 7 minutes away. Coming up in the morning calls and later, RBC's Amy Wu Silverman joins us around that opening bell with her thoughts on why tech exuberance is waning. That conversation just around the corner.
younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Three-month lows on the S&P 500, just a little bit of a bounce on the S&P by 0.4%. As the price action, here's some morning calls. First up, TD Cowen initiating coverage of Levi Strauss with an outperform rating, seeing the company well positioned to grow direct-to-consumer engagement. HSBC upgrading DocuSign to hold, seeing the company making progress in stabilizing revenue. And finally, Gordon Haskett downgrading Burlington Stores to hold from buy, 137 price target, citing links to the company's Q4 same-store sales growth view. Coming up on this program, we'll turn to tech with RBC's Amy Wu Silverton. That conversation is coming up next.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Names in business choose Bloomberg.
That is a great question.
It's a great question.
Great question.
question?
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
High-end conversation about Travis Kelce in the commercial break that you don't need. Believe me. Your equity market futures bouncing by 0.3% on the S&P 500. On the NASDAQ up by about 0.25. 3-month lows on the S&P, the lowest since June 7th. We're trying to bounce. That's your opening bounce. Switch on the board and get to the bond market. Bonds taking a bite out of this equity market worldwide. Yields on a 10-year. Cycle highs over the last couple of days. 451, pulling back a couple of basis points this morning. In the FX market, the dollar strength sticks. The euro weaker, 105.31 on euro dollar, negative 0.4%. The dollar at the strongest point of the year so far. Dollar yen pushing 150, 149.20, and crude. Even with the dollar strength, commodities breaking out, 92.38. Crude right now up by more than 2 percentage points. That's the cross-asset price action. Your opening bell about 30 seconds behind us. Your equity market open looks like this on the S&P, up by 0.3%. On the NASDAQ, up by 0.4. One stock to watch at the open is Paramount, the company in focus after the Screenwriters Union approved a new contract with the studios and ended their strike. Other Hollywood-tied stocks, including Warner Brothers, Disney, Netflix, also taking center stage. Abby has more. Hey, Abby.
Hey, John. Well, at 12:01 LA time today, the 5-month dispute, bitter battle between the Writers Guild and the big entertainment companies, it ended as the Writers Guild, the screenwriters, did approve a deal. Now, they got the 3 big demands that they wanted. First, they got a pay boost. They also have a piece of the action for some of the streaming shows that do especially well. Second, shows will have appropriate staffing level. And third, they've received a reassurance that AI will not be replacing their jobs. Now, the stocks are up modestly this morning. I think, John, what folks, investors are really waiting for is the possibility that this deal could suggest that the SAG strike, this, of course, is the first time in more than 60 years that both of these entertainment unions had gone on strike together, that it will be resolved. And that could really help out Warner Brothers and Paramount in particular. Since these 2 strikes have started, roughly Paramount down 50%, Warner Brothers down about 20%. So an overhang could be removed. And right now we do actually have a pretty decent rally, up more than 1% for most of these stocks.
A decent pop there. Abby, thank you. Early days, about 2 minutes into the session. Let's turn to EVs. Rivian gaining after Baird analysts named the company, quote, a bullish fresh pick. We see Q3 deliveries as a near-term catalyst and expect sentiment to improve. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. It's been a short-lived open for Rivian, now basically flat, having been as high as 1.8% following the market open. Yesterday, the stock jumped by the most amount a month after that RBC note. What they're focused on is quarterly production and delivery figures. You'll remember that Rivian recently raised guidance by a modest 2,000 units to say they will produce 52,000 electric vehicles this year across their 2 consumer brands and the delivery van that they build for Amazon. But there's always been a debate about how conservatively Rivian's been playing this. You'll remember, John, that I reported in March that Rivian had told staff that its manufacturing blueprint, its plans, showed that they were capable of building 62,000 EVs this year, 10,000 more than they're currently guiding. So the question, I guess, is how much further above guidance they're going to go. This is an EV name, pure play, that is kind of not in the same category as the other startups that have struggled. But remember that they have a plant in Illinois that is capable of building 3 times what their current guidance is. There are questions about demand, but recent commentary from executives, the CFO and CEO at investor conferences has been quite bullish about the demand that's out there, particularly bearing in mind that the two consumer brands carry a premium price point. This stock's up 22% year to date, John.
Pretty muted price action this morning so far. Ed, thank you in the first 3 minutes of the session. Let's shift to retail. Costco fluctuating despite an earnings beat. The big box giant staying silent on the timing of its increase in membership fees. Simone Foxman on this story. Hey, Simone.
Hey, John. Yeah, Costco pointing now a little bit higher after some post-market losses after these earnings came out yesterday. There's a bit of a mixed bag here. Earnings per share beat analyst expectations, coming in at $4.86, but comp sales coming in a little bit weaker than anticipated, especially when you include the impact of currency and gas. Overall, we're looking at 1.1%. The street had been looking for about 1.8%, especially seeing a little bit more weakness in the United States. The company's saying it's seeing those customers
Trade down, big ticket items purchases still weak. So a lot of the interest there on the lower margin stuff, the food and that sort of thing. Shrink, however, not a big issue for Costco. Markets have been focusing, and maybe we're focusing yesterday as we saw some of those post-market losses, on what was not being said. The company did not talk about a fee hike. That is something that some analysts wanted, but people in the store is encouraging traffic growth more than double what Wall Street had anticipated, and the number of paying card holders coming in at 71 million. Again, that's up almost 8% from a year ago. Re those fee hikes, the CFO saying it's a question of when, not if. Surely markets would like that to be sooner, but we're already looking at shares up 21% year to date, John.
The hot dog is still $1.50. Am I right? Is it still $1.50?
You know, I haven't been to a Costco and bought a hot dog recently. So
okay, that's a big deal at Costco. Anyway, Simone, thank you. Thank you very much. Let's stick with Costco. Cowen raising its price target on the stock to $680 from $600. Analyst Oliver Chen saying this: we believe Costco is well positioned to continue delivering robust earnings growth over the near to medium term, driven by square footage growth, membership revenue growth, and industry-leading comps growth on strong physical and digital momentum. That stock is up by about 0.1%. I want to turn to entertainment. AMC expanding its screening of Taylor Swift's concert film to more than 100 countries beginning October 13th. Katie Greifeld has this. Hey, Katie.
Hey, John. Yeah, great news. If you can't catch it in North America, like you said, about 100 other countries will also screen Taylor Swift's Eras Tour moving beginning October 13th. I'm sure I'll see you there. Now, tickets for the international locations, they went on sale yesterday, and prices vary by country. And this is a big deal for AMC. Remember, when this movie about the tour was announced last month, it was met with record-breaking demand. It actually, in the first day, saw $26 million in ticket revenue, and that is the highest advanced sales revenue in AMC's 103-year history. And AMC, it needs some good news. Remember, the company announced plans to sell up to 40 million shares earlier this month after getting those court approvals. That has shares down 37% this month alone, and not a single analyst tracked by Bloomberg has a buy rating on the stock. But the Taylor Swift movie coming soon.
You're not going to see me there, Katie.
I don't know.
Just for the record, you're not.
She's the voice of a generation, John.
It's not going to. Okay, Katie, thank you. Thank you. Katie's going to be there, basically, is what you're hearing there, based on that delivery. Katie, thank you. Let's turn to the bank. Serious story. Not that that wasn't a serious story before I start getting hate mail about Taylor Swift. Bloomberg learning that the U.S. Justice Department is stepping up its probe of Credit Suisse and UBS over suspected sanction breaches. Shonali Basak has the latest. Hey, Shonali.
John, when you look at what is happening now, you have the Department of Justice going to UBS officials and saying that there are these suspected violations when it comes to Russian clients over at the Credit Suisse Wealth Manager. Now, this is a classic problem. When you buy somebody's house, you don't know always what's in it. The UBS CEO Sergio Armati has moved very quickly through the summer to resolve a lot of outstanding investigations when it came to Credit Suisse, amounting to fines in the billions of dollars. We're talking about fines tied to Archegos, fines tied to pre-2008 RMBS matters. So coming into this new era of a potential new investigation that is still in its early stages leads to an overhang for Sergio Armati that is quite unwelcome. Now, we don't know the scope of what this could cost them in the longer term, but remember, as we've been saying, this is in the early stages of an investigation, and it ties back to a larger issue that the Department of Justice has privately voiced. According to Bloomberg's Hugo Miller and Ava Benny Morrison, this is a frustration at seeing Switzerland and not doing enough to enforce sanctions when it comes to Russian individuals in this era. So we have a larger issue at play, and UBS is certainly caught up in it.
Shonali, just help me understand this a little bit more. Are these failures at Credit Suisse, which ultimately UBS inherits, or is UBS in the firing line as well for things they've done previously before this acquisition even closed?
It's a little bit of both. According to our reporting over at Bloomberg, it's largely Credit Suisse. But you have to remember, UBS apparently, according to my own sources as well, has known that there could be issues in the wealth manager when it comes to their clients. They didn't know the extent of what all those issues would be. And UBS itself, they are looking at UBS. Remember, this initially started as a sweeping kind of a set of requests to a larger set of banks. UBS is definitely being looked at as well, but largely these issues are tied to Credit Suisse.
So, Shonali, as far as I understood, Sergio Armati and UBS gave up that state guarantee for legal fees that they agreed to several months back in the spring when this deal was basically explained to us all. Shonali, why did they do that? Did they not have a decent understanding of where this might be going?
Yeah, they did not. And that it was part of the problem. Remember how quickly this deal came together, John? There was a very implicit understanding. I also will have to say that for so heavily into wealth management, this is the ugly side of wealth management. And it is something that Sergio Armati, Colm Kelleher, they know that this could be an issue moving forward. They did not know the extent of the issues. And again, this is another thing that they could face as an overhang for months ahead.
Our Chief Wall Street correspondent, Shanali Basso, breaking that down for you. About 9 or 10 minutes into the session, that stock, of course, trading over in Swiss trading, but here in the United States, we're down by about 3% or so. I want to turn back to tech. Amy Wu-Silverman of RBC Capital Markets noting a decline in, quote, tech exuberance, writing this: when we dig into what the options market is pricing for mega cap tech, it is mostly that bullish sentiment has waned. Amy Wu-Silverman joins us right now, I'm pleased to say. Amy, you were warning about higher volatility. Here it is. Is there more to come?
Here it is indeed. And yes, unfortunately, I think there is also more to come. Look, even if we strip out everything that's going on, John, UAW, debt ceiling, geopolitics, it's just seasonally a very strong month for volatility in October. Going back 20 years, this is typically a time when you see volatility picking up. And unfortunately, we have a lot of muddle through catalysts to go through, which suggests to me that we're still going to get that bid in volatility.
Got all these headline risks on the horizon, including the shutdown. Is that something you're focused on at all, Amy?
Yeah, unfortunately, I wish I didn't have to. I feel like we watch this movie again and again and again. And we kind of have to just go through it. But I just want to remind folks that, in 2011, this was an issue that brought the VIX to 45. I don't think we're going to get there, but the problem is because there is historical precedent for some of these spike type events, you just can't ignore it. You have to muddle through with it. And hopefully it's something that we can just digest. But until we actually do digest it, the market certainly has to price that into its volatility surface.
Amy, Mike McKee was on the program a little bit earlier this hour, and he was talking about the data points we might not get if the government does shut down. Does that, do you think, put even more emphasis on the bank earnings we get later in October, in the middle of next month?
It certainly does. And the other thing I think it does is it's going to change what we seasonally expect in the later months of the year. So just as October of the last 2 decades is a time where volatility picks up, usually we get a decline in volatility in November, December. But if we're going to push forward these data points and you're going to get them all at once later in the year, unfortunately, I think the market has to brace itself for even a higher VIX in those later months as well, John.
With that in mind, what are you advocating for with clients at the moment? What are you suggesting they should do?
Look, this has been a struggle for, I'd say, at least the last 2 years, where put-skew has been underperforming and hedges haven't really been doing well. I think the major difference now is if you look from 2 months ago to now, folks have jumped in the pool, so to speak. There's much more participation in areas like mega cap tech or just overall in the market than there was before. And so, look, you have something to hedge, and those hedging levels have been extremely low this whole time. And I know that's sort of a boring thing to talk about, but at least there are events now to catalyze that low volatility where I think that didn't exist in the summer.
What have they been hedging? Amy, when you think about it, I know you've picked out, let's say, Apple and the bearish sentiment around that name. Is that about rates in the bond market? Is that about China? What is that about?
Yeah, so it's interesting. In Apple in particular, this is a name where if you look at mega cap tech, if you look at that Magnificent Seven, most of what we're seeing in option sentiment is just a decline in exuberance. So folks just aren't that bullish anymore. Whereas in Apple specifically, you are seeing hedging. You've seen that even with the 10% move down in Apple. I think that's very China related, but I also think it's the fact that, again, you had that massive move in participation. And now because you have that length, that's continuing to be there as you get data points in China. The other areas we're seeing are stratified. So you're seeing hedging in Canada, for example, and you're seeing hedging and other parts of the market like the credit-related ETFs, but it's all stratified hedging, John. It's nothing where I can say the full-on market level SPY, IWM, they're seeing a lot of pickup in demand there.
I think we can all appreciate how frustrating it is to talk about a potential for a government shutdown. Amy, appreciate the update. Amy Wu-Silverman there of RBC on a potential for a shutdown and everything else going on at the moment, looking for higher volatility. About 14 minutes into the session, equities up here by 0.25% on the S&P, on the NASDAQ bouncing back by just 0.5%. Coming up, we'll talk about it. Lawmakers scrambling to avoid a shutdown.
We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Team coverage coming up next.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
We'll be bringing up 4 of the appropriation bills we've been trying to do since July. Finally, we got the members together to be able to make that happen. If we're able to finish those 4 along with the ones we already, that would make it 73% of all the discretionary funds that we're supposed to appropriate for this time. We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Speaker McCarthy fighting for his party's votes as the House and Senate charge ahead with rival spending bills. The U.S. still on track for a government shutdown at the end of the week, despite incremental progress. President Biden playing the blame game, saying, quote, funding for the government is just a basic responsibility. It's time for Republicans in the House of Representatives to start doing their job. Economic fallout of the potential shutdown expected to grow the longer it lasts, impacting everything from federal salaries to GDP to the next Fed decision. Let's get your team coverage. Bloomberg's AMH in Washington and Ira Jersey. Anne-Marie, where is this one going?
Well, Jonathan, as you said, it's incremental steps at the moment, baby steps to potentially keep the government open. But the track that they're on, it does look very likely that the government will be shut down come October 1st. So you have two different issues at play here. One is the Senate side, and they are putting forward their own stopgap funding bill. I call it very vanilla in terms of what's in it. Keeps the government open just 6 days before Thanksgiving, so through November. And it does come with some Ukraine aid and some disaster relief aid. The issue is Speaker McCarthy can't put that on the floor because those hard right members of his party, like Matt Gaetz, already says that there'll be a motion to vacate, aka fire him. So what Kevin McCarthy is trying to do on the House side is show goodwill to some members of his party. They were able to get through late last night just getting bills on the floor to debate. That's something he wasn't able to do last week. And he says once that's through, these are full year spending bills. Once that's through, they'll look at a continuing resolution, a stopgap measure. But it comes with deep cuts in discretionary domestic spending as well as immigration provisions that the Democrats will not sign up for. So then there's potentially this third option, Jonathan. It's called a discharge petition. And what you could see is some Republican moderates signing up with Democrats basically over Speaker McCarthy's head, taking control of the floor and voting through pretty much a clean stopgap measure. The issue is, Jonathan, this has happened only twice in this century. So it's anyone's guess on how this gets done this weekend.
Fun and games, it's always a mess. Ira Jersey, whenever I try and talk to people about this at the moment in the market, they just shake it off. They don't want to talk about it at all. Ira, what can we take away from this that means something to what you do every day?
Well, I think there'll be some volatility, and presumably one of the outcomes of this will be slightly slower growth in government spending over the next 4 or 5 years. And that ultimately might be modestly good for the Treasury market, because one of the things that's pushed Treasury yields so much higher of late is the idea that and the fact that we're getting larger deficits than the market was originally thinking. So there is a potential positive outcome for Treasuries in this whole mess, but at the same time it's very uncertain, and clearly volatility in markets might pick up a little bit. Something important to note, though, John, is that this is not like the debt limit issue that we had back at early June. We're not talking about defaulting on the debt. We're not talking about Treasuries not being issued. The Bureau of Public Debt remains open. The Federal Reserve remains open, and we will continue to roll over debt and issue new debt as well. So that is a whole thing is off the table.
Anne-Marie, final word on the GOP debates a little bit later. Is this going to be a feature of that conversation, fiscal austerity?
Oh, absolutely. Fiscal austerity, and also what these individual candidates would do in terms of their advice for their Republican Party in the House especially. And Jonathan, we've seen a wide spectrum of that. We know from reporting that Governor DeSantis has been calling some of them, saying, yeah, maybe potentially shut the government down. The former president, Donald Trump, who won't be there, be doing his own counter program, which we spoke about earlier, in Michigan, he said, hold the line, shut it down if you don't get everything you want. And there's going to be others like Governor Nikki Haley, which says we have to keep the government open, but we need to also make sure they're doing their jobs in terms of fiscal health for this country.
The Fox Business hosting that one a little bit later. Want to watch. AMH, thank you. Alongside Ira Jersey there on this bond market. Your equity market, better than yesterday, that's for sure. So far, at least. Let's see if this sticks. About 22 minutes into the session, we're positive here by 0.3%. Let's get you some sector price action. Here's Abby.
And John, based on the bearish action we've had recently, that's just the second up day in 7, but let's see if these gains hold. And sector-wise, it suggests that maybe that could happen. The composition is not so shabby. Energy, the best sector, up 1.3%. We also have communication services, real estate, tech up there. Utilities and staples and healthcare are among the down sectors. Actually, healthcare just flipping slightly positive. Those are defensive, so the fact that they're down, in a way, that's risk on. Over the last 3 months, though, John, and of course we are coming close to the quarter end, most sectors are down. Energy up with oil. Communication services also higher. But take a look at those rate-sensitive sectors. With yields going higher, those dividends look less well. Those sectors are worse, even down more than technology.
Abby, thanks for that. Your update up next. The calendar for the week ahead, your trading diary, just around the corner.
always just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Minutes into the session, stocks higher across the board here. Outperformance on the Russell, the small caps, the S&P up by 0.3%. That's the price action. Let's get to the trading diary. The week ahead looks like this. Donald Trump speaking to current and former UAW members at 8 p.m. Eastern as the second 2024 GOP presidential debate kicks off at 9 p.m. Thursday, the Fed speak picking up with Chairman Powell, Goolsbee, Cook and Barkin. Plus, we get US GDP and another round of jobless claims. And finally, the government shutdown deadline coming at midnight Saturday. I'm sure you can't wait for that. About 26 minutes into the session, your equity market just about positive by 0.3%. Thank you very much for choosing Bloomberg TV. Good to be back in a seat. Thank you very much for all the feedback over the last week as well. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. Trading Day, Wednesday, September 27th. Here are the top market stories that we're following for you at this hour. Trying to stay airborne, the World Aviation Festival underway in Lisbon, confronting supply chain issues, slow business travel, and a tight labor market. Guy Johnson's going to talk to IATA's General Director, Emirates President, and Dubai Airport's CEO. And taking a break, the equity sell-off takes a breather. Bond yields fall, at least on the long end. We're going to speak to legendary investor Greg Littman of Max Capital on where he sees opportunity in the market. And sanction crackdown, the DOJ stepping up its probe of Credit Suisse and UBS to see if the banks helped Russian clients skirt some sanctions. We're going to get you the latest. From New York, I'm Alex Steele with my co-host in London, Danny Berger. Guy Johnson is on assignment. Welcome to Bloomberg Markets. Danny, I'm having a little bit of a time making a big deal out of any kind of movement we're seeing because it just feels like a rally off of a low, right? Like we've seen a brutal couple of days, and now we're just seeing a little bit of calm.
Yeah, it doesn't even feel like a rally, to your point. It feels like a pause, a time for reflecting of what we've seen after all those central bank decisions. Has something fundamentally shifted? We certainly see it in things like the most positive term premium, if I can find my word, something we haven't really seen for the past 7 years.
Yeah, and you take a look at, say, the S&P. S&P futures bounced off its 200-day moving average, right? So to me, it's no surprise that we're seeing a little bit of follow-through here, but it is an energy story, and we're still well below the 100-day moving average. So the technical signals still leave me a little bit of question. But, you know, to your point, Danny, we talk about term premium, but we broaden that out. It's really about broader risk, right?
It is, and it brings us to our question of the day. Are you getting paid enough to take risks, be it duration, be it stocks, be it really anything? After what we've seen over the past 2 weeks, are you getting paid enough to jump in? Joining us now to help discuss that is Bloomberg's Michael McKee and Ira Jersey of Bloomberg Intelligence. Ira, if I can start with you and start with the term premium. Look, it's math that boggles my very basic mind, so I don't want to get too much into the details of it. But what has changed with a positive term premium? What is that telling us about the world we are in right now?
It tells you that a model says that the term premium is positive. The way that I look at term premium, it's like dark matter, right? We know it must exist, but we can't observe it. And I think that that's one of the challenges that we have using models like term premium models to determine, hey, are we being compensated for the risk of holding an instrument that's 5 years or 10 years in length? And it's hard to say that that's the case when you have the yield curve inverted as much as it still is. And at the end of the day, to your question, is the market priced appropriately given the preponderance of where outcomes could be in the next 3 to 5 years? And I think the answer to that is that in the Treasury market, we probably are now priced even with yields higher than where they probably ultimately will be. Because eventually, especially if the Fed does what it said it will do last week, something's going to break. We're going to have a recession at some point. And when we do, you can wind up seeing a reasonable return. If nothing else, you're going to get 4.5% over the next decade if you buy and hold a 10-year note.
Right. Maybe it's not price appreciation, but you're still getting the income play. Mike, to you, are you getting paid enough to take some risks? Obviously, we're zeroing in here on the term premium.
Well, I was just thinking, Ira, pay the man. He said it all. That's pretty much what it comes down to. When you look at what the history of rates has been over the last 30, 40, 50 years, basically since Paul Volcker took over at the Fed and brought down inflation, what you've seen is that inflation and real rates tend to run at about the same level, and they were around 2% until the Fed artificially pushed down yields after the great financial crisis. Now, we've built a sort of infrastructure around the idea of extremely low or near zero interest rates over the last 10 years, and that's going to be hard for people to break out of. But I think Ira is exactly right. That we're probably settling at where we will be going forward as far as we can tell right now. Obviously, we don't know what's going to happen with any recession or whether or not our star is going to fall back and we're going to see extremely low rates again. But at this point, it looks like we've priced to about where you would expect us to be based on longer history than we've been looking at.
And Mike, I'm taken back to the presser you and your peers were at of Fed Chair Powell talking about duration, the long end of the curve, saying that, look, it's not acting based on inflation. Something else is going on. It's growth and it's supply. You think of something like Treasury supply. I mean, that's wholly out of the Fed's control. Do we need to be reevaluating risk right now that it goes beyond just rates and inflation?
Well, of course, you've got to take into account supply, and the market's been doing that, which is one reason you're seeing this big rise in yields, because some of the biggest buyers that we've had for a long time are now out of the market, including the Fed. They're getting rid of longer-term treasuries, and so that creates a problem in trying to sell them. And the problem we have is that I guess Washington didn't think this through and should have issued a lot of debt to do infrastructure work when rates were at zero. Instead, they're issuing debt when the Fed is not buying stuff and when some of the foreign buyers have cut back. And so we're going to end up paying more for stuff than we would have if this had been done the right way.
Yeah, in the France budget today, just looking how much interest payments have moved in the last few years was truly staggering. You know it's a super hot day when you're talking about term premium at the top of the 10. Like, I'm just putting that out there, Ira. So to that point, what's the next catalyst? Like, what's really going to juice the market here?
Well, I think when you're talking about risk assets, you're talking about credit spreads or equities, it is probably my market, right? It's the rates market, and where do we think that, where ultimately do we end up, say, at the end of the year? It could be that we have a good news is bad news and a bad news is good news kind of thing going on for the next 3 months, because if we do have a significant economic slowdown, which is still the base case scenario that Bloomberg Economics has, and if we have a recession in December, January, February of next year, you can wind up seeing Treasury yields maybe rally 75, 100 basis points, and I think that helps boost valuations in some other sectors, in the risk asset sectors. So there is this interesting risk dynamic that could wind up going on over the next few months, not necessarily because profitability is going to be good or anything else. It just has to do completely with valuations. Fair value on 10-year Treasuries right now, according to our model, we literally ran it this morning, is 4.48%. So, we're not completely, undervalued or overvalued compared to where we should be, given the preponderance of all the data that we have.
Really great combo, guys. I appreciate it. Bloomberg's Michael McKee and Ira Jersey of Bloomberg Intelligence. Okay, now we want to head to Lisbon, where my partner in crime, Guy Johnson, is at the World Aviation Festival. Guy is in his element. This is his jam. Guy, it's good to see you. What were some of the big takeaways for you so far?
The takeaway is that my jam is your jam. This has been an energy conference, Alex. This has been a conference in which fuel prices have been dominant. It's a conference at which the future existence of aviation as we know it has been called into question because of the ultimate expense of sustainable aviation fuels. Not just the current generation sustainable aviation fuel, but eSAF. Yes, I got there early. I'm using those words, which is basically carbon capture, carbon and hydrogen put together to produce fuel. It's going to be really expensive. And the key question, Alex, is are we ultimately going to see many people priced out of flying because flying is going to become so expensive? So at the moment, the view is that, yes, fares may go a little bit higher because of jet fuel being where it is right now, but the market can cope with it. The move into sustainable aviation fuel could be a whole different matter. The feeling at the moment is that demand is strong enough to cope with Brent at 100, but the next few steps over the next few years could be really quite interesting. So it's been nice to be here. It turns out that my jam is your jam, which is great. What I get out of this trip is a few tins of sardines. I thought I'd better get you something, Alex. And what I got you was this.
Notwithstanding oil as it is, as I said earlier, it'll settle back. We've been up at 100, 110 before. Crack spread is a worry. But so far, the markets are taking the price points that are a result of what we're having to face to deliver the margins that we need to keep going.
Sir Tim Clark, Alex, talking about energy and using those dreaded words. He wasn't the only one. I have heard it a number of times. We're going to hear from Willie Walsh a little bit later on in the program. Crack spreads. Apparently, crack spreads are a bit of a problem because everybody wants diesel, and therefore the crack spread on jet fuel is very, very high, and nobody's happy about it. I can't believe that that is what has happened here. But everybody's been talking about crack spreads.
You're welcome. This actually is quite a gift to me. But I think it actually raises the point that the product market is what's tight, particularly when you take Russian sanctions of certain exports for product off the table. That's where the market is super tight, which is really bad news for the airliners. ESAP and crack spreads, 10 a.m. This is where the nerds stay. Guy, just a quick question. Did you get sardines? Because there is a shortage of fancy sardines in the UK right now for Guy.
So there has been a bit of an issue with acquiring the sardines, the tin sardines that I like in the UK. There are lots of tin sardines here. So Angel, my producer, and I, we went out last night. We got tin sardines. We got tinned octopus. We got tin prawn. They're delicious. They all look absolutely fantastic. The only downside, Alex, is that it is not sardine season. So fresh sardines, not on the menu here. But the tin sardines are freely available. I'll be bringing them home. I'm looking forward to sampling them. I get something, I get sardines, you get the crack spread.
This is a good partnership. I'm glad we had this talk. All right, Guy, you're going to be back. Thank you very much. Bloomberg's Guy Johnson. We're going to have more with Guy from the Aviation Festival. We're going to bring you his conversations with IATA General Director Willie Walsh, Emirates President Tim Clark, and Dubai Airport CEO Paul Griffiths. So stay with us for that. Coming up, though, more on the question of the day: are you getting paid enough to take risks, and where? Kelly Cox, eToro investment analyst, is with us next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
We're starting to see the consumer certainly under some pressure.
Weakness in the consumer.
Consumers are going to be facing some headwinds here.
The market doesn't like the strong economy keeping interest rates higher for longer.
Even 50 basis points higher from here really will start to impact the consumer.
Consumers continue to complain about inflation being elevated.
Higher oil prices.
They're still concerned about the labor market and their personal finances ahead.
The trend in yields is up.
Yields are rising.
You have to ask the question, is this last move up in yields the signal that we're end of cycle?
You always have that kind of last kind of move
where people throw in the towel. And I think that's what we're going through.
I think from here, the consumer slows.
There's a real spending issue coming up, and I think that that's going to impact earnings.
Bond yields being higher and our Fed that's higher for longer is going to continuously put pressure on just the broader markets.
The risk for the fourth quarter is, can the consumer continue to surprise on the upside?
Consumers are getting it right and saying, look, there's trouble ahead.
Those were just some of the voices who've been speaking with Bloomberg TV, which is funny because Norwegian Cruise Lines is one of the top performers right now in the S&P, so something gives. That leads us to the question of the day: are you getting enough to take risks? Are you getting paid to take risks, and where? Callie Cox, U.S. investment analyst with eToro, joins us now. Callie, what do you think? Are you getting paid enough?
Well, first of all, I think it's a loaded question, but I think you have to remember, I mean, you can get 5% on cash right now, so that's your hurdle rate right there. But, you know, if you look around pockets of the stock market, I think you can still find value. You just have to be very careful and understand what your time frame is, because, you know, we're in an odd environment right now. Inflation is picking up. You know, the economy looks strong. That's good news. But it also, you know, makes things tricky because it gives you more choices on where to put your money.
So where are those pockets of value, Callie? Where do you see them?
All right, so when I'm thinking about pockets of value, I'm thinking about cheap cyclicals if the economy keeps growing at this moment. You know, we think there's immense pressure on the economy right now, so it may not grow this quickly for very long, but it certainly is resilient. So I'm looking at, you know, banks, for example. You know, energy has popped up as an interesting place to put your money. Just looking at valuations, I mean, a lot of cyclical sectors outside of tech are below their 5-year and 10-year PEs, and I think earnings season could actually give you a point to get in there.
If the economy rolls over, though, are they cheap enough to maintain that risk?
Yeah, so this is where time frames come into play.
Right.
So if you're looking over the next 1 month, 2 months, I mean, it looks like the economy is chugging along quite nicely. So maybe, you know, look at value, especially when interest rates are high. And when I talk about value, I mean cheap cyclicals. Beyond that, though, I think it's really hard to say that rates will stay this high over the next year, 2 years or so. And I think you have to remember that if you're in cash, which, you know, many individual investors are. You're getting 5% right now, but will rates go much higher with so much pressure on the economy? I'm not so sure.
Callie, I mean, you have someone like Jamie Dimon saying we could get to 7%. You had a lot of folks who thought this was the year of the bond market. It didn't happen. Rates kept moving higher. When you look at the sell-off we've seen in duration, do you want to follow that trend? Do you think or do you want to buck that trend, rather? I mean, do you want to buy the dips in the bond market, given what you're saying, that you don't think that the Fed can last at these levels for much longer?
Yeah, I think it's worth bucking the trend, especially if you are that longer-term investor. I mean, I've been saying for a while, I cannot believe that yields are staying this high for this long. And I think that's a testament to the economy as well. I mean, we're not seeing inflation expectations pick up in many markets, but at the same time, we're seeing yields rally. And some of that could be technical. It could be forces that you can't explain with the economy. But I do think a good part of it is just the markets catching up with how strong the economy is. However, rates are high. Again, a lot of pressure, and inflation has come down a lot for a reason.
Do you just want to like go buy the bond and get the income versus appreciation, or is that not where you want to be at?
Well, the income is a sweet deal, right? But if you're at the point where you think the economy will slow from here, and the economy is doing really well, chances are it will slow from here. You know, you can take comfort in the fact that treasuries usually do outperform during recessions. I know correlations have been a little bit weird recently, so you do have to keep that in mind. But again, you have that income, and I think the guest before this mentioned this. I mean, 4.5% a year is not too bad given the risk that you're taking.
On the correlation point, Callie, in a world where bonds and stocks are more positively correlated, what do you do with portfolio management? Where do you turn to? Does something else become the tonic when there are tough tides?
Well, I think you have to look at a variety of markets, and that's what we've been telling customers too, because we've gotten a lot of questions around this. You know, if we do hit a recession or a snag in the economy, you know, what happens to my money? I've already been burned by this before. So we've been telling people to, you know, explore different markets. I mean, gold could be an interesting one at this point. You know, we also have a lot of crypto customers, so we always encourage them to, you know, look into crypto, look into Bitcoin, you know, as a possible hedge against the system. But, you know, don't rule bonds out of the picture. Just don't stand up a market just because you're not sure if it will provide the kinds of returns in, you know, different economic scenarios.
If that volatility pick up, finally, does that increase as the economy rolls over? How do you see that playing out?
Well, if you're talking about the VIX, I actually think the VIX is showing us something really interesting right now.
Okay.
It hasn't hit 20, even though the S&P has sold off 7%. And that's the biggest S&P sell-off where the VIX hasn't hit 20 since 2005. And I think there are a lot of market structure angles for this, not ones that the average investor should really worry about, but I think it's just another area where you may not get paid for the hedge that you're taking. So you have to think about that if you're looking into options. Understand that hedging the broader market may not give you the payoff you deserve. Think about looking at single stocks, hedging through there. ETF options are another good choice.
Kelly, only about a minute here, but the calls for $100 barrel oil have been picking up. JP Morgan says we're heading towards an oil super cycle. How would $100 a barrel oil change what you just told us? Does it change your calculations for the attractiveness of risk?
Well, you have to think about what higher oil prices mean for economic data and then for the consumer, I believe. So, inflation has been picking up because of energy prices, because of oil prices. And oil is in a supply crunch right now. I mean, I think it's tough to make an argument that higher oil prices are because of higher demand. But at the same time, we don't know how long the supply crunch lasts. And it's a little harder to predict because it is supply focused instead of demand focused. So I say that to say, inflation data, may tell us that the economy, is staying stronger. It may increase inflation fears there, and that may keep yields higher. So I think you have to think about that in terms of how, you consider what kind of rates you can get and, how you're looking at yields. But, if you're in cash, that means higher yields for longer, and it also encourages you to look at value.
All right, Callie, wonderful to have you on. That is Callie Cox of eToro. Okay, still ahead, OpenAI seeks a $90 billion valuation. The company is now eyeing a possible share sale. We're going to have details for you next in The Startup. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
It is 23 past 7 on the West Coast. Let's get to the startup. We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its gorgeous morning. Bloomberg Technology co-host Ed Ludlow joins us. Ed, we miss you here. Nevertheless, that was a nice shot. So OpenAI potentially seeking a $90 billion valuation and a possible share sale. This is according to the Journal. That is enormous.
Yeah, when OpenAI did its share sale back in April, 300 million dollars worth of shares, it was valued at around $29 billion. So this is a ginormous jump. One point on what the Journal is reporting is that this would be an insider share sale, valuing the company at up to $90 billion, give liquidity to long-time employees, not offer new shares. But the cap table's so interesting, right? Of the money raised to date, 10 billion of it has come from Microsoft. Microsoft owns about 49% of OpenAI. But then you go to some of the financials, and the journal actually reported something that I had already reported, that revenue this year for OpenAI is going to be about $1 billion, but grow big time into next year. Does that justify a $90 billion valuation? That's an impossible question to answer.
I mean, Ed, the time is maybe right for AI-related big tech to IPO in a post-ARM world.
Yeah.
Is that in the cards?
It's a great question, but Sam Altman has basically said no to an IPO for OpenAI. Remember that this started as a not-for-profit, and then OpenAI transitioned to a capped profit model. In other words, they could take outside investment or equity stakes from outside investors, but honor the original sort of goals of the not-for-profit. And the way that Sam Altman's explained it is that if you're a not-for-profit and you're beholden to public market investors, you're inevitably going to do things that they just don't like. You know, the idea around shareholder returns or, you know, giving shareholder value, that doesn't fit with how OpenAI is run as a business.
But that's so interesting, which also then leads me to then how is OpenAI translating into the real world? Because that's going to wind up giving some real juice behind any of this.
So a lot of it is still research based, right? They're still thinking about how they generate, they grow the next generation of large language model. But the business model is actually quite simple. Licensing the technology to enterprise, subscriptions for consumers. The compute costs are really high still. And part of the Microsoft relationship is that they get credits and support through Microsoft's cloud offering Azure. But in the real world, it is there. You know, through an API, you can integrate GPT 3.5 into your own technology and vice versa. And as consumers, we can interact with ChatGPT. And if we don't want limits to that, we pay a subscription, a premium. And go back to the financials, $1 billion of revenue this year, several billion next year. They're doing something right with what in November was an idea.
Okay, Ed, thank you very much. That's Bloomberg's Ed Ludlow. And of course, you can catch Ed and Caroline Hyde on Bloomberg Technology in about 90 minutes. Coming up, the hedge fund manager who made his name shorting the housing market and was a central character in The Big Short. He's going to talk about what he's betting on now. That's Greg Lippman on Bloomberg.
The thing that strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
Bloomberg surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Markets really going nowhere. We're losing a little bit of steam, say, in the Dow. Let's go back to our question of the day. Are you getting paid enough to take risks, and where? Joining us now for his take is Greg Lippman, LibreMax Capital CIO and managing founding partner. The firm has $9.5 billion in assets. And you know Lippman, he made his name by shorting mortgage-backed securities ahead of the 2008 crisis, was an inspiration for one of the characters in The Big Short. He says he's the most excited he's been since 2014. Greg, good to see you.
Nice to see you.
Thanks for coming in. Why are you most excited right now? What are you most excited about?
I'm most excited, you said, what you're getting paid for. Short duration, given the way the yield curve is inverted. Short duration credit, we find really attractive. You can get sort of 9 to mid-teens yield or low teens yield in what we think are pretty safe credits.
What kind of, give me the framework for how you think about it in terms of inflation and growth and when the economy is going to wind up getting hit, because that's going to give you the opportunities, right?
Yeah, well, again, I think there's opportunities right now to have a reasonably resilient portfolio with low double digits returns in it. The biggest question is really the three scenarios, right? Is there going to be this immaculate soft landing, which will enable the Fed to lower rates gently and not in reaction to weak economy? Then there's we're going to have a hard landing and soon, which some data would suggest that. And then the third is that the resiliency of consumer spending in the economy and unemployment is that we're going to have no landing and the Fed's going to have to continue to raise rates. I think that first scenario, the soft landing, is sort of the least likely, and we've tried to create portfolios that are resilient to either a harder landing or B, a persistence of higher interest rates, which would surprise a lot of people.
Not to give us too much of a history lesson, but how is this set up different than 2008, where it was the mortgage market? Yes, it was banks, but it was the consumers being super leveraged that was the real issue, right? And having to work that through the system. How are we set up right now in relation to that in terms of leverage?
I think it's completely different from that, and that's one of the, people always, and it's exactly what you just said, which is that people always fight the last war, right? What went wrong before? Let's focus on that. And in the wake of the GFC, the government made a lot of reforms to the structured finance business and to banks in general. Certainly the Dodd-Frank rule, the Volcker rule, among other things, the qualified mortgage rule, the Consumer Financial Protection Bureau. And the result of that is that in the years since the GFC, the consumer has consistently delevered themselves. There's more fixed-rate mortgages as a percentage of outstanding mortgages than ever before. And on the corporate side, it's the opposite of that, which is that there's more covenant light in the high-yield space than ever before. There's more floating rate than ever before. And so our view is that going into the next recession, whenever it may be, on a relative basis, consumers are in a better shape relative to corporates than they were in 2008. It's almost a mirror image of that.
Interesting.
Greg, Danny here in London. Great to speak with you. Can I push back on the consumer? Because there have been warnings. There is a feeling that the piggy bank is running out. There's a study from the Fed. Only the richest 20% of Americans still have excess pandemic savings. Mike Wilson has been warning about consumer stocks. Consumer confidence has been undershooting expectations. Do those cracks concern you?
Well, first of all, the Fed's stated goal is to slow the economy down, right? So, which would be to sort of weaken everything about the economy, consumers, corporates, et cetera. And if you look at the data, in most cases, the defaults and delinquencies, they look like they looked back in 17 or 18 or 03, 04, 05. And that's the same for high yield. So there's absolutely an increase in consumer stress off of relatively low levels from before. So we're concerned about the consumer, but not more so than about corporates.
So then, how do you play that? Do you want to go buy MBS? Is it about buying consumer credit loans? Is it about subprime auto? How do you play a consumer that's stressed but not terrible versus corporate profit margins that you think are going to get hit really hard?
Sure. So, well, one obviously is in the portfolios we run that have hedges. We have a meaningful amount of hedges now relative to other times in the last 2 years. Second would be we play it in generally shorter duration things. So things where we feel we're value covered and we're getting sort of an 18 to 36 months of cash flow. I think it's being selective where you are. So certainly on the RMBS side, we've been taking more risk in residential mortgages than previously, whereas on the CLO side, we still have a large allocation, but we've been taking less risk. We've been buying CLOs that are in the process of delevering and paying down, as opposed to buying, say, new issue BB in equity, which are more exposed to the cycle.
Yeah, I mean, it has been, as you know this much better than me, Greg, a very slow year for CLOs. There's barely been any M&A, little demand for liabilities, but there have been inklings of some very, shall we say, buzzy kind of names starting more CLO funds. Do they know something? Is there a pickup on the way? Is there more excitement in the industry about a revival of the CLO market?
The CLO business is a great business when you can scale it, and it's reasonable that a lot of people have been getting into it. We for one bought a CLO manager a handful of years ago, and have been sought to grow that business as part of the suite of things that we offer our clients and customers. What will be interesting about CLO, when you think about CLOs from the perspective of starting them, it's usually on the equity side. And the returns of CLO equity are going to be driven by the exact way the cookie sort of crumbles. And in that CLO equity that was issued in and around the GFC, it went down a lot in price on a mark-to-market basis, similar to other markets. But because the default cycle back then was very short, and CLO managers were able to reinvest at wider spreads in 2009 and 2010, those deals actually ultimately ended up being great, even though they were launched at probably a horrible time.
So tell me more then about CLOs. So then how do you think this, so then what do you like? I know you're scaling back, but what are you scaling back, and then what are you keeping?
Right, so we've been increasing our exposure to deals that were done where they're past the reinvestment period, so they're begun to delever. So the BB, as the AAA is paid down, the BB becomes safer, and therefore we think in a lot of cases the ratings are stale, and they're stale too low as opposed to stale too high. And ultimately, a lot of them are going to get either upgraded or called, and will again generate sort of high singles to low double digits returns. We also like deals that were done at the wides last year, where we think there's upside to a call or a reset, because the spreads are very wide relative to the current market.
So then, just to follow on, commercial mortgage-backed securities. So you said RMBS. Where are you concerned in real estate? Like, obviously, this is a huge stress point for the economy. Where does it suck, and where are you making money off of it?
Sure. So I think what's important to never forget is that markets react to the difference between expectations and reality. So if you think things are going to be excellent, and they're merely very good, the price can go down. You see this with stock earnings all the time. Love stocks, and that do great, but not quite as great, and the stock tanks or what have you. So in the case of CMBS, everybody knows there's a big problem. It's certainly not a secret. And the result of that is, first of all, there's a certain lack of political correctness, and there's a certain amount as a result of indiscriminate selling. You have people who are just like, I want to own less CMBS, and I don't want to hear about why this bond is good or bad. Just get rid of it. So we think it's a non-politically correct asset. We've had that 3 times in our 13 years in business. When we started the company, subprime mortgages, people said everybody lives, an hour and a half outside LA, and they're never going to pay. And the result was actually that about half as many people defaulted as we thought in 2010, even though that number was like 4 times as many as people thought in 2006.
Right.
So it's all about expectations. 2013, student loans. Everybody has a huge student loan, and they all work at Starbucks. And there are some people like that, but there's a lot of people that's not the case. And, unfortunately, most of those types of loans are guaranteed by the government. We were involved in non-government guaranteed student loans. But getting back to the question about CMBS, it's our view that the whole sector is priced for horrible. And some of the bonds are going to turn out to be atrocious, but other ones are going to turn out to be, medium to bad. And if you can invest in technology and data and underwriting skills to sort of sift out which are going to be bad, which are going to be atrocious, and which are going to be horrible, and you just buy the bad to the horrible pricing, it's going to go up.
On these product questions, a lot of what we see in terms of these different debt instruments, different products, they used to live on the balance sheets of banks. They're increasingly moving into private hands. We know private credit has been gaining in popularity. Post-SVB, more of those loans getting sold off to, again, private investors. Just a minute here, Greg, but is there a risk in that, of the shifting of the world's debt?
It's a great question. I mean, the bull person would say they're in hands that are long-term, they're in vehicles that don't have redemptions, that don't necessarily have margin calls if they're not taking leverage and whatnot, and there's a stability there. I think that what the government did in some of the changes they made in saying to not want to have another Lehman ever again is that they made the system resilient to sort of a bankruptcy, but they made the system more fragile for selling, because in the pre-days when banks could have a lot more leverage than they can have now, when they were selling, banks could step in and say, some senior person at one of these banks could say, I'm going to buy $2 billion. I'm the one who's going to stop the selling now. They're not really able to do that, particularly in structured products, because of capital charge changes and whatnot. And so the result is that in the absence of private credit, markets are much more volatile than they used to be, for sort of short moves, even if they're more protected for a gigantic move, like the Lehman bankruptcy, if you will. So I think that private credit has played an important role in being that sort of stabilizer. The question will be, what about when they have to roll over their debt, or are some of those firms actually using leverage? And did I think one big question is how many people back in 21 thought that SOFR would ever be 3%,
right,
let alone 5 or 6? And I do suspect that there's a lot of things out there that the stress case was a SOFR of 3 or 3.5, and those cracks haven't really come out yet. But that would be one place I'd be looking for cracks.
All right, Greg, thanks a lot. We'll get you back. More to talk about. Greg Littman of LibraMax Capital, thank you very much. Coming up, we're going back to Lisbon. Guy Johnson, we're speaking with IATA Director General Willie Walsh. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals, or 10 p.m. Eastern on Bloomberg TV.
Guy Johnson, my colleague, is in Lisbon at at the World Aviation Festival with Willie Walsh, IATA Director General. Looking forward to this. Guy?
Thank you very much indeed, Alex. Yep, Willie is here. He joins me. We've had a number of conversations already this morning. Let us continue our conversations. Willie, we spent a lot of time talking about fuel today. The world is talking about fuel. Oil prices are going sharply higher. Does higher oil mean higher fares? Does higher fuel mean higher fares?
I believe so. You know, the fuel costs, the single biggest cost in an airline's cost base. If you have high fuel costs, the airline can't absorb that additional cost. So ultimately, it gets passed on to the consumer.
Is the consumer in good enough shape to take that? Up until now, it seems the consumer, certainly over the last 18 months or so, very price insensitive. Does that continue?
I think some of the macro issues are actually quite positive for the airline industry. Not all of them. You know, and clearly high oil price is not a positive development for the industry. It typically relates to a high and strong economy. I think there's a bit more in it today. But if the economy is strong and there's growth in the global GDP growing, that's normally good news for the airline industry.
But you get the sense that demand is going to continue to be. How do you see demand evolving? It's been, so it's been really good. We're coming out of the summer, which has been sensational. What happens now?
Well, I think demand is strong. It's certainly stronger than I would have expected at this time of the year. It appears that it will continue to be pretty good going forward. The issue will be supply will be constrained through no fault of the airlines. You know, airlines want to put additional capacity in there, but because of issues outside of their control, they can't. You know, and the latest one is the problem with the Pratt & Whitney GTF on the narrow-body fleet, which will restrict capacity in the short-haul market.
But there's so many other restrictions as well. Gatwick, what is it? Gatwick
all of these issues are impacting on supply.
Right. So that keeps all of those issues keep fares high.
Yeah, there is a balance at the moment. It is actually very finely balanced between demand and supply, and we've seen the two of them move pretty much in line with one another. So I think as supply continues to be constrained, I think demand will continue to be good. But I don't see any issue for the airlines. The environment is actually reasonably good at the moment.
Business travel isn't coming back in the way that it was. I'm hearing anything between sort of 60 and 80% in terms of pre-pandemic levels. Is that a problem?
No, again, I think people need to differentiate between business travel and premium travel. And people often associate one with the other, when in fact they're quite different. So you get a lot of people traveling in the economy cabins, and you get a lot of non-business traffic in the premium cabins. And what we're seeing actually is premium growth. So that if people traveling in the first and business class cabins, that's actually growing or recovering faster than economy.
But it's not as high a yield of business generally as the business travel.
Typically it is. You know, speaking from my past experience, the yield you get from what we call premium leisure is normally very similar to corporate deals.
Right.
So I don't think there's an issue for the airline industry there, because we are continuing to see very strong demand in the premium cabins.
Let's continue. Let's go back to the fuel issue. This industry needs to decarbonize. The way that it's going to decarbonize is by sustainable aviation fuel, which is going to evolve into what's called eSAF. It's super expensive. And I look at the journey that this industry is going to have to go on, and I'm wondering at the end of it, when we get to 2050, whether anybody is going to be able to afford to get on an aeroplane, whether or not this fuel is going to be so expensive that it's going to price most passengers and airlines ultimately out of the market.
No, I don't think so. You're right. It will be. It's very expensive today, and it will be more expensive, in my opinion.
So flying is going to get more expensive.
It has to. You know, and I've been saying this for some time. Anybody who believes that you can transition to net zero at no cost, I think is misleading themselves and anybody else. There will be a cost to transition to net zero, and ultimately that cost will be borne by the consumer.
Does that mean a smaller aviation industry?
I think it will impact on the rate at which the industry grows.
So a slower rate of growth?
Yeah, I think there will still be growth. If you look at markets around the world, look at what's happening in China, India, Latin America, there's still scope for a lot of growth in these growing markets. But I think the rate at which the industry grows may well be impacted by the additional costs associated with sustainable aviation fuel.
Why is the industry and governments and passengers to a certain degree seem to be on really different pages about who is going to bear that cost? The government's saying you have to use SAF. You're saying to the government, that's great, but where is it? And the passengers are going, well, we'd like to have a better experience. We'd like to be more sustainable. but we don't actually know quite how it works. Everybody's talking past each other. There needs to be a sort of moment of truth in all of this.
Well, I think we're getting there, and it's not a common theme around the world. You look at the US. I think the US has adopted a position of incentivizing the production of sustainable aviation fuel. Yep. They have federal and state incentives to produce more SAF. I believe that's the way forward. Europe is taking a slightly different approach where they believe they can beat people into using SAF. To me, that's a nonsense. Airlines have used every single drop of sustainable aviation fuel available, despite the very significant premium associated with it. So what we want as an industry is to see greater production. Now, greater production will bring down the cost from where it is today. It's not going to bring it down to the level of jet kerosene. That's my opinion. Yep. So I think there is a price. What we want governments to do, in the same way as they facilitated the transition to clean energy for electricity and for road transport, we're not asking for anything different. We just want the governments to have a policy framework in place that will support the industry making that transition to net zero.
There's an issue with fake parts in the industry at the moment, which is getting quite a few headlines. Does the industry have a safety issue around that? A lot of people are going to be watching this thinking, wait, what? Jet engines and fake parts? That doesn't sound like a good combination.
No, unfortunately, there has always been an issue, but it's been on a very small scale. And what you need to do is ensure that your supply chain, the providers you're dealing with, are reputable. It's like anything. Know who your partner is, you know their track record, that they know who their partners are, and that the chain is secure. So this is a very small problem, but clearly anything that impacts on safety is something that the industry
Does the industry have a growing safety issue?
No, I don't believe so.
We referenced Gatwick earlier on. ATC is really struggling at the moment to recruit staff. The industry is struggling to recruit staff. Is that going to translate into safety at some point?
No, I think the industry is struggling in some areas to recruit staff, not everywhere. But what it means, there's no compromise on safety. Yep. And in fact, the statistics prove that. Our safety performance is actually improving. Right throughout the pandemic, during the deepest financial crisis, the safety record of the industry actually improved. And that will continue to be the case. So, the industry works hard. We don't take this for granted. We work very hard to ensure that our industry is safe and gets safer. And that's what we're going to do going forward.
So we've just been through multiple challenges that this industry faces. Is a more consolidated airline sector the only way that we are going to be seeing that kind of become a reality? Do we need bigger, stronger airlines, certainly here in Europe? We're here in Lisbon. There's a race to maybe take over TAP. Is TAP an obvious candidate to be consumed into some of the other big groups that exist out there at the moment?
I believe so. And certainly that was my position when I was running IAG. I think consolidation is part of the solution. It is not the solution to the problems we have, but I think it is part of the solution. And I think TAP would flourish as part of a larger group in the same way as we've seen with other smaller airlines who have joined airline groups. So I think it is the way forward.
Willie, I'm going to congratulate you on that interview. You managed to get through it without using the words crack spread, which are Alex's favourite two words that she can...
Do you want me to talk about it?
No, I'm very happy if we don't. I know it's an issue, but I'm happy you didn't bring it up in this interview. Willie Walsh, the Director General of IATA. Thank you very much indeed. Alex, there you go. We got through an entire interview with nearly not talking about it. Thank you.
But you just talked about it twice. I feel like this is Guy actually wanting to talk about crack spreads now and ESAP. This is all him. You would put money in the jar for your jargon talk. All right, Guy, we'll be back with you in the next hour with Emirates CEO Tim Clark and Dubai Airport's CEO Paul Griffiths in the next hour. It is time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. We have a Bloomberg exclusive right now on Citadel and the SEC's WhatsApp probe. Joining us now is Bloomberg's Shonali Bassig. Now, Citadel's pushing back here, right?
They're preparing to. You may remember back in January, the Managed Funds Association, big industry group, had said that the rules for the private funds industry are different than that of the banks. And so the logic for Citadel is very similar here. Now, there's no sense that the SEC will necessarily bring a case forward, but as we've been reporting here, we know that they've really expanded the probe here and the idea of looking at more private funds, hedge funds, private equity firms, Apollo, Blackstone, all facing these same questions when it comes to communication from employees and how the SEC looks at it. So Citadel going above and beyond is certainly a significant move for the industry at large that doesn't really know how the SEC is going to handle the cases when it comes to themselves.
Sonali, speaking of probes and Bloomberg scoops for that matter, we had that breaking story earlier today about UBS, Credit Suisse, and the DOJ. What exactly is going on?
Well, a few things. We have indication here, according to Bloomberg's reporting, that the DOJ officials, Department of Justice, have alerted UBS executives, particularly in the U.S., that there might be alleged sanctions violations among clients of Credit Suisse. So they are taking a look at it. It is an early part of the investigation. You did see UBS shares react because what's Credit Suisse's problem is now also UBS's problem. And remember, when the DOJ is looking at these communications and business with Russian executives and wealthy individuals that could be in violation of sanctions rules, they're looking at UBS and other banks as well. And so this is early on, which is why you're seeing this overhang. With UBS, I would say into the summer, they've already settled a number of investigations regarding Credit Suisse, tied to Archegos, tied to RMBS pre-2008. So you have Sergio Armani moving quickly to clean up these legal matters, but this is a new issue on his plate.
And they set aside a bunch of money for reserves on this. Like, does this, of course, throw a wrinkle into that?
Well, that's the greatest question because they have reserved. Right. It's unclear where this new investigation would fall in, especially because it's so early. It's unclear whether this will amount to anything yet or how significant this would be. But these types of investigations tend to take a lot of time, which is why that kind of uncertainty and overhang is something they may look to clear up as soon as they can.
And then, so what is the next step then, Sonali? Less than a minute here. What happens next?
What happens next is, for UBS, is containing the scope of what is gone wrong here. Remember, the deal came together very quickly. And so when you think about this particular issue, they're probably looking to see the scope of the matter here as the DOJ is. Remember, this is an issue that the DOJ did go to executives about already. So clearly, they're getting a handle on this together.
All right, Sonali, thank you so much. That's Bloomberg's Sonali Basak there. Now, coming up on the European close, we're going to be speaking with Monica Defend of Amundi Institute. Euro still under pain, trading at the moment 105.13 as stocks struggle for gains. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under
Tightening would be a worse mistake than over-tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
It's Wednesday, the 27th of September, as a pause turns back into a sell-off. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
30 minutes into the end of cash equity trading here in Europe, and where have the dip buyers gone? At the start of the day, it looked like a moment of pause, of reassessing the sell-off we had seen, but it is resuming, and at least in the case of the euro, resuming with full force. Euro-dollar trading at 105.09, down 0.6% versus the dollar. We had some really grim European data coming in, credit data falling the most since the euro crisis. So it's not looking great in that regard. At least we were buying bonds. Now we're not anymore. German 10-year yield, that resumes its climb up 2 basis points yesterday, hitting the highest level since 2011. As we reassess risk, we reassess where the Fed is going and the higher for longer narrative. That also translates into European stocks, Alex, which also falling about 1/3%. Risk really is struggling. Again, it seems like today would be a day that we'd have a pause from this. Sure, it's not as bad as it has been, but we're still going down.
I thought that Cameron Kreis put it best. He was like, look, sentiment stinks. Sentiment stinks. You got to look at the charts. We did have a bounce in the S&P futures over the 100-day moving average for the S&P, right? But, you know, so we're not really going anywhere, even though we were able to bounce. So that follow-through buying, not so great. VIX picking up, and I point this out because you look at a chart of the VIX, we've seen a real move over the last few weeks. Does that actually wind up continuing? Skip crude for a second because it's pretty cool. The 10-year yield up by 1 basis point. Again, we talk a lot about the term premium in the 10-year. We will discuss that in a moment. Are you being compensated to take risk? Is it enough? Which leads me to crude. Up by almost 3%, energy outperforming in the S&P. If you just look at the curve, that front month price for oil has really re-rated a lot higher just in the last 4 weeks. And that really raises a lot of other questions into the market as well. It's supporting energy stocks, but that's a big move. 93 for WTI. Is that sustainable? You got to re-rate a lot of stuff if we stay here. Danny.
And to that point, I have a chart, Alex, in front of me of the term premium. Now, again, this is from the New York Fed. It's calculated in a very complicated manner, so I won't, nor can I, really go into the details of that model. As Ira Jersey told me, or told us, Alex and me just moments ago, it's a number and it's now above zero. That's the meaning of the term premium. But look, you could be skeptical in that way, and you could say the term premium now tells us the fact that it's above zero for the first time since at least a year ago says to us that we are now needing more compensation to take on the risk that is duration, that something has changed in this macro environment, that it doesn't make sense to have a negative term premium, Alex, which we have for the past 7 years. There's risk on the long end, and investors want to be paid to take it.
Yep, and does it get even worse? If we want to have a lot of fiscal spend, we were just hearing that from Guy Johnson, does that also change the term premium? So joining us now for a question of the day, are you getting paid enough to take risks, and where? Bloomberg Markets Today managing editor Christine Aquino and Bloomberg's Michael Masika. Christine, let's start with you. Do you think we're getting paid enough to take risk?
Well, Alex, if you're asking a bond investor, the answer is clearly no, right? I mean, this is why we're seeing that pullback in yields today. And yeah, I mean, just looking at that term premium chart, it's incredible that for the past 2 years, investors have not been getting anything when it comes to holding bonds. And, you know, in this environment where we are higher for longer rates, as well as inflation, right? That's the other piece I think that we have to remember. It's not just that rates will stay higher for longer. It's also this tacit admission by policymakers around the world that inflation will stay higher for longer and will not necessarily already hit the respective targets for quite some time. And so in this sort of environment, not surprising at all, investors are really demanding more to hold them. Otherwise, they're going to have to face competition from other sorts of products like cash, for instance, that's starting to become more popular again, as well as just kind of, your plain old bank deposit, which still yields higher than the 10-year at the moment.
True story.
Yeah, and we've seen that, right? We've seen cash flee into the front end. So, Michael, let me take this question to you, too. Are investors getting paid enough right now to take risk?
It's a good question, Danny. I mean, especially when you look at the equity return. If you look at dividend yields for Europe or for US, this is not looking good. Like people are getting less for their money compared to bond yields, for example. If you look at the forward earning yields in the US is lowest in like 13 years, about something like that, maybe further than that. You were talking about cash earlier. Yeah, definitely. I mean, a T-bill, a 3-month T-bill is yielding 5.4%. Why would you take any other risk, whether it's in equities or in bonds, when you have that type of returns on a 3-month T-bill? So no wonder why cash is like, the big winner this year. I mean, most portfolios are overweight cash.
Right.
There's been $1 trillion of inflows into money market funds. This is just a very clear picture.
So, Michael, I guess when you take a look at, say, value stocks, where are value cheap enough that it makes up for the risk? We all know Europe, super cheap, blah, blah, blah. We hear that story. But is there a point to be made on that?
Well, Alex, there is a point to be made on that. It's so cheap that technically you could argue that value stocks are already pricing the worst in terms of the economic environment. But we clearly know that for the past few years, every time there's been a bounce in value stocks, it's been very short-lived and it didn't work very well. So I think a lot of investors are very, very cautious. And yes, they will dip into value stocks from time to time, like we've seen in banks rallying or autos rallying. But every time we will have like a slightly bad news on the macroeconomic front, then this bounce will fade.
Christine, I want to bring that same question to you, but with currencies. I mean, there are a lot of cheap currencies right now compared to the dollar. The pound, which I'm sure you're celebrating, given you're not getting paid in it anymore, I'm assuming. You have the yen, which is really cheap, versus the dollar. I mean, is there anything that investors seem willing to buy? It seems like King Dollar is reigning supreme over everything.
Absolutely, Danny. I mean, that seems to be the story once again, which really caught a lot of investors off guard, right? Because you would expect at this part of the Federal Reserve cycle where they're starting to think about pausing and just keeping rates steady here, that momentum in the dollar will fade. And we did see that in the first half of this year. But I think now that central banks, other than the Fed, have kind of followed in the same footsteps, comparatively speaking, the dollar is really looking more attractive again. And I think add the uncertainty around the potential U.S. shutdown that's kind of looming all over us, that kind of really just burnishes the dollar's appeal in a number of ways. And so, a lot of currencies at the moment, cheap, but also cheap for a reason.
So I think that means that what I'm hearing is just more vol. Like whether you're looking at FX, whether you're looking at rates, I mean, more vol I put in quotes. Like I don't know how much the VIX is going to actually tell us, but just more volatility surrounding this question of like, how do you take risk?
Yeah, absolutely, Alex. I mean, I think what we might see for the near term over the next few weeks and months is really just kind of this sort of listless back and forth trading, right? That's definitely the feeling that we've seen this week. It's been really hard to kind of really see sustained moves and big themes guiding markets here because there really isn't any. I mean, this is kind of the difficulty with a higher for longer sort of environment, right? That people don't necessarily have a clear kind of endpoint as to when we might get that shift in policy. And this sort of uncertainty might be here to stay until we get more of a definitive steer from central banks.
Right, which to Michael's point was like, that's why you're just going to fade kind of every real rally that we see. All right, guys, thanks a lot. Really appreciate it. Christina Aquino, Bloomberg Markets Today managing editor, and Michael Masika from our equities team. Thanks a lot, guys. All right, coming up, we're going to get more on the question of the day from Monica Defend. Amundi Institute head will join us next. This is Bloomberg.
largest and wealthiest consumer markets in the world. And there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
You know, if you look around pockets of the stock market, I think you can still find value. You just have to be very careful and understand what your time frame is because, you know, we're in an odd environment right now. Inflation is picking up. You know, the economy looks strong. That's good news. But it also, you know, makes things tricky because it gives you more choices on where to put your money.
Callie Cox of eToro speaking to us a little bit earlier. Now, we had asked Callie about our question of the day. Are you getting paid enough to take risks? We've seen a term premium move positive. Tech stocks, they've corrected. Can you jump in and buy? Do you get paid enough to take risks? Joining us now is Monica Defen, Amundi Institute head. Monica, what say you? Are you?
Hi. Well, it depends. You cover already the fixed income and the equity, so let me focus on a balanced portfolio perspective. So when it goes there and you look at risky asset, it's really difficult to get a straightforward directional bets. Therefore, you are not paid to get a long equity or a long duration all the way down, but you are paid to get risk on relative positioning. For example, emerging market versus developed market, whether it is on the equity or the fixed income space. What we really see is this progressive deterioration with disinflation progress continuing amid higher real rates. So it really depends on the time horizon and the kind of investors you are.
Absolutely, Monica. We were talking to Bund of UBS yesterday, and he made the relative point, but in terms of equities versus bonds, U.S. versus Europe. So on a relative basis, bonds are so much cheaper or provide better value than equities do in the U.S. versus that spread is a lot tighter when it comes to Europe. Would you agree with that assessment?
Yes, we do. And it is even more evident if you plug in emerging markets versus developed markets.
In emerging markets, Monica, I can't help but wonder the risk there of a stronger dollar. We were all excited about the Fed ending its rate cycle, that finally you'd see some relief. They wouldn't have to keep defending their currency and hiking. But yet again, you see a strong dollar. What does that do to your assessment for EM?
Well, on the central bank's monetary policy stance, most of the central banks in the major emerging market countries have already U-turn, starting to cut their rates. On the US dollar, really the short-term pain relates to the fact that this temporary spike that we see in inflation, and this is again is a big assumption because we think that oil prices spike is set to be temporary. So this is going to be reflected into higher PPI and CPI print, but over the fall we expect inflation to moderate farther back.
So then if you just take the EM example, where in EM are you getting compensated for the risk and the potential volatility?
Well, I'm thinking about India, Indonesia, Brazil, countries that are showing a nice growth path, transition in the economic model that is going to benefit from the allocation, for example, of supply chain. Therefore, these regions are getting an interest on the full spectrum, whether it is fixed income, equity, or the FX itself.
Monica, going back to this bond market and the sell-off we've seen in duration, there seems to be two things driving it. Jay Powell said himself, it is growth and it is supply. We have both the consumer and the government spending money like there is no tomorrow. Will one of them crack, and which is the first one to do that?
Well, we do worry that it will be the U.S. consumer, and this is why we are thinking about this recession kicking in over next year, between the end of the first quarter, second quarter. Then, depending on the tightening of the financing condition, if the Fed is done, as we do believe, this might really transfer a lagged effect on the U.S. consumer, and we think that this is where the weakness in the U.S. economy will be at the beginning of next year. Having said that, the debt overhang is clearly a weakness, a vulnerability that is going to probably not help amid a U.S. economy that is proving to be weaker.
So, Monica, on a tactical basis, you were talking about time frame in the longer term, and that makes sense. On a tactical basis, what price action does not make sense right now to you?
Well, really, on the fixed income, probably we buy this concept of a higher for longer, but this movement in the yield curve on the Treasury, for example, it is really well above any fair value calculation one might pencil if you take into account the growth, the inflation path, as well as the debt dynamic and the Fed balance sheet.
Okay, I just, the corner of my screen, which on my terminal setup has oil on it, it just caught my eye. WTI is up 3 1/3%. Brent is up 2.5%. That rally is coming back in a big way today. Do you buy into the oil super cycle narrative from JP Morgan? Is $100 a barrel next?
Actually, our target for the Brent is 90 US dollar. We do believe that demand and supply dynamic will adjust into that target, and this is why we believe the inflationary pickup that we saw recently is going to be temporary.
However, do you bet on, but if we stay sticky here, like it's not going to go down to 80, right? Or like 70. So if we stay sticky, does that change the calculus? We aren't really seeing it feed into gasoline prices. It may affect the overall headline inflation, but in terms of the consumer, like we're not actually seeing that yet.
Well, and this is going to ponder on the U.S. consumer as a tax. So it's, if you want, another element that might call for weaknesses in the U.S. consumer. But overall, if you look at the basket of inflation, everything is going down but energy. So probably it might be delayed, but over the fall, it might turn back to a downward trend.
Yeah, no, fair enough. All right, Monica, thanks a lot. We got through a lot there. It's really difficult, that short-term and longer-term look, amazing opportunities for emerging markets. All right, Monica Defend, Amundi Institute head, thanks very much. All right, coming up, speaking of oil, kind of, we're going to head to Lisbon for the World Aviation Festival. Paul Griffiths, Dubai Airport CEO, joins us for an exclusive interview next. We'll see if he doesn't talk about crack spreads. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
we have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All right, now I want to take you to the World Aviation Festival in Lisbon, where Guy Johnson is with Dubai Airport's CEO, Paul Griffiths. Guy?
Thanks, Alex. Yep, Paul's here. Nice to talk to you, Paul. Great to see you. You took over in Dubai 16 years ago today?
Exactly, 27th of September 2007.
The airport, the place has become very... I used to live in Dubai many years ago. There was a logic to the hub and spoke model that then Maurice Flanagan, then Tim Clark have ultimately built. Dubai is a very different place now. It is a destination. It's less point to point. It's more point to point. You go to Dubai rather than going to Dubai to go somewhere else. How different an airport, therefore, is it?
Well, the interesting thing is the growth of the hub and spoke mechanism that we've used so successfully has grown alongside the city. And now, of course, after the pandemic, we've seen a switch. Pre-pandemic, we were 60% transfer, 40% point-to-point. That's now switched around, and 60% of the people that come through DXB are actually travelling into the city. Now, as an economic multiplier for the economy, of course, that's extremely good. But the attraction of Dubai remains its connections with the rest of the world, and we've recently been judged to have the largest number of point-to-point and transfer destinations in the Asia, Pacific and Middle Eastern regions. So that's a great accolade for the connectivity that we've grown over the years.
What is demand like at the moment? We've come through a period of zero demand then to extraordinary demand. Do you see that extraordinary demand continuing?
I think so. Our first half numbers showed that we were back 100% at our pre-pandemic levels. And I think if I look at the forecasts for the rest of the year, with so many events in Dubai over the next few months, including COP28, we're very optimistic that we'll close the year exceeding our pre-pandemic numbers. So I'm very optimistic that the growth will continue. There's some signs that the overall global market will change a bit. We're seeing the balance of demand slightly softening in the West, but the big hope that the Asian tigers will start to wake up, and we'll see the resurgence of China in particular, which has been a significant part of our traffic in the past.
We are going to go to a world where sustainable aviation fuel becomes a big part of the fuel mix for airlines. How ready are you? How easy is it to make that transition, particularly with blending different kind of requirements? How easy is it going to be to do that? And how easy would it be, or hard would it be, and expensive would it be to go to hydrogen?
Well, I think the first thing is that we've got to get enough product produced globally, and there's no point in producing sustainable aviation fuel in California and then tankering it all the way across the world to Dubai. So we've got to choose an energy strategy that actually best suits the location. Our big push is towards solar, and we are actually going to be installing something like 10 times the PV generation capacity at DXB by putting more solar panels on the roof spaces, which is significant. That'll reduce our carbon footprint substantially, and the aim is to try and get all of our ground-based vehicles to be powered by non-hydrocarbon sources within a fairly short space of time.
But in terms of the fuel, airports are the kind of the final conduit, the storage, the whatever it is for the airlines that are using that airport. Are plans advanced to put SAF into train, to make it actually a reality?
The thing is, SAF is relatively easy once you've got it into the fuel hydrant system. The question is, to produce it, you need a huge amount of feedstock, and you have to have a large amount of fresh water to grow the feedstock. And there is huge divided opinion as to whether that's possible. There was a report recently showing that the UK's consumption of aviation fuel was something like 12.7 million tonnes per annum. And to grow enough feedstock to make that pure SAF, you'd have to give over half of the arable land in the UK to produce SAF. Clearly that's not going to be practical. SAF will be a component in the sustainability agenda, but the problems of production at scale and the pricing differential is going to be a major problem. We really need an alternative method to power aeroplanes other than relying on hydrocarbon fuel, and that's very hard.
No kidding. Final quick question. I consider you an expert in the subject. Why is it so painful getting from the moment I walk into an airport to the moment I walk onto the aeroplane and take off? Why is that process still so incredibly difficult and painful as a passenger?
Too many independent stakeholders, too many people owning segments of the passenger journey, whereas the passenger moves horizontally across all of those different processes. If you can't take an end-to-end view of the customer journey, it's like bumping a shopping trolley across some railway tracks. It's painful every time you go from one stakeholder to another. We take the view of joining all that together, providing a single seamless process, which is why when you go through Dubai, hopefully most of the experience is actually incredibly quick and very reliable.
Paul, great to see you. Thanks for stopping by to see us. We really appreciate it. Paul Griffiths, the CEO of Dubai Airports. Danny, back over to you.
Guy, thank you so much for that conversation. Bloomberg's Guy Johnson with Paul Griffiths, Dubai Airport CEO. Guy, I'm going to tell the team, I'm only filling in for you when you have airport conversations, airline conversations, because this is a joy for me to be in the anchor seat and watch them. All right, it's almost the European close. Stocks are almost done trading, but we are seeing risk turn as we head into the close. Oil, though, on fire. WTI almost up 4%. The bond rally, it undoes itself. We're seeing bear steepening yet again. So some of the relief we had seen now running out of room. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become
the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Stocks are just finishing up the trading day here in Europe, and it seemed it was supposed to be a day of pausing, of reassessing the risk-off environment we've got on, but that is not what happened. Bond proxies really are getting clobbered here as we end the day in Europe. The only thing that seemed to do well was energy, with this rip-roaring rally we're seeing from oil today, up more than 3% for both WTI and Brent. So most of the regions ending lower. FTSE Med DAX, those higher beta regions really getting hit hard. But you can see just in the intraday, we were above water for most of the day. We were buying the dip through some of the pain that we saw yesterday. But really in the last couple hours of trading, that's when we fell, and we ended down 0.2%. That does seem to be an overall macro kind of sentiment-driven thing. There are some individual news stories to unpick, though. UBS falling 3%, a great scoop from the Bloomberg banking team that the DOJ is looking at both UBS and Credit Suisse about their actions with Russian clients, whether they help them to evade sanctions. According to people familiar, still in the early stages of this probe. It might not result in charges or settlement, say those people. All right, NN Group, this is a Dutch insurer. It fell today 18 1/3%. This is also a result of some government action. A Dutch court, to be specific, ruling against them when it comes to some transparency issues. In other words, for a couple specific of their products, they weren't transparent enough. They didn't give enough information. Some of the fee and cost structures were also questioned in this. Finally, H&M earnings out, a gain of 3.4%. This is a good story of when it comes to inventories. This has plagued H&M. Post-pandemic, they had this huge buildup of inventories. They finally have been able to eat their way into that. They still exist, but they're a whole lot better. And at the same time, H&M announcing some cost cuts, too. That's helping them out. So that's what we've seen over the past day. Here's what's ahead. Kicking off in Berlin tomorrow is the Berlin Global Dialogue Conference. We're going to hear from some big people. That includes Schultz. I'll also be speaking with Larry Fink on Friday of BlackRock around this conference. We're going to get some big data out too. Italian consumer manufacturing confidence and economic sentiment. We saw the budget today. What the higher rates has done to that, the pressure on the Italian government. Going to get some other data pieces, Alex. That includes Eurozone confidence and CPI. It'll come out of both Spain and Germany.
Yep, and really interesting with those CPI numbers, particularly with oil continuing to rise. So ahead of that, ECB Governing Council member Robert Holzmann yesterday told Bloomberg he can't rule out another rate hike.
Inflation is full of surprises. And as a result, we cannot say for sure now we have reached the peak and no more increase. The reason is that the inflationary pressure is still on. And just these recent days, we have seen how much energy prices have surprised us.
Well, joining us now is Pooja Kumra, Senior European Rate Strategist at TD Bank. Remember, Holzmann is one of the more hawkish members. Pooja, when we get really Germany CPI tomorrow, what are you going to be watching and what's priced in?
Thanks, Alex, for having me. Yes, for German inflation, at least it's a good news for markets. We're actually seeing a 2% drop in inflation, and that primarily comes from the base effects. And I think that's something we and markets are pretty much aware of. And I think key for us is what do we need to price for ECB. I think pretty much in the September meeting, we have been told that they want to play the Fed's playbook. So I think it does not really particularly change the pricing for the October meeting or the December meeting. I think the key is now market focus in Europe has changed from just the inflation numbers to the growth numbers. We know inflation is on its trend downwards. It will be a slow trend, but at least that's where ECB seems a little more satisfied just because the financial conditions are doing their work for them.
What is the growth picture telling you? Is it telling you stagflation, I dare say?
So I think growth picture, there has been a lot of pessimism in Europe. And I think that's where I'm thinking that will it be that bad, because we have been hearing about, German going for recession, and I think even ECB did major downgrades when it comes to growth in the September meeting. I just feel that now we are coming to a turning point where possibly we could see a turnaround in especially manufacturing PMIs, even though services PMI have started to go downwards. So I just feel that overall picture may not be as bad as the kind of pessimism is in the German market right now with respect to growth.
Do you feel like the rise in oil, though, can kind of disrupt your view? And I know central bankers are going to say that they look through it, but this is going to have a material impact on, say, German industrial companies, for example.
Yes, no, I think now the key theme is oil and what impact it can have for inflation after going through so much. Literally, central banks have been very successful in halving the inflation, and the last surprise we want right now is from oil. So just to give you some maths right now, we will actually need something around 40 barrel increase in oil prices on a consistent basis so that it adds something like 0.3 to 0.4% to headline inflation. So I think that's a big number when it comes to the oil prices increase and its impact for inflation. So we don't think that at this stage it will have a material impact when it comes to inflation, other than the month-on-month increase that we could see in the next couple of months. And also we do not really, we also need to keep in fact, we do have higher oil prices, but we also have China, which has actually disappointed when it comes to its fiscal stimulus. So I think both should kind of offset each other. And I'm not a commodity specialist, but our economics team is actually looking for oil to end around 90-ish. So I think we are almost there. So we are not looking for much in terms of upward surprises.
So can I buy German sovereign debt yet with yields, 10-year bund yields at a 2011 high? Can I jump in then?
Oh, you have treasuries even cheaper.
True. True.
Yeah,
so, okay.
No,
but do you ignore bunds then? I mean, do you ignore Europe if you have treasuries that are cheaper?
No. I was just going to say, for us, definitely we are longing in long duration, just given the fact that I think September the move was too much for no reason. The higher for longer story has been going on since August, right? Central banks have been pretty much upfront on that. So I do feel that these levels, we will see markets scaling in longs. But I think that very solid conviction when it comes to long duration is still not there, just because the data has been annoying for markets right now. But I think from a cross-market basis, we still like holding, possibly like UK debt versus Europe debt, just on playing it tactical, but we do like holding longs here.
So our question of the day, Pooja, over the last couple hours has been, are you getting paid enough to take risk? And I know it's a relative conversation, but I'm wondering in the bond market, where do you think we are being paid? You're being paid enough to take on the risk of potential resurgence of inflation at any point, but more importantly, higher for longer?
I think when it comes to Europe, we still have real yields being a bit subdued. We are still around 30 basis points, 40 basis points. But I think if you look at US real yields, we have crossed 2%. I think that tells you a lot. Like generally, we have seen S&P actually declining the moment your real yields actually go beyond 2%. So duration is giving you a lot. I mean, I know whenever we reach for a level and markets just break that level, but I think at this stage, we do need to think, does data actually justify another leg higher in rates? Your labor market is slowing down steadily. We started the year with non-farm payrolls being 650. Now they are actually below 200, and that's been the trend. Is your inflation going higher? No, we are seeing sticky inflation, but it's coming around the 0.2% for USPC. So I think we are getting at those levels that we will see a big long in duration jumping in, but I think we need maybe possibly one more month of data to see that weakness in labor market.
Yeah, Pooja, afraid that's all we have time for. Really great to catch up with you today. Pooja Kumra there, Senior European Rate Strategist at TD Bank. All right, let's check in where European stocks have settled as we head to the break. Another down day for these European indices. FTSE 100 down 1/4 of 1%. DAX down 1/4. CAC not doing so bad. Barely changed. It is energy that outperformed today thanks to oil. Now, speaking of the energy energy conversation. Coming up, we're going to hear more on how airlines are dealing with the higher fuel costs. We're going to hear from Emirates President Tim Clark on the airline's aggressive post-pandemic growth plans. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
In London, this is Bloomberg. The world's largest international airline is charting an aggressive post-pandemic growth plan. Emirates President Tim Clark spoke with Bloomberg's Guy Johnson from the World Aviation Festival in Lisbon about the airline's fleet expansion.
The 787 isn't in the short-term picture at this point in time. Yes, we're talking to Boeing about the 787. We quite like the aeroplane.
So there's no news coming at Dubai, the Dubai Air Show?
What's the space? What's the space? As I said, we're in talks with Boeing, as we are with Airbus.
Yep.
And we are hiring large numbers of crew. Many of those will be direct entry captains onto 380s or whatever, simply because we're moving some of those pilots onto the 350s, which start arriving in July, August of next year. And we have 50 of those being delivered in rapid order. So we have to move our pilots around. So we know we have to recruit. The 7779 is hopefully coming at the end of 25. The 350s next year. We need more 9s probably in the future because of the retirement of the 380s. We're looking at the 350-1000 quite seriously. Still got propulsion issues with Rolls. Hopefully they will get resolved in the next couple of years. So to the point I made earlier about the new era, yes, we've got a lot of big plans for the airline going forward. New fleet, larger numbers, larger network, fly Dubai. So I think it's going to be quite a good story. We've learned a lot from COVID. It reset our thinking, reset our processes, and we came out of that having made the largest profit we've ever made last year. And this year, it's going south.
Final question. The UAE is about to host COP28. Huge event. Sustainability, aviation sustainability, front and center. The cost of making this industry sustainable, are we being honest about it? Do you think the aviation industry will have to be smaller given how expensive the fuels are going to be? Do you think people will be flying less because of how expensive fuel is going to be if this industry is truly to make its targets of 2050?
Well, to deal with the first question, are these targets achievable? Are we really kidding ourselves into what we can do? At the moment, technology is there for us to do whatever it may be, ESAF, hydrogen, etc. The scaling of that technology and the power required to scale, as well as all the other bits and pieces, is not there yet. Okay, so we need to sit back, and I would like to see, we talked about it on the stage earlier, I'd like to see some kind of body, if it's under the UN, under ICAO, where they actually thrash out the issues of civil aviation going forward, rather than take views about mandates and punitive penalties and carbon credits, etc. What is the truth of all this? Ask yourselves, what is the truth? And how are we going to deal with it? And then publicize that, whether it's good reading or not. It's the statement of truth.
That was Bloomberg's Guy Johnson with Emirates President Tim Clark. I will be back tomorrow. I definitely want to talk more about ESAF and crack spreads, for sure. All right, coming up, we got the Republican presidential candidates are set to take the stage again tonight for their second debate. We're going to look at all the things you need to watch next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
Stocks trading a little heavier here. The S&P is now off by about 0.3%. Energy really still very strong in the market right now. Abigail, do a little tracking the moves. Abby?
Yeah, well, it's interesting here, Alex, because we, of course, did have gains earlier, and now we're down a little bit for the S&P 500, down for a second day in a row. But to your point, not a huge loss, but it felt like maybe with the smaller gain earlier and positive sector composition that maybe the S&P 500 could hold on to a gain. You can see the NASDAQ 100 also lower. Now, the Russell 2000 small cap outperforming up about 1% on the day. And one thing that could be weighing at least on the S&P 500, more so on the technology technology sectors and NASDAQ. Take a look at the 10-year yield at a 4, basically 58, its highest level, I believe, since October of 2007. So yields continue to back up on the idea of higher for longer. And of course, Jamie Dimon yesterday, CEO of JP Morgan, suggesting the idea that we could see a 7% Fed funds rate, which completely would confirm the idea of higher for longer. As for what's moving beneath the surface, to the upside, we have Costco doing a reversal of its pre-market loss, up 1.7%. They did, of course, beat. There's some unhappiness about the fact that they didn't mention their membership increase hike. ExxonMobil climbing higher with oil, up 1.9%. This is the best sector on the quarter, up more than 10%. Apple down 1%. And then we also have Amazon down for a second day after yesterday's big loss on the FTC's antitrust complaint against the company, down 1.3%. As for the Russell 2000, one reason to think that the S&P 500 may be going lower, perhaps toward 4,200. The Russell 2000, you can see well below its 200-day moving average, down about 12% since its late July high. On the S&P 500, 4,200, that is the 200-day moving average, Danny. Often, as you know, small cap leads, and maybe this could be a case where that will happen again. Also, Apple on the lead toward that 200-day moving average as well.
Abigail, thank you so much. That's Bloomberg's Abigail Doolittle there. All right, let's get you set up for the rest of the day. Here's what to watch out for. Earnings after the bell. We'll hear from Micron and Jefferies, as well as Bank of America CEO Brian Moynihan. He'll be speaking at the Economic Club of New York. That will start in just a few minutes, noon New York time. Plus, Meta CEO Mark Zuckerberg will be giving the keynote at a Meta Connect event. That will happen in about an hour's time. Then we also get the second Republican presidential debate. That'll happen later today, Alex, from the Ronald Reagan Presidential Library in California.
Yep, going to be looking at that. So they're going to gather in California today, as Danny was just saying. So earlier in the week, I spoke with one of the candidates, former UN Ambassador Nikki Haley. There's a lot on the table right now, and I asked her actually about the government shutdown and if she talked to leadership about what's going on right now in the House.
I haven't talked to leadership. I've talked to all of Congress saying it is irresponsible and inexcusable that you would let government shut down.
And what's the response?
It is also irresponsible and inexcusable to not cut all of this spending. They are using our budget and keeping it in pandemic spending. We're no longer in a pandemic. Why are they still spending at those levels?
So for more on the debate and what their response was, Ryan Teague Beckwith joins us now from Washington. What are you going to be watching on the debate stage? It does feel like there's going to be a little bit of a gang up on Nikki Haley after her better performance in the first debate. What are you hearing?
Well, I think actually that the gang up is going to be on Kevin McCarthy, because both Haley has attacked the Speaker of the House here implicitly by saying that a shutdown would be a bad move, and he's personally, right now, the person who's most responsible for that may be happening. But also Ron DeSantis, who's kind of cheerleading for a shutdown, has attacked McCarthy's leadership. So he's kind of getting it from both ends there. I think that will be a real interesting dynamic tonight between those who see this as an opportunity to talk about why we should shut down, to fight spending. Trump has also said it, although he will not be at the debate. And those who say, you know, this is not the kind of tactic that wins elections. This is bad for the economy. It's bad for Americans.
Right. It's probably just important of who's not there and as who is there. We got some Trump counter programming from Detroit. What are we expecting in that regard?
Trump doesn't, has said that he wants to win the endorsement of the United Auto Workers, that he wants to win these auto workers. He doesn't need to win them in order for it to be important. He just needs to peel off a small number of union households who typically vote Democrat to vote for him. I think in this particular case, he's going to be speaking at a non-union workplace, which is a little bit of a faux pas if you're reaching out to unionized workers. And I think that the sooner that the UAW issue is resolved, the better it is for President Biden, who joined the striking workers on the picket line. That was kind of a historic moment there. Trump, he's putting himself out there in a kind of a key place to put some pressure on Biden. We'll see how well he's received.
Ryan, how do you think this is going to, the two will play into the debate, right? How much are the candidates going to gain from attacking Trump and McCarthy at the end of the day, like on the debate stage? Like, how do we judge the winner there?
Well, I don't actually think they're going to attack Trump much. The focus groups, polls, just man in the street, you can find that Republican voters don't really want to hear the other Republican candidates bash Trump. They just don't like it. They either like Trump or they like kind of where he's leading the party. Polls show that pretty consistently. So for the Republicans, they're kind of looking at a way to distinguish themselves without doing that, and that's why I think McCarthy will take a lot of heat, because absolutely nobody has any truck with McCarthy. And then they'll hit each other over things, as we saw at the last debate, Haley hitting Vivek Ramaswamy for not having any foreign policy experience. They'll jab at each other a little bit like that, but there's just not going to be a lot of Trump bashing in my view.
Okay, so interesting to see how they're going to thread all those needles. All right, Ryan, thanks a lot. Ryan T. Beckwith for joining us. Here's an interesting story, though, Danny, before we go, that I wanted to talk about that sort of caught my eye, right? Talking about commercial real estate and residential real estate, fireworks between Katy Perry and the founder of 1-800-Flowers. They are headed to court over a house, a $15 million house. So Carl Westcott, he's the former private equity manager and entrepreneur who founded 1-800-Flowers, says he didn't want to sell Perry his mansion in a very fancy California town for $15 million. He bought it not for a quick flip, and he was not in the right mindset to sell it, and he wants to back out. She's like, no, you can't back out. We signed the contract, and she's also suing him for $1.4 million to be able to get some money back from what she would have lost what she's lost in rent. I mean, yeah.
Yeah. I mean, it's not great, but the thing I truly, truly cannot get over in this story, about halfway through, it talks about that this isn't the first time she's had this issue. She bought a $15 million former Catholic convent. The nuns who lived there objected. They tried to sue her. The judge ruled in Perry's favor and made the nuns pay Katy Perry, and they ultimately filed for bankruptcy. What?
I mean, I kind of have two feelings on this. Like, one, if you sign a contract, like, it's a contract. Like, like here, if you sign a contract, you put down a down payment, and then you back out, you leave the down payment, and you walk away. Like, there's contingencies. Like, you got to do that. But the other hand, like, I don't know, you bankrupt nuns. Like, that doesn't sit well on, like, a headline level, right?
Yes, exactly. I mean, maybe contract law doesn't take into account the holiness of nuns. Maybe it should. It's still so strange to me. I can't get over it.
Thank you for joining, Danny. It was a pleasure to have you. Oh, always good. This wraps it up here. Coming up, you have Bloomberg Technology. Wendy Hall of the University of Southampton will be joining Caroline and Ed. This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question.
question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we'll preview what to expect from Meta's Connect as analysts watch for the company's generative AI and VR plans.
Plus, we'll have more reaction to the FTC's landmark antitrust suit against Amazon and hear from Chair Lina Khan herself.
And as Sam Altman's OpenAI seeks up to a $90 billion valuation, we'll discuss the state of AI, the regulation of it, with the co-chair of the UK government's AI review. All that and so much more coming up. But first, we check in on these markets, which are macro-dictated. We're flip-flopping between gains and losses on the NASDAQ at the moment, currently underwater by 0.2%. It seems to be being moved by this particular market, the bond market. We're seeing yields back up 4 basis points. Look, we're at sort of decade-long highs at the moment, 4.57 on the 10-year at the moment. We're seeing above 5% on a 2-year. We're worried about the direction of travel for the Federal Reserve and indeed a potential government shutdown here in the United States. Interesting, though, that we see the dollar, of course, still pushing higher. Is that as we expect the Fed to have to push back on currently where some of the inflationary pressures have been? We're seeing the Bloomberg Dollar Index up for a 6th straight day, longest winning streak that we've seen since the beginning of the year. Let's move on and see that actually, in the face of a stronger dollar, Bitcoin higher, up 0.5%. We saw a sudden bout of buying in European trading, so actually managing to tread some water here, Ed. But get back to the micro that's involved today.
Yeah, there's kind of some themes in the show, from sort of consumer electronics to augmented reality, playing out in the news cycle markets as well. So Snap up 2.3%. They're shuttering the unit of their business that does augmented reality for enterprise. 170 jobs going with that, jobs being cut as well. It's kind of a question about the long-term commitment of Snap to augmented reality. Later in the show, we will talk to our Bloomberg Intelligence analyst about that. Consumer electronics hardware, Peloton now down 0.9%. Tom Cortese, the last remaining founder of Peloton, is leaving the company. So of the 5 that started the company, he was the last domino to fall. He is left but will remain on as an advisor. The stock kind of traded sideways for most of the session. It is now down. The big one, as you said, is Meta Connect. Meta Connect is the company's annual developers conference. When we think about developers conferences, we do think software, but there's going to be a big hardware component. We know that Quest, the next generation of, will be a topic of conversation. Of course, alongside AI, we are treading water on Meta, the parent of Facebook, up 0.1%. How much focus is going to be on the software side? How much focus is going to be on the latest generation of hardware? Metaverse versus artificial intelligence, what is the priority? These are the great questions we have to ask.
And indeed, the ones that we've been asking day in, day out, in fact, with executives of Meta. Of course, last week I got to sit down with the head of global affairs to discuss how the company is utilizing generative AI. Just take a listen.
We're announcing next Wednesday on the 27th new applications of generative AI in our products, things like you'll be able to communicate with businesses on WhatsApp and Messenger, these sort of really, really extraordinary AI-powered bots. That will transform the way that all of us as consumers interact with businesses, and many other things that we'll announce next Wednesday.
Let's weigh up what investors want to hear. Jefferies senior internet analyst is with us, Brent Thill, ahead of the all-important Meta Connect. And Brent, to that end, how much do you want to be hearing about generative AI? How much do you want to be hearing about chatbots, about therefore the desire of people, younger generation in particular, to remain committed to Instagram, to Messenger, to the other offerings?
I think AI is front and center for every tech company, Google, Amazon, the whole industry. This is the majority of the topics that we're having with our investors. So I think that's what investors want to hear. Obviously, it's software. They don't love the hardware side of this, so they'd like to hear more about this than the Quest and the hardware side, which again, I think most investors are skeptical about. Obviously, a more expensive endeavor, higher margin building software and AI than hardware. So I think we want to hear more around that. Mark Zuckerberg, did a story yesterday on his Instagram about Jarvis. Back in 2016, he showed Jarvis was his AI bot at his house that could turn on the lights and do things like make his toast at home, right? So that was back in 2016, and he kind of reposted that. So we believe, this concept of Jarvis for the home comes to the mass market in AI. Obviously, Microsoft and Google are doing this. Meta also has an incredible opportunity given what they have with WhatsApp Messenger and the global platforms that they have that can help us, find the right goods we want, help surface ideas, maybe pass along photos or other ideas to our friends. So I think this is going to be, for us, the most exciting part of it. I think the sideshow will be, Meta Quest 3, and the price point everyone is obviously looking for below that of the Vision Pro at $3,500. So the differentiation there and what's going to happen in the next generation of the metaverse.
Brent, Meta is building large language models, a heavy emphasis on open source when developing that technology, and it's kind of hinted at how that translates to generative AI tools in their existing properties, right? I think we're focusing on AI agents. Do you see a clear path to Meta ever making any money from all of the things that they are working on the R&D side?
We do. They've been very clear they're not making money now or don't believe that this will be a big revenue initiative in the short term. Long term, we do believe that they can make money on Llama, and they're obviously a consumer-focused company, not as much enterprise. And so this is, going to take them time to figure this out. But we think given the quality of the feedback from the channel about Llama and how they're using it, how the open source community loving what they're doing, there's no doubt
Difficult to transformative, right? So when you think about our starting position, given that we are so diversified, we don't really need to add any specific capabilities. I mean, we can debate private credit, but otherwise we feel we have what we need. So therefore, organically would be mostly, let's say, German engineering, meaning some precision, proper bets on certain things where we feel we can do better. But yeah, you always want to have, your eye on the ball to see what happens inorganically.
It's interesting, when you were brought into DWS, it was a pretty tumultuous time. You were facing greenwashing allegations in the US and abroad. You've recently settled with the SEC on some of the questions that they've had, still facing questions abroad. How hard has it for you been to turn the page on this issue, and what has it changed in terms of how you think about sustainability?
So it's definitely been an interesting experience. I can, obviously well covered when I joined 16 months ago. So look, because you mentioned the SEC, it was great to put that matter behind us, right? And we obviously acknowledged what they found. We appreciate the fact that they basically, credit us for proper cooperation. And we really learned two things when looking in the rear mirror. I mean, one, there was a lot of exuberant marketing, right? And you just, especially for new things, by the way, there will be AI washing lawsuits in a couple of years, right? But I think that you just, as a fiduciary, have to tone it down a bit. I think secondly, for something which is quite evolving, our processes were quite immature. I mean, we have, fixed it since then. So therefore, great to put the matter behind us and be able to look forward, because to the point you made, sustainability is such an important topic, and we feel we can be much more front-footed going forward.
Do you believe in the term ESG?
I think it's a complicated term because you just put so much into one thing, right? And obviously there's a huge difference between climate change, biodiversity, governance, gender diversity. And so therefore we like to look at it individually. Right? But I think the sustainability piece, so really specifically climate, is such a gigantic challenge that it just really deserves utmost attention.
You think about what's happening in the world of energy. Germany in particular has been in the center of the storm. When you think about energy security, how are you thinking about the relative dynamics between what's happening in Germany, broader Europe, and the US, and how your investors want to put their money to work in these very tumultuous times?
So I feel it's somewhat unfair when people call Germany the sick man of Europe, which we haven't done, so thank you for that. I like to think of it more as the sore athlete, right? Because we clearly have a really strong foundation, but I think we're pretty naive in not appreciating who we get stuff from and who we deliver stuff to, right? Because Germany is quite good in getting commodities from all over the world, unfortunately also from people that we rely too much on. And obviously, given that we are probably the most long globalization country, we have been also suffering from deglobalization over the last couple of years. Okay?
So deglobalization, what does that mean in terms of your footprint and where you might double down?
So we are still operating in 7 markets in Asia, for example. So a quarter of our AUM is in the US, right? Majority obviously in Europe, but we're still in 7 markets in Asia. And that's what we want to expand. Like I recently spent a week in India, which I find a phenomenally interesting market. Not easy for foreigners and not easy to see how you can add value, but that's the market we're looking at. We are reasonably large. In Japan can do more. We own 30% of the 7th largest asset manager in China. So Asia is definitely interesting. But then again, a quarter of the AUM here in the US, and it's also a market we want to grow in.
Certainly a lot to cover there. But you said something earlier I want to come back to, which is this idea of AI washing. Interesting thing to bring up when there's so much exuberance in the AI trade. Do you think it's misplaced?
So I think there's definitely a lot of buzzwordy, people on stage talking about it. it's definitely real, but let's think about what it could mean to asset management. So clearly we'll have efficiency cases, so personalized emails, people watching, I don't know, Fed speak, and that obviously can be done by AI. The question is, can the essence of what we do in asset management be AI'd, right? And I think it can, right? So just imagine if you are a high-yield analyst, so obviously the way that you look at securities will be a certain way. If we can actually get your perspective on the market into an algorithm, they would then allow you to be much more precise, efficient, always challenge whether the security you pick is really, aligned to your normal thought process. But I think the challenge will be to actually get people, humans, to essentially explain their way of thinking in order to create algorithms from.
You think about how fast Wall Street has changed under the speed of technology, even settlement times, for example. Do you think Wall Street can keep up with the AI revolution?
I mean, asset management is probably the least disrupted part of the financial industry. Right? So when you think about the financial industry 20 years ago versus today, retail banking has been completely disrupted. I mean, think about equities, right, which you covered early in your career. It looks completely different to 20 years ago. Asset management still looks pretty much the same. So I feel that the combination of AI, which can take out certain things of what we do, but also digital assets will be interesting disruptive element for our industry.
You have a tie-up with Galaxy, Mike Novogratz's firm, when it comes to distributing assets in the digital asset space. Why is this a space you're focused on? There's a lot of questions around blockchain, Bitcoin, and the value of digital assets.
So I will try to run out the time on this topic, not just kidding. So 3 things we focus on. So crypto is not something we would really advocate, but some of our distribution partners told us that their clients care and they need to be able to provide safe access to crypto. So one of the things we do with Galaxy is launch a couple of crypto ETCs actually this year. When it comes to euro stablecoins, so bringing fiat currencies on blockchain, I think that's going to be quite interesting because, at least in Europe, the digital euro will take some time. And then the whole idea of having real assets being represented on blockchain, I think is going to massively simplify the value chain between investor and investment. So that's also interesting.
If AI isn't coming out for the asset management industry, what about other technology giants? What role do the Apples of the world take in terms of their push into financial services? Is it something that worries you long term?
Coming back to the point of us being the least disrupted part, it definitely worries me. So I spent the last 4 years before I moved to asset management in transaction banking. And in many cases, the payment element has just become an afterthought, kind of pushed back by the PayPal that you see. Right? So we basically just became embedded in front ends that clients would kind of communicate with. I think the same could happen to asset management. So could you imagine, somebody, less educated and less following the market just saying, I want to invest 8% in IG, 7% in, Vietnam and so on, without requesting a DWS product behind. And I think that could happen. Now, in that case, we need to be as embeddable as possible into whatever front end the clients communicate with. Right? So that's one of those things that keeps me up at night.
What else keeps you up at night? When we think about the markets, we're on fragile footing. What worries you the most?
I mean, geopolitics, but I guess that's an easy one to name, right? I think that next year could be tame, but could be a lot of weirdnesses you could see next year. I think, to give the central banks credit, the fact that, over the last 12 months, we went from really fearing a recession to kind of debating whether it's re-acceleration of inflation or maybe a mild recession is a massive achievement. Right? But, we have a lot of new technologies. And, one of the things that worries me is if you look at countries' wealth creation, there will be massive amount of wealth being created in AI, for example. But I don't know if the whole population will benefit. So that's one of those things to keep in mind.
When you mentioned geopolitics, you were talking about your relationship to China's asset management industry. What are you more concerned about at this point, the relationship between the U.S. and China or China's own economy?
It's probably one of those questions that could get me in trouble to answer it on live TV. So I think that China is doing better than people give it credit for. I mean, it's still growing at 5% real, right? Like meaning, and that's clearly substantially more than what the US or Europe is growing. So I think for us to dismiss China as not growing at 8% anymore, or maybe real estate being in trouble, I don't think China cares too much. I mean, I think they have a probably more diversified economy afterwards. And when you think about the massive reliance that the US has on China processing commodities for Tesla, that dependency is something that we should always keep in mind, right? So hopefully cooler heads will prevail. You will always have politics, but I think the real economy flows, they haven't really been impacted over the last couple of years.
That was DWS Group CEO Stefan Hoops with me. Matt, thank you so much for your time.
All right, Shanawi, thank you for continuing to bring us fantastic guests. Stefan Hoops, also appreciate you being in the studio with us. Still ahead, Meta is about to unveil a VR headset that could be 1/7 the cost of Apple's competitive product. We'll discuss that with Mark Gurman next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Markets. I'm Matt Miller. We have breaking news on Kraken, the crypto exchange. It plans to offer trading in U.S.-listed stocks and ETFs, exchange-traded funds, marking the 12-year-old company's first foray outside its cryptocurrency roots. I just thought that was an interesting story that we should bring to you. We'll continue to bring you any details as they come across the wire. Now, in just a few minutes, Meta, the owner of Facebook, is unveiling its latest products and software updates. Let's turn to Bloomberg's Mark Gurman in LA to find out, what we should be watching for and how well they're going to compete with Apple. Mark, we just said, this product that we're expecting from Facebook is going to cost 1/7 that of the competitive Apple product. Are they really in the same exact market?
They're in the same market, but they're not in the same league, if that makes sense, right? They're both in the mixed reality. They're both in the XR market. Meta is repositioning their foray into headsets from the metaverse, from devices where they thought you would communicate with people, or they thought you would video chat with people virtually, right? They're transitioning to more of a productivity and gaming device, something more of a computer replacement using mixed reality, which is exactly what Apple is doing. And they're in two different leagues in terms of the overall performance and capabilities and resolution and clarity that you're getting from the Apple device. That is going to be infinitely better than what you're getting from the Meta device. But is it 7 times better? That's the question, right? Is it worth spending $3,500 for those improvements versus $500 for something that, for all intents and purposes, works pretty well? I've had the opportunity to use the device a couple of times now, and I came away impressed with its graphics power, its overall performance. The resolution of the lenses in the Quest 3 is a big improvement over the Quest 2. But I think this is going to shape up, maybe 3 years down the road as the future. Instead of iOS versus Android, it could be Vision OS, which is the Apple operating system for mixed reality, versus Meta's XR operating system on their Quest devices. You have that low end and you have that high end. Two alternatives, different leagues, same market.
So I imagine these are going to be, much like the iPhone, devices that you upgrade every year or two. How big is this market?
Yeah, I personally, I respect your opinion. I personally disagree. I don't think these are devices that you're going to upgrade on an annual basis. At least at this point, it's a very nascent market still. I think this is something that's going to be more so on the tablet or computer upgrade timeline, right? It's very possible that people hold on to these and, never get hooked on it and never upgrade it. It's also possible people upgrade these every 3 to 4 years. So I don't think these will be on an annual basis. Right now, it's quite a small market. In the first year for Apple, in terms of their sales, they'll probably only make $3 to $4 billion in revenue on this, which is basically half or a quarter of Apple Watch or AirPod sales. But over time, it could grow exponentially. The reason you're seeing a higher price on these Meta devices now and that higher storage tier is they want to start making money, right? These have been a money-losing proposition for them the last few years. It's time for them to turn the corner, and the hope is that the Quest 3, especially at that low price point compared to that $3,500, could be the one to do the trick for Meta.
All right, Mark Gurman, deep in the research on these devices, so I respect your opinion more. Coming up, let's talk about how a government shutdown would affect the Fed's rate path. We heard a little bit of that from Neil Kashkari. We'll talk about it more on the other side of this break. This is Bloomberg.
thing that strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
John Oliver. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a look at what's going on in the markets at this hour. It is a risk-off day as financial conditions tighten. The S&P 500, you can see, down 0.7%, 42.44, the level on the benchmark index. You have the U.S. 10-year yield continuing to rise, now 462.19, the highest level that we've seen since at least 2007. The Bloomberg Dollar Index climbing to the highest level we've seen since last year, 1273.69, a more than 0.5% gain there. And crude oil continues to climb as well. This is a NYMEX quote. Brent is at 96. West Texas Intermediate 93.46. So up more than $3 a barrel, John. Some pretty substantial moves in asset prices today.
Yeah, especially with that data suggesting a tighter supply picture in the U.S. And that's where I wanted to start, Matt, because you are seeing energy stocks outperform on another down day for Wall Street. Actually, it's interesting. The 7% slide we've seen for the S&P 500 since the end of July does not match up with the energy stocks like Exxon, which has actually rallied about 10% since that stretch. Gold has been struggling in this environment recently, and we're seeing that reflected in names like Newmont, which is down another 5% today. It's slumped about 10% this week. And then on the retail front, wanted to come back to a couple of stories that we've been tracking throughout the trading session. You had Costco out with quarterly results that basically showed a picture of consumers sticking with the membership-driven retailer. Those shares up about 1% right now. Amazon, though, Matt, down once again today as investors are digesting the FTC antitrust action, and Bloomberg doing its own reporting on some of the behind-the-scenes interworkings of how Amazon does business. So we'll continue to track that story.
All right. Yeah, definitely some fascinating storylines today. None maybe as big as the prospect of a government shutdown, which looks like it's going to happen on Sunday. It's getting more and more attention from economists as well as political watchers. House Speaker Kevin McCarthy, though, remains hopeful.
We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
And one person with an eye on the situation is Minneapolis Fed President Neel Kashkari, who said earlier today we might then have to do less with our monetary policy to bring inflation back down to 2% because the government shutdown or the auto strike may slow the economy for us. David Wilcox is Director of U.S. Economic Research at Bloomberg Economics. He joins us now from D.C. And David, you put together a really, especially for Bloomberg Terminal users, a really helpful breakdown of some of the key areas to be focusing on right now. I guess let's start with the economic assessment of what happens in the case of a shutdown. What do we need to know on that front?
Well, the playbook is pretty apparent here. A general rule of thumb is that for each week that a shutdown persists, GDP will be nicked to the tune of about 0.2 of a percentage point. So, for example, a 5-week shutdown lasts, in other words, about a month, would take a percentage point off the growth of real GDP in the fourth quarter. And then growth would be bumped up by a percentage point in the first quarter, restoring the level of GDP, roughly speaking, to its non-shutdown trajectory.
What are the the permanent effects? I mean, what actually leaves a mark? Because I don't think it matters that much if we lose a percentage of GDP one month and just gain it back the next.
Yeah, from a macroeconomic perspective, the permanent marks, if nothing really untoward happens, the permanent marks are pretty small. I wouldn't want to underestimate the microeconomic marks because there will be federal workers who normally exist paycheck to paycheck who have to go without pay during this period. There will be federal workers who have to work during the shutdown period without getting paid. There will be contractors who will never be paid, even retroactively. So at the individual level, there's going to be some hardship. And then, of course, there will be significant consequences from the normal operations of government simply coming to a screeching halt.
David, John was reading the quote from Neel Kashkari saying, this could do some of our work for us in terms of defeating inflation. to me, the auto worker strike seems inflationary because you'd have less supply of vehicles, and wages, obviously, when the thing is resolved, are going to rise, at least for those 150,000 people. What about a government shutdown? Is it at all inflationary or deflationary? What's Kashkari on about?
So the main effect for the Federal Reserve's two objectives is pretty much neutral. This will be a self-healing pothole on the unemployment rate. The unemployment rate, if the shutdown lasts long enough, could jump by as much as 0.4 of a percentage point. That'll come down as soon as the shutdown ceases. For the price gauge that the Fed ties its policy to, there basically won't be any discernible effect. There could be a little withdrawal of purchasing power, a little hesitancy as households pull back on their spending in light of the greater uncertainty, but that'll be a pretty subtle effect. The real concern is that this shutdown doesn't come in any old average period of time. We're in a delicate moment macroeconomically. The Fed has restrained the economy by undertaking its hiking campaign of more than 500 basis points in rate hikes. There are other turbulence factors here at work, including, as you mentioned, the UAW strike, the restart of federal student loan required payments. Those are slowing the economy, and the Fed doesn't need, and the economy doesn't need, yet another source of turbulence.
Right, and then how do you assess, let's say, October data if you're the Fed and we see a shutdown, which we'll continue to watch. David, thanks very much. David Wilcox, Director of U.S. Economic Research at Bloomberg Economics. Meanwhile, Blackstone is expanding despite the economic uncertainty. The private equity giant has opened an office in Toronto and plans to invest more in Canadian real estate and industries tied to the energy transition. Earlier, I spoke with Blackstone President and Chief Operating Officer John Gray, who shared his view on the economy.
The good news is the inflation is starting to come down. And so that is starting to show up in the data. I think we'll see it more around the world. We certainly see it in input costs in our companies where goods are basically flat year on year from a cost standpoint. We're seeing in the U.S. shelter costs or rental costs come down, their growth rates come down, which will be very helpful. It's the biggest component of CPI and core CPI in the U.S. And then in the labor markets, we're starting to see some softening there as well, where we're seeing wages, which were growing as high as 7+% a year ago, now growing around 4-ish% in our portfolio companies. So I think what we're going to see is inflation come down, which will allow central banks to pause, I think, fairly soon. But I do think on the flip side, they're going to hold rates at an elevated level. They don't want the experience of the 1970s where inflation came down, they cut rates, inflation surged again. And so I think they're likely to be more hawkish. That's certainly what they've been saying. And so I think we've got to expect that. The output from that will be likely an economic slowing. We've begun to see in the U.S. a bit of this, and I'd expect we'd see more. It's not 2008 or 9 in terms of imbalances, but I think you have to expect some moderation given the sharp increase in cost of capital.
A few years back, Blackstone's CEO, Steve Schwarzman, helped to play a role behind the scenes in bringing together the new NAFTA agreement. Jared Kushner, in his memoir, had described him as having a pivotal role in that process. Since then, we have seen growing tensions between countries like Canada and the U.S. and other countries around the world. China would be an obvious one. So getting that deal done in retrospect, how has that opened the door for a stronger performance, let's say, throughout North America in a world that might continue to change?
As you think about trade, getting that deal in particular done between the U.S. and Canada, I think was very helpful. Because if you think about investment, it's all about certainty. When you know, here's the economic framework, here's the trade framework, you're able to then deploy capital. And what we've seen around the world is when you have abrupt changes, when there are geopolitical tensions, invariably that makes businesses pull back. And the best environment is when there's policy around, certainty around policy, economic policy, trade policy, tax policy. Countries that migrate in that direction, particularly emerging market countries, attract more capital. You look at the turnaround in Greece over the last 5 or 6 years, it's been remarkable under the leadership of that government. And so we would encourage governments to find ways to encourage foreign direct investment, to encourage trade, and to have certainty of policy. I think we found that balance in the U.S. and Canada, and that certainly helped our activities here.
John Gray there, talking with John Ehrlichman. Coming up, the latest from Meta Connect, a conference that is underway right now. As you see the live feed here, Mark Zuckerberg is speaking on stage, and we'll bring you the details. This is Bloomberg.
And this is going to unlock a lot of awesome experiences for hanging out with people, watching content, and even if they're not there with you.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With 2 more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time now for our stock of the hour. We've been tracking Meta shares. They have been losing momentum over the last few minutes. Facebook's parent company hosting its annual developer event as we speak. Now, the stock has had a huge run this year. That was helped in part because of the AI boom. But we want to bring in Bloomberg Technologies' Ed Ludlow, who is joining us from San Francisco. He's been tracking this big developer event. And Ed, aside from the metaverse update, which we can talk about that. It feels like this is an opportunity for Meta to explain on the headset side how they're going to stay relevant versus Apple with the Vision Pro. I mean, what are you watching closely today?
Yeah, look, I can tell you that the street is super focused on artificial intelligence, and that's kind of away from the metaverse and hardware side of this story. The stock down, maybe this is sell the news. We got the Quest 3. They told us that we would get the Quest 3 at Meta Connect. They're raising prices from $300 to $500. It's a mixed reality headset, right? And some of the functionality that they're talking about kind of speaks to the strategy against Apple. You know, you can have virtual reality where you are playing a video game or watching a movie within the headset, but a tap of the button turns it into mixed reality. In other words, images imprinted onto a projection of real life around you. One source that I was speaking to ahead of Meta Connect at the company was saying, like, we're really keen to demonstrate that we've worked out how the software and hardware work together. And, you know, the Apple Vision Pro is at a completely different price point, right? $3,500. But it comes with that exclusive Apple software and content that everyone is pretty excited about in the first instance. And lots of folks were looking to Meta and saying, okay, you've got your hardware, you've taken a gamble to raise prices, because you've led this market to this point. What are you going to be able to do on this thing?
What are the most sort of killer app uses for this, Ed? I mean, is it for a consumer who wants to play video games, or Mark Zuckerberg was just showing a lot of sports that you could, I guess, get involved in with it, or is it for B2B purposes, or does anybody have products that are for that?
So far, it is very much a consumer-focused product, right? And heavy emphasis on video games in the virtual reality context. In the mixed reality context, the images that they've shown so far is the use case of imprinting a graphically generated image onto your living room. So that kind of speaks to who they're going after with this. The comparison with Vision Pro is that at $3,500, the Vision Pro in the first instance is very much targeted at the developer community. And to answer your question, remember what I reported earlier in the year. One reason that Meta had cut prices on previous generations of Quest, particularly at the high end, is that it was not resonating with enterprise customers. They really wanted to position this as a productivity tool. There is an emphasis on productivity with this, but not aimed at the high-end enterprise market.
All right, interesting stuff. Ed, thanks for giving us your perspective. Ed Ludlow, their co-host of Bloomberg Technology, and he's been doing a ton of reporting on this as well. Now, before this event got underway, Bloomberg Originals had a chance to catch up with Meta's President of Global Affairs, Nick Clegg, for its series AI IRL. He explained how Meta is making a distinction between AI and human-generated content.
AI systems not only recommending content, but now increasingly generating content. So one of the things that we've been working on is how to make sure that people can distinguish between the provenance, the origin of something which is generated by AI rather than generated by human beings. So we will have visible, clear watermarks on the photorealistic imagery that people will be able to use in something called /Imagine, which is our photorealistic tool integrated into Meta AI.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. The Writers Guild, which had been on strike for months, has finally struck a deal with studios. It includes higher wages, streaming royalties, and guardrails around the use of AI. Paul Dergarbedian is a senior media analyst at ComScore and has been tracking the Hollywood scene for years. And Paul, I guess part of the writer strike story being done opens the door to a question around whether the actors' strike can come to a conclusion soon. Do you see that happening?
I think so. I think this sets up a situation where, the writers sets the tone for this, the resolution of that strike. Now, the next step in this process is to get the actors on board, and I think that will happen. I mean, this sets a precedent moving forward. It shows that there's movement on the producers' side, willing to, come to terms with the writers. And look, you have to have writers, of course, but then you need actors to perform. So this is a two-tiered situation that we're so grateful, I think, the whole industry, and even those outside of the entertainment industry, those who have ancillary businesses that are affected in a positive way by film production, they're looking forward to this being resolved. And sooner than later is better. If this had gone on till next year, like a lot of people thought, that affects the production pipeline for TV and the big screens. So that would not have been a good outcome. Of course, it'll take a while for this all to get ramped back up. It takes a long time to create movies and television shows, but this is a great result. And I think the actors will follow suit if they can come to an equitable agreement.
Paul, one of the concerns is that you won't need as many actors or writers if AI shapes up the way people fear, people in that industry fear. How much AI is already being used in content that we watch, and how do you expect that to change over time?
Well, I think we're in early days of that, so I think there's a lot of fear in terms of AI. Now, AI can be used to, help write a script or even write an entire script. I know that authors have seen that their works have been either used as a model for or used to create stories or scripts or books that AI generates. So I think it's about trying to harness this technology, and anytime there's a new technology, you need either new case law or new protocols to deal with it. But I think the big fear is that can people be replaced by AI? And when I say people in this case, I mean actors and writers. And that's why in the writers agreement, there is a clause in there about AI. It's very important, saying that a writer can use AI to assist their work, but AI should not be used to replace writers entirely. So it just shows you how powerful AI is looming over everything, of course, up to and including entertainment and the creation of artistic works.
And Paul, now that you get some kind of resolution and maybe more with the actors on the horizon, what becomes the immediate focus? I mean, obviously you had a big box office summer. But at the same time, we're sort of retooling on the streaming side. I mean, where do the priorities on the business side end up going once everybody gets back to work?
That's a great question. I think a big part of this is the ability of actors to go out and promote their movies. And you look at a movie like Dumb Money, which is out there right now. It's a star-studded film, but the actors aren't able to go out. Now, writers technically can now go out and promote films or TV shows that they're working on. But to have actors out there, I think that's a number one priority. And then, of course, well, maybe really the number one priority is get writers writing, get production ramped up for TV shows and movies, and get that all going. But the promotion of movies, I guess we didn't all realize how important that actor participation is in the promotion of movies. And I think we saw Dune 2 move to next year. We've seen some movement of films into next year in anticipation of the resolution of this strike. Now that it's happened earlier, and hopefully the actors' strike happens very soon, those promotional abilities by the actors and creatives, that can shift into high gear and get all that going. So it's very important.
We've also seen, the fall schedule is a lot of reality TV shows. Yeah. It's a lot of, TV talk shows.
Yeah.
In a sense, it seems that the writer's strike has kind of forced the studio's hand there. Obviously, they're not around to create any content. Is that going to be hard to turn around? What if some of that stuff catches on? Have they kind of struck themselves out of future revenue?
Well, that's a great point, because sometimes out of these situations comes an opportunity for other types of content to move to the forefront. And you're certainly right. Reality shows and certain talk shows are able to continue, and they've moved to the forefront now. I think people are going to want that solid diet of diverse content, not just one category or another. So I think that'll work itself out, but it does show how powerful those other types of content are. And if we look at the Taylor Swift film, I mean, for theater owners, that was a dream come true. That opens on October 13th in theaters. And so the Taylor Swift Eras Tour is a concert film. It's not a narrative film, although there may be documentary footage in there.
Right.
But that also shows how alternative content for theaters is also a big deal. I think that'll continue as well. But I think all these things will work together in sync. And at the end of the day, it's us, it's the viewer who really wins in the end, because we want new content.
Yep. Paul, great to talk to you. Thanks so much for joining us. Paul Dergarbedian, Senior Media Analyst at ComScore, talking to us about the end of the writer's strike, and hopefully the actors' strike end will follow. We're looking at Mark Zuckerberg there at the Meta Connect conference talking about AI himself. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production, because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals, or 10 p.m. Eastern on Bloomberg TV.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
A downside scenario for almost every asset class. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to the closing bell here in the U.S. It's not too pretty of a picture. Again, with about 2 hours ago, the S&P 500 off by about 0.6%. It's the same thing if you look at big tech. The NASDAQ 100 off by about 0.6% as well, building on yesterday's losses. And once again, you have a sell-off in the Treasury market. You take a look at benchmark 10-year yields right now, higher by 8 basis points. We're looking at 462 almost on the 10-year yield. That is the highest level going back to 2007. And all the while, oil as well on a tear. You can see crude oil, we got above $94 a barrel earlier today, currently about 3.5% higher, Romaine.
Yeah, and if you remember, Katie, it was at the start of last week where we hit 91 bucks a barrel on WTI. At the time, that was a year-to-date high, but that march towards $100 a barrel actually was put on pause for quite a few days, but now resuming here on this Wednesday afternoon. We talk about the idea here, the march higher, and the biggest one-day surge right now that we've been seeing in futures prices going back to mid-June. Now, that's taken out both the year-to-date high, and it's also taken out, believe it or not, that 52-week high as well here. We talk about why, and we talk about what's next here. A big investor positioning right now, whether you're looking at the CFTC data here on the U.S. side or overseas there when it comes to Brent crude, the trend right now appears to be going higher, and a lot of that has to do with the premium that we're seeing between the month contracts and the end month contracts here. And the narrowing in that space here seems to suggest right now that we're talking about the potential for an increase in the tightness in supply. That tightness, of course, a big part of the reason why we've continued to see that march higher. A huge turnaround for oil here, which at the end of June was sitting on a 12% price decline, but has since rallied more than 30% since. A similar pattern unfolding for the dollar, which was in the red for the first 6 months of the year. That has since crawled its way higher by about 5% from the year-to-date lows back in July. That Bloomberg Dollar Spot Index currently on a 6-day run, longest daily win streak of the year. But SocGen chief FX strategist Kit Juke saying that he sees the potential for a reversal if a U.S. government shutdown lasts for more than a week or two. A scenario, he says, will, quote, derail the doom loop of rising yields, rising dollar, and a, quote, still okay economic data. But for now, yields aren't cooperating with that scenario. The benchmark 10-year higher for the 8th time in the past 10 sessions, and compensation that investors demand to hold those longer-dated issues, that so-called term premium, Katie Greifeld, has this month widened to some at the fastest pace that we've seen since 2009 at the end of the financial crisis.
And we can say we're back in positive territory, at least if you look at the New York Fed's model of the 10-year term premium. Like Romaine said, this is the extra compensation that investors get over holding the expected short-term path of rates. You can see that we flipped back in 2021. This is the first time we're turning positive. But really, for the past 7 years, the term premium has been deeply negative. So we'll see if this is sustainable. And the fact that, again, the first time since 2021, pretty dramatic, but then you take a look at nominal interest rates, even more dramatic. The sell-off across the curve, bringing us to cycle highs, especially when it comes to the long end of the Treasury curve. You're looking at 10-year yields, you're taking a look at 30-year yields. We are at the highest levels going back to 2007, 2008 territory. And the question becomes, Romaine, where's the ceiling? Where do we stop? And also, what is actually driving this?
All right, well, let's pose that question to our first guest. Maureen O'Connor joining us right now to kick us off to the close. Global head of high-grade debt syndicate over at Wells Fargo. Maureen, great to have you here. And I'll just steal Katie's question there, because I think that's what everybody really wants to know. When do we sort of start to finally see that top?
Well, I think our call at Wells Fargo is that we're pretty much looking at it right now. I think, what we're dealing with is at first sort of a simple supply and demand imbalance, right? You have the Treasury that's been ratcheting up supply. We had the refunding announcement in the summer that obviously surprised to the upside. You couple that with a more hawkish Fed sentiment from last week, threw a little bit of gasoline on the fire. And then on top of that, you have balance sheet liquidity that's pretty constrained right now. You have the Fed draining liquidity out of the market. You have balance sheet liquidity across the street from a regulatory standpoint only getting lower. And then you pair that against an environment where foreign demand for U.S. Treasuries is, definitely ratcheting lower as the cost to hedge dollars against other G7 currencies has gotten prohibitively expensive. So you're really talking about technicals here that are pushing things higher. I think the concern is, do we hit a point at which you start to see some of that convexity selling from the mortgage portfolios?
Yeah.
And I'm not sure that we're there yet, but we're flirting with it.
Well, then fold that into the corporate credit space as well, because, you can look at what we've seen in Treasury yields, and I think there is certainly some negatives there that people will look at. At the same time, when that feeds into what I guess maybe you're seeing right now in the credit space, particularly with investment grade credit, I would think that would also present some degree of opportunity.
Yeah, well, I mean, it's interesting. When you look at the investment grade bond market right now, yields are basically at the year-to-date highs. But the percent of yields that is represented by spreads, so the spread over which, our bonds trade relative to the benchmark, is at its lowest since 2007. So said another way, 80% of the yield in our market is Treasury yield. So it's almost like investment grade and credit more broadly is trading a little bit like a macro product, trading like a rates product. So when you think about 6% yields at investment grade, which is kind of where we're sitting right now, that historically has been a very, very strong entry point for investors. So we have a lot of demand for our product right now. Unfortunately, for borrowers, it's a much more difficult landscape to navigate because you are looking at probably some of your most expensive debt in a cycle. And the question is, can you weather this storm long enough? How much is higher for longer? How long are we going to be in this environment? And what can you do tactically to access the market in a way that feels as painless as possible against a higher rate environment like we're in?
Well, that's where I wanted to go. If you're a borrower right now, you're looking to issue debt. Are you on the sidelines? Are you trying to time this market?
So the answer to that question is it depends on who the borrower is. And actually what's been interesting about the supply that we've seen this last month, it has shifted in favor of our spread-based borrowers. So issuers that tend to swap their fixed coupons to floating, a lot of bank supply. Spreads are at year-to-date tight. So naturally, if you are a spread-focused funder, this looks like an opportune window to come. If you are a corporate borrower and tend to be more fixed-rate focused, now you have to shift your thinking towards more defensive strategies like you're referencing. Some options are to use some of your balance sheet liquidity and pay off your near-term maturities with cash and de-lever or fund whatever
pace. I mean, we saw this year out of some of the key funds here. And I don't know if that had to do with concerns about economic conditions, or maybe it was just competition from returns that you can get in other investments. But where do we stand right now?
Yeah, I think one of the most compelling stories in the muni market right now is just the high absolute yields. You really have to go back to taper tantrum, fall of 2013 to pick up yields like we're able to pick up in today's market. So just a couple of data points there. 30-year AAA munis right now are yielding a little bit more than 4.3%. And as you know, the municipal market's a very high credit quality asset class. If you go down the investment grade credit spectrum, down into the AA, single A, triple B portion of the municipal market, those yields are north of 5% for the triple B index, which on a taxable equivalent basis is north of 8%. So it's a very compelling opportunity right now, just from an absolute yield perspective for munis. You're absolutely right that open-end fund flows were very negative in 2022. They've stabilized somewhat in 23, but we think there's a lot of cash sitting on the sidelines waiting for these opportunities.
Well, Ben, that's what I wanted to talk about. What are munis competing with? Are they competing with money market mutual funds? Are people just happy to sit in cash where they can get comparable, if not higher yields?
Yeah, absolutely. They're very happy sitting in cash. So I'd say that's the number one piece of competition for the municipal market is, investors just sitting in money markets or cash equivalent type of investments. We have seen a lot of interest over the last couple of weeks and months as these yields have just continued to rise for people pushing out from cash and cash equivalents into the fixed income markets to get a little bit more normal asset allocation. We think one of the big positive catalysts for flows really to come back into the municipal market will be the yield curve inversion flattening, and then ultimately getting to a much more normal upward sloping nature to the yield curve. And we've seen some steepening here just even over the last couple of weeks.
Yeah, and that's actually what I was wondering. What actually will be the catalyst? Is it yields on cash and some of these short-dated, very safe instruments coming down, or is it long-end yields actually getting to a point where people can't resist?
Yeah, I think it's a very good question, and I think the FOMO, the fear of missing out that investors have sitting in cash, if they miss this opportunity to invest out the yield curve and lock in some of these really attractive rates, will be very real. So I think the muni market is uniquely inefficient because it's a retail-driven asset class. It's not really an institutionally driven asset class. So being a retail-driven asset class, it tends to be more inefficient. So when the moves happen, they tend to happen very, very quickly. And so with any sort of flattening to the yield curve or an upward sloping nature to the yield curve, I think that'll be a very positive catalyst for money flowing right back into open-end funds in particular.
All right, great insights here, Ben. Ben Barber there, Director of Municipal Bonds at Franklin Templeton Fixed Income here for our Muni Moment. Katie Greifeld on a Wednesday afternoon where we're seeing the broader market, which when we started this show about an hour or so ago, was deep in the red, and it looks like we were headed for another down day. But now everything pushing back into the green, believe it or not, led by the Russell 2000, up more than 1%.
Well, I have the same question about stocks I do have about the bond market.
Oh, yeah?
What's driving it?
Yeah.
I don't know. For stocks, did anything fundamentally change in the last hour and a half? Probably not.
Probably not. There's so many knee-jerk reactions here. Everyone's trying to piece together a narrative, but how do you do that when you have the dollar on a tear, when you have yields continuing to go higher? And you're seeing right there on there, one of the main indices attracts the Chinese property developers down again. Katie Greifeld, do you not care what's going on in China property?
I also care about oil.
Do you?
Yeah.
Okay. Well, you got to fill up that big gas guzzler that you drive to work every day. Stick with us. We'll be back in a moment. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Well, pop star Katy Perry, the other Katy, she's heading to court with the founder of 1-800-Flowers, Carl Westcott, all over a $15 million house in Montecito. Now, Perry and Westcott are feuding over the ownership of the estate. Westcott says he never wanted to sell his home. He was not of sound mind when he inked the deal. And Perry, she's not walking away from the purchase. She's expected to take the stand as soon as Friday. And Romain, we're talking about an 8-bedroom, 11-bathroom estate. Sprawls over nearly 9 acres.
It looks nice here. I'm a little confused about the dispute here. I mean, he bought this place back in 2020, then put it back on the market a couple months later, signed this deal with Katy Perry, or at least her people who run her finances here, and now he had regrets.
He's saying that he was on painkillers at the time, and he wasn't of a sound mind. And
I mean, who isn't? I mean, I don't know. I mean, it's a contract, right?
I know. And so apparently they're going to court.
I mean, how is this in court? I mean, either he had the right or I guess the cognitive ability to sign this, or he didn't, right?
I know that we're focused on the shutdown and that Saturday deadline, but
is this the more important story?
I don't know. It starts on Friday, so we'll see what the news cycle is. But I agree. It does seem pretty clear cut. But who am I? I'm just the other.
Does Katy Perry not have a home?
I don't know.
Does she really need this one?
Her and Orlando Bloom.
Who's Orlando Bloom? That's her husband?
Her partner. Okay. He was in Pirates of the Caribbean. Yeah. Very handsome. Legolas.
Not the other, not the Johnny Depp guy.
No.
The other one.
No, the other guy.
Yeah, Johnny Depp.
In any case.
Johnny Depp was just.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
You ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is the countdown to the close. About 30 minutes left to go here in the trading day, Katie. Another interesting day for equity markets, continue to be battered around by higher yields and a higher dollar.
Going back and forth, right now the S&P 500, it's in the green. You take a look at the sector level, it's pretty much an even split. As you can see, energy up top makes sense when you have crude oil off to the races. Energy up by about 2.6%. Industrials getting in on the action, as too is communication services. That's the good news. You go down the list, look at what is not doing too well today: healthcare, consumer staples, and then utilities at the bottom, off by 1.7%. Interesting to see consumer staples and utilities really taking it on the chin today. Romaine, typically those are your defensive sectors.
Yeah, absolutely. Here, when we talk about some of those defensive sectors, at least for right now, the defensive sector is going to be the energy space. Occidental Petroleum up 4% here, but then you look at some other names in the energy space like NextEra Energy on the back of some guidance that really caused some concerns amongst investors. Those shares down about 8% here, one of the biggest decliners in the S&P here on this day. And Mattel, though, getting a boost. An interesting note out here from the sell side here, saying that there is a potential here for a rebound in some of these consumer names, particularly those like Mattel and Hasbro here, as we get deeper into what here in the U.S. at least is a traditional holiday shopping season. But if you're looking for that canary in the coal mine, you actually might find it in the consumer discretionary space. Remember, that was the big outperformer earlier this year, but that has flipped a big time. The bloom has really come off the rose. In fact, the consumer discretionary sector in the S&P now on setting up for what's going to be a 7% drop here in the month of September. Worst drop all year long here. And a lot of people are saying that when you look at some of the concerns about a government shutdown, the resumption of student loan payments, and concerns here about credit card balances and just how much cash is really in the pockets of some of these households here, the main pillar of this economy, remember, the bulk of our GDP coming from consumer spending and a lot of it from the discretionary side. If investors don't think that's going to hold up, it makes you wonder what's going to happen with the rest of the market.
Well, let's go from that sector back to the bond market and what to expect next from the Fed, including how a government shutdown could affect monetary policy. Joining us now, I'm thrilled to say, is Jerome Schneider. He is Managing Director and Head of Short-Term Portfolio Management and Funding at PIMCO. And actually, Jerome, I want to start on the long end of the curve because the moves that we're seeing have been pretty staggering. We're at cycle highs across the curve, particularly at the long end. And when you look at that and you look at the pace of the moves that we're making, have we moved beyond fundamentals? Is there something else going on driving these moves?
Yeah, Katie, good to be with you here today. We believe that there is obviously a significant move to be had. It's driven by some volatility, some recalibration and inflationary expectations for a little bit longer. That's been propelled by the recent discussions within the Federal Reserve. But ultimately, investors have been preparing and are continuing to prepare for a higher for longer scenario, at least for the immediate future. And what that means is two things. Number one, that term premiums, meaning the shape of the yield curve and the premium you should demand for being in longer maturities, continues to recalibrate higher, and that's denoted by the reinflation, if you will, of the 2s-10s spread by moving more than 30 basis points in recent weeks. And the second thing, ultimately, is liquidity premiums. The notion of having the amount of cash and what liquidity is worth in the marketplace has continued to move higher. And as a result, what the investors are really telling you is that they believe the Fed is going to be on hold for a reasonable period at this point in time. They need to be paying or achieving higher yields in this regard. And fundamentally, the fixed income universe is much more attractive than it was even a few weeks ago as a result. And so that balance is sort of a healthy recalibration and rationalizing what the Federal Reserve continues to tell investors, to be vigilant, to focus on the possibility of a soft landing, but at the same time, trying to avoid the tail risks of longer-term inflation outlooks that will remain higher than expected.
So to the point that fixed income is more attractive than it has been, of course, yields at 15-year highs will do that. But then you think about the volatility that's coming from fixed income. I think it's safe to say the Treasury market has been a lot more volatile than the stock market. The fact that what's supposed to be the ballast of your portfolio, the volatility dampening part, what does it mean that that's actually where a lot of the volatility is coming from?
Well, that might be true in the microcosm of hour-to-hour, day-to-day moves that we witnessed over the past few weeks. But what I think we have to look at is the portfolio composition as a whole. And historically, the equity volatility tends to be much more profound than the fixed income volatility. We actually look at equities, we actually look at the fixed income balance in the portfolio as being a diversifier and specifically actually helping to reduce portfolio volatility. Well, how is that? We specifically look at the difference in how we achieve returns. And in this world where we are today, those returns are achieved by earning income, by receiving distributions and coupons that right now are in excess of 5%. And as a result, portfolios have a lot of cushion within that fixed income universe that helps reduce the volatility profile of their portfolios and actually not increase it. And so while you may not necessarily have the precise entry point of knowing where the 10-year note is today, tomorrow, or the next few weeks, the recalibration of where we are in the range of 4.5% right now presents a really interesting opportunity for investors to increase those distributions and actually reduce the volatility in a portfolio, especially given the uncertainties we see in the economic outlook that might still be a tail risk to investors' portfolios over the cyclical horizon.
Well, let's talk about that uncertainty. And I guess one part of that some people seem to think is certain, which is that the Fed isn't done, or at least is certainly not going to cut rates anytime soon. How does that change, if at all, the general calculus here or what you hold?
Well, part of the calculus is what we see obviously going in the marketplace with the rates moving to the higher end of our spectrum of what we believe at PIMCO. But at the same time, what we think is a critical juncture for investors who have been typically underweight fixed income for many years at this point in time to begin to rethink the value of fixed income in their portfolios. And the initial impact is to think about how to move to cash, put that to work, and then move slightly beyond those spectrums. We think that there's an opportunity, no matter which way the Federal Reserve moves, by being in the front end of the yield curve potentially. And the way we think about it is there's three different outcomes. The first one is the Fed remains on hold for a foreseeable future. In that case, you're going to earn an above market premium by being at the front end of the yield curve compared to money market funds, often in times of 100 basis points or more. So those returns are about 6.5%. In a rate hike, you're also being more defensive by immunizing your portfolio to the mark-to-market risk, and at the same time earning the higher yields by being in instruments like floating rate notes. And the third element is, should you have an unforeseen shock where the Federal Reserve actually has to cut rates, you're going to have the ability to reinvest cash and have already reinvested cash with much longer duration than being in a money market fund, which will recalibrate its yields immediately. So we view this as a thoughtful process where investors who have a lot of cash on the sidelines begin to dip their toe into that fixed income universe and potentially continue to move out the yield curve as they find opportunities and they get more comfortable with the yield outlook where we see it right now.
All right, Jerome, it's great to catch up with you. Really appreciate your time. Our thanks to Jerome Schneider of PIMCO. Now, coming up on the close, big news from Meta, which is looking to capitalize from consumer AI. Meanwhile, Snap is shuttering its augmented reality unit just 6 months after its launch. We're talking tech, rather, for our stocks of the hour. Up next, this is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
All right, time now for our stock of the hour. A broader look at the tech sector regarding the future of the social media space. Artificial intelligence and augmented reality could be the stars of the show, but two distinct companies, Meta and Snap, moving in different directions, both in terms of their stock price as well as their strategy going forward. Alex Barinka joining us right now to talk a little bit more about what we've learned. And Alex, let's start off here with the big event that Meta just held. Mark Zuckerberg taking the stage in that really tight t-shirt there, trying to explain why all these new features that he's rolling out for chatbots, et cetera, will somehow be the salve for their AI dreams. What did we learn today?
I'm here still at Meta, where he did roll that out in person. And there are two kind of really big buckets that Mark Zuckerberg was talking about here at their annual Connect conference. The first was virtual reality and mixed reality, like you mentioned. They released their new Quest headset, the Quest 3. It's a $500 headset that they're really pushing for mass appeal, trying to get everyone with this thinner headset to be spending more time not only in virtual reality, but there was a lot of talk today and a bit of a change of tone about mixed reality. Zuckerberg said you can put this headset on, look around your room, play games with your friends in both virtual and bringing these images into your real life. They also released a pair of Ray-Ban sunglasses with cameras on it that fits into their kind of hardware offerings. The other big talk of the day, which which is quite a difference from what we heard out of Connect last year, is artificial intelligence. The company came out today and rolled out basically its first big slew of consumer-facing generative AI tools. Everything from the ability to create custom emojis or stickers in the Meta apps to chatbots, both a Meta AI chatbot that you can ask questions and it will search things for you in partnership with Microsoft's Bing, but also a number of celebrity face chatbots that are really specific. You can ask a character like real celebrities. Tom Brady, apparently this is his second act. You can ask a character called Brew about sports information, and Tom Brady's face is there in video format answering you with the help of generative AI. So a kind of a wide range of things here for Meta, really kind of showing both developers and consumers here at the event today and investors where their kind of big direction will be for the next couple of years.
Well, Alex, let's bring this to Snap, because you mentioned that Zuckerberg, his focus was on AR, on augmented reality. And then I'm looking at your byline. I see the news that Snap is shuttering its AR unit, just launched this year. So it seems like Meta is going into an area where Snap maybe hasn't been as successful.
Snap historically has been really strong on AR, and building on that success, they launched this unit called Ares, the augmented reality enterprise services business. They were trying to take the AR they're so good at in the Snapchat app through lenses, the puppy dog face you can put on your face, and build that into retailers' websites. Well, in the memo that I read and we wrote about this morning from CEO Evan Spiegel, he said that websites were too much of investment. It's too difficult. So they're cutting this business. They're losing about 170 people who worked for this business unit. And instead, they're retrenching on kind of the consumer-facing stuff. So this is really setting up an interesting standoff with Snap, who has been talking about augmented reality more than virtual reality, much more than Meta. Meta, who used to be all in on virtual reality, and now they're kind of running into each other here, one on Meta's headsets and the other on Snap's Snapchat app.
This does seem to be an issue, too, I guess, of who has the deeper pockets. I mean, Meta, at least in theory, can spend a lot, I guess, until investors finally try to clamp down on Zuckerberg. I mean, Snap, its R&D spending was just out of control.
It was, and analysts expect this for Snap to be their first yearly decline in revenue. So Snap has gone through kind of a retrenching, a reprioritization. They've killed a lot of business units. This was one of the few next to AI that actually made it out of a big refocusing year that they've had over the last 12 months. Meta, too, is in their year of efficiency, but they have been spending on record levels behind the scenes on things like artificial intelligence infrastructure and, of course, the metaverse, which is at times investors' favorite, but also least favorite story of the hour coming out of Meta Platforms.
All right, Alex Brink out at the Connect conference there at Meta's headquarters. A look at Meta and Snap, our stocks of the hour, as we move closer to these closing bells. Amy Kong, partner and wealth advisor at Corient, going to be joining us after the break. This is Bloomberg.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
The thing that strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
This is the countdown to the close. I'm Romaine Bostic alongside Katie Greifeld here. Another interesting day in the markets. We were well off the lows of the day, but now off the highs of the day. Kind of a mixed day here, coming off what was one of the biggest sell-offs that we've seen all year yesterday.
Yeah, a mixed bag in the equity market, but the direction of travel clear in the bond market, of course, and that's yields higher.
Yields higher, the dollar up for a sixth straight day, longest winning streak for the Bloomberg Dollar Spot Index all year long. Gold also moving lower here on the day as inflation expectations and Fed expectations start to get adjusted. We should point out we are getting some earnings after the bell. Micron going to be coming up once we get to those closing bells. Full coverage right here on the close. We are just about 9 minutes away from those closing bells. Amy Kong joining us right now, partner and wealth advisor over at Corient, which has about $150 billion in assets under management. And Amy, let's start off with kind of this inflection point that we seem to be at. I don't know if people are making bets on economic conditions or they're just trying to make bets on what the Fed might do, or if there's something maybe more fundamental that's been driving the price action as of late.
Yeah, thanks for having me. I think you're absolutely right. There's obviously a lot of debate over the direction of the economy given the Fed's more hawkish comments recently. At the same time, we are seeing a number of factors hit the system, whether it's strikes, whether it's student loans starting to become repaid again, or, in essence, a lot of different factors hitting the tape. And I think ultimately, because it's all hitting at the same time, the market's starting to lose a little bit of direction. And obviously, some of the froth that we've been seeing with this tech rally all year is starting to fade a little bit.
When we talk about sort of what moves equities right now, obviously the higher rates is certainly having an effect. The higher dollar also having an effect here. What matters more to you?
Ultimately, for us, it's earnings. And we are watching for a couple of things as earnings season is about to start in a couple of weeks. Given the hawkish comments that we have been hearing from the Fed, the dollar has ticked up a little bit higher. So that's a factor that we're paying more attention to as we head into the next earnings season. I think the shape of the consumer is also something that's worth watching. We've seen that they've been more resilient than ever this year. And as we are now getting into the back half of the year, we're starting to see a little bit of cracks in the system. The consumer is saving less, they're spending less, and as the student loans getting repaid is starting to pick up a little bit, we're actually seeing, Google search for words like restaurant reservations or airline tickets start to moderate a little bit, and I think that's going to start to impact companies forecasting what their earnings potential would look like, which is, I think, what's going to drive the markets.
Well, where does that appear in the stock market? What sectors would we start to see those cracks appear first when you talk about that slowing consumer?
Certainly, at the end of the day, we're watching the banks report first. They typically report as the first leg of the earnings season. We are watching loan growth. We're watching credit cards. Those are the things that will generally give us some bellwether metrics on the shape of the consumer. And as we edge closer and closer to the back half of the earnings season, of course, the retailers start to report, and you're looking at general spending on goods. But I think what we're looking for is services, which has been holding up the equation here. I think what's also something we're looking for is the fact that a lot of companies have been able to execute on pricing power. And I think that may start to lose a little bit of steam. And so we're watching for volume to come back, which I think is another very important metric to balance the act out.
And if we are maybe at the tail end of peak pricing power, what does that mean for some of these corporate margins that we focus on?
Yeah, margins are another thing that we are paying a lot of attention to. I think they've held up well, but as you've noted, considering that pricing power may start to slip up a little bit, we're also seeing that energy prices is starting to reverse course. Gasoline prices higher. I think ultimately that will translate into potentially higher input costs for manufacturing firms, et cetera. And ultimately, what we're also been very mindful of too is wage inflation, and that hasn't really moderated just yet. I've been encouraged that the quit rate, which is really the rate in which employees hop around in different jobs, has moderated back to pre-COVID levels. That's a good sign, and it's usually a leading indicator that wage inflation may moderate a little bit further. That could help buoy margins a little bit, but we are mindful that from an input cost standpoint, especially with energy prices now moving above 90, that could, of course, be a headwind for margins going into this next quarter.
I am curious, Amy, about what clients are asking you, both in terms of, I guess, where they should allocate, and more importantly, I guess, the type of returns that they expect in this environment.
It's gotten tougher, especially as the bond market and bond yields that we've been watching have continued to move higher. And so for us, it's a function of, one, rebalancing client portfolios between stocks and bonds, considering that bonds are now a more viable option than 18 months ago. Within the equity markets, we continue to focus more on longer-term trends, whether it's shorter-term, for example, which companies will benefit in a higher for longer environment, and which companies will benefit in longer-term megatrends like AI, for example. And so fundamental research to us still makes a lot of sense. Pricing power, as I've mentioned just before, and those companies that can innovate, in our opinion, are the ones that typically can grow earnings in pretty tough environments, even if a recession were to hit.
What does innovation look like these days, though?
It can come in many forms, Romaine. I think one of the biggest hot topics this year has been AI, and that's something that we do think is a mega trend for us. AI can come in the form of just being able to support the development of AI, whether it's hyperscale vendors, whether it's just those companies that can enable the app developers, or it's just using AI in a different features or different opportunities, as we've seen lots of features coming out of Microsoft or Adobe. Those are, again, ways to monetize off of AI. We think that those avenues, if you would, are different ways of innovating. And as you've noted, and I'm sure we all are aware, AI does increase productivity, and it can obviously lighten the weight in terms of employee compensation.
Amy, does the promise of AI, does that help you look past some of the valuations on some of these names that are very involved in AI? I'm thinking a lot of these tech companies with very high valuations.
To a degree, yes, but ultimately we are still very mindful of valuations. So if the question was rephrased to, are you buying NVIDIA? The answer is probably no at these levels, but ultimately we are mindful that a company like NVIDIA would be a great beneficiary of AI. It's just maybe watching for the windows of opportunity to get in. I think we probably would be more preferring the names like Microsoft as an example, which are still expensive relative to the market, but they've been able to successfully carve a number of ways to benefit from AI, whether it's investing in OpenAI or having, like as I mentioned before, offerings or features on their system that can monetize off of the technology.
All right, Amy, always great to talk to you. Amy Kong there over at Corient, helping us count you down to the close. And interesting, Katie, she was just talking about AI. We actually heard from the president a little while ago, basically saying that he's going to try to move a little bit faster here on creating some guardrails for AI. And that actually underpinned the big move that we saw in some of those stocks associated with it.
I'd love to know where that is on the priority list right now, though, for the president. It's a good question.
It is a good question. I don't think he would give us an answer, but we are counting you down to the close. We'll provide you some answers as to what happened today as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms on another volatile day here for equities, commodities, and of course, treasuries alike.
Is it the meta effect? What is going on today? I can't make sense of it. I mean, I'm looking at a meta chart, but it might be true of like almost every equity chart because we've had quite a turnaround from about.
Do you have one of those meta headsets? Those,
No.
What do they call? What do you call them now?
Oculus Quest.
Oculus.
Do you have one?
Sounds like Tim has one.
I've dabbled. I don't have the 3 yet.
Did you see how he like got that so?
I mean, I pay attention
What
to.
do you do on that, Tim? You just play games?
Yeah, you play games. I've messed around with it a little bit. There's some fun games. I did boxing on that. That was a fun little workout.
You could just, you
Interesting.
could box in real life.
Yeah.
Oculus Quest.
Yeah.
I think Choppy,
I didn't
though,
realize
is a
you had
good...
that much free time, Tim.
I don't.
Okay.
No, this was my workout. This was my workout. Yeah. But I do think choppy is a good word to describe today's trade. It's been a while since I've looked at a stat like this, but we moved between gains and losses on the S&P 500 at least a dozen times today. So investors kind of thinking, okay, which way are things going to go?
Did you count that?
Yeah, I just did. I counted it on the Bloomberg terminal.
That sounds painful.
SPX, GIP, and then I used my finger to count.
Did you really do that?
Yeah.
That's cool. That's no, that's high finance. And I was saying to Romaine earlier that it does feel choppy.
That's AI at work, right?
In the stock market, no clear direction there. But then you take a look at the bond market, the message is clear. Yields are higher right now.
Yeah, absolutely so. And that appeared to be the big driver. About half the stocks in the S&P are lower. About half the stocks in the S&P are higher. You put it all together, and the net effect is really a market that is unchanged on the day. Of course, it takes time for these numbers to settle, but right now the S&P 500 right around 4,274, which is right around where it was yesterday at the close, basically unchanged here on the day. The Dow Jones Industrial Average did move a slightly lower here on the day, down by about 0.2%. The NASDAQ Composite higher on the day by 0.2%, while the Russell 2000 is going to finish the day as the relative outperformer higher on the day by about 17 points.
All right, we're going to get into industry groups in just a moment, but I do want to point energy, really the outperformer. This is oil jumps to a one-year high. Has to do with levels at Cushing dropping to the lowest since July of 2022. Again, the supply-demand dynamics at play. But, you know, Katie, I feel like we continue to talk about energy being really an outperformer.
I'm going to do that right now. You take a look at the industry groups. Energy up about 2.5%. We all know this story. Oil prices in particular through the roof. That's benefiting the equities as well. Capital goods also saw a strong day, as too did some.